Okay. Good morning, everyone. We've got a full but not contentious agenda, and we might as well get started and go through it. Do we have any minutes that need approving? Okay. First, do I hear a motion that the proposed agenda be adopted?
I move.
Is there a second?
Second.
All in favor say aye.
Aye.
Ayes have it. Morning, Suzanne.
Morning. How are you doing?
Approval of minutes. What minutes are pending?
Minutes of the March 2014 commission meeting.
Okay. That was a good, fast job of getting the minutes.
Thank you, sir.
Do I hear any objections to or corrections regarding the minutes? Do I hear a motion that the minutes be adopted as written? Okay, I hear a
Second.
motion and a second. Any discussion? All in favor say aye.
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 Ayes have it. Okay. We are ahead of schedule. Jeff Berg, are you prepared to present regarding securities lending?
Yes, I'm trying to get you set up and then we'll move.
All right. Thank you, Mr. Chairman. What I'd like to do today is share with the commission a proposed change to.
Can you ask him to either speak up or get closer to a speaker? I can't hear anything.
Okay.
I can barely hear Jeff.
Jeff, you
Would
heard
it help
that.
if I sat in his seat, maybe? I don't want
The
to.
mic seems to be pointed away from you. That's what.
That's not the right mic?
No, it's that mic does not have anything to do with that. We have these paddle mics here. But you're just gonna have to
Okay.
speak loudly, Jeff, to hit both mics.
Okay.
Or you can sit at one of the vacant chairs at the table.
Okay. Why don't I do that?
Commissioner Loftus and Commissioner Gillespie are participating by phone, so you can take one of these microphones.
Okay. Is this better?
Yeah, I can hear you better.
Okay, great. Okay, what I'd like to do today is to share a proposed change to the current securities lending program. But let me offer some context for why we're having this conversation right now. Last fall, Herschel asked me to explore the question, if we're going to continue with securities lending, how should we do it? What's the right way to structure the program? So for the past 5 months, I've been working with HEK, who's been exceedingly helpful, as well as with Scott Forrest and Nicole Waits internally, who have just done an unbelievable amount of work on this project. And I'm excited today to have the opportunity to share the results of our work with you. What I'm proposing today, the team believes has 4 principal benefits to the trust. First and foremost, we expect that what we're proposing today will reduce the risk of securities lending by helping us protect against losses in the program. Secondly, we expect that we will earn more income from the act of lending securities. Third, we expect that we will also earn more from the reinvestment of cash collateral, and I will explain this in greater detail as we move through the presentation. But finally, we're exceedingly impressed with what we feel is just wonderful advances in transparency of the program, as well as in the reporting elements that we will have access to. What we're recommending today specifically is that the Commission hire Deutsche Bank as a third-party securities lending provider. But let me be clear about what this means. This is not a recommendation to terminate BNY Mellon. We're proposing that we add Deutsche Bank so that we can have 2 providers. As I note here on the slide, the State Treasurer's Office, in their custody contract negotiations with BNY Mellon, anticipated the possibility of third-party lending and negotiated an annual custody cost for this service of $75,000, which will help us as we move forward. Before we get to the heart of the recommendation, I want to move fairly slowly here and make sure that we establish a common understanding for what securities lending is. The easiest way for me personally, and I hope for each of you, to think about securities lending is to think of it as two separate transactions that occur. There's the actual lending of securities, and in exchange for that you receive cash collateral. The other transaction reflects the investment decisions around how you invest that cash collateral. As we move through the discussion, I will continue to refer to the lending transaction and the collateral reinvestment transaction. And I want to be clear in a little bit more detail as to that distinction. The lending transaction is exactly what it sounds like. We, South Carolina, the owner of the assets, agreed to lend our securities to someone else who has a need to borrow them. The borrower, in exchange, in order to securitize that, or to secure that loan, posts cash collateral in an amount in excess of the value of those securities that they borrow. The collateral reinvestment transaction simply refers to the fact that for the duration of that loan, we, the lender, have the right to invest the cash collateral received from the borrower for our benefit. As we sit here today, our securities lending program currently reinvests the cash collateral in overnight repo with agency, U.S. government agency securities as the collateral. Let me back up and return just for a moment to the lending transaction, because there's something that I think is very important to understand. When the loan is initiated, both parties agree to what is referred to as a rebate rate. The rebate rate effectively serves as the price of that transaction, and it specifies the amount of compensation that will change hands as a result of that loan. When you hear me refer to the rebate rate, I'll often quote this as either a positive or negative interest rate. And it can get confusing. So this part, I'm going to go particularly slowly. A negative rebate rate indicates that the borrower is paying the lender. So as we lend a security, suppose I lend Robert a security as an example, and we agree to a negative 1% rebate rate. If that loan lasts an entire year, I will receive 1% income from Robert. Now, I haven't invested the cash collateral. That is completely separate from the concept of the rebate rate. A positive rebate rate, so let's suppose that we agree to the same transaction, and that carries a positive 1% rebate rate. I will pay Robert 1% for the term in which he borrows my securities. Now, that can be confusing. Why would we pay someone to borrow securities? It only makes sense. Recall, I have the use of his cash collateral. It only makes economic sense for me to engage in that transaction if I expect to earn more than the amount that I'm paying him in the event that I'm paying him a positive rebate rate. It's an important concept, so let me pause here to see if anyone has questions so far.
Yes, what determines the rebate rate?
Well, there are two answers to that. The first simple answer is our negotiations determine that. But in reality, what determines that is the demand for my securities. So suppose, and I'll use Tesla Motors as the example. Tesla Motors does not have nearly the number of shares available to borrow as does General Electric. It's a very small float, if you will, and it's a more controversial stock. There are significant divergent opinions regarding Tesla Motors. So there's considerable demand to borrow Tesla. So the supply-demand imbalance right now has raised his cost to borrow Tesla Motors from me. So he will pay me a considerable rebate rate. Let's compare that to General Electric. There's there's a lot of General Electric stock outstanding. So therefore, it's not difficult to come into shares to borrow. So that he will not have to pay me a lot because he'll have a lot of other places that he can go borrow cheaply. So it's that supply-demand imbalance that can, at times, create what are called specials, meaning, and I'm drawing a number out of thin air here, but the situation with Tesla Motors right now, because of the unique circumstances around that company, it could be a 20% annual rate that he would have to pay me. That's a special. A special just refers to something where it is very profitable simply for him to borrow. I don't have to even reinvest my collateral. It's that profitable to me. So I hope that helps answer it. If I'm not being responsive to the question, please let me know. Okay. Are there any other questions at this time? Okay. I will move on. But before I do, I want to make 2 points on this slide that are important to understand. One, when you lend a security, you relinquish title to that security. And in the case of equities, that's particularly important because when you relinquish the title to the security, you are foregoing your right to vote those shares. And that, for some companies, can be very meaningful. Secondly, the borrower, this is something that usually comes up in these discussions. What happens if, when a dividend is paid and I have relinquished title to my security? I'll continue my example of Robert borrowing my securities. Robert has to create cash flows payable to me that will leave me with the same cash flow profile. So I will not forego any income as a result of having lent him my securities. I'm going to move to the next page, but please stop me at any time if you have questions. Securities lending is not a riskless opportunity, and it's important to understand where risks typically arise in the securities lending program. I say typically, it's not common, but when there is a problem, this would be where you would expect it to emanate from. I'm going to continue with my lending transaction here for just a moment. The main risk relating to the lending transaction relates to the borrower's inability or potential inability to maintain sufficient collateral. So if Robert borrows a security from me, and let's assign it a value of $100, he has to post to me, if it's an equity security, he has to hand me $110 worth of cash collateral, which I then have the ability to invest. Now suppose that security doubles in value the next day. His $110 of collateral is no longer sufficient to secure the loan for what now is worth $200. The security that he borrowed went from $100 of value to $200 of value. He has to collateralize that with me on a nightly basis. So now he needs to have $220 with me, or else he has insufficiently collateralized this loan. So if he fails to do that, I have risk. So that's what I mean by this first point here. The other key areas the other key area of risk relates to the collateral reinvestment transaction. So right now we are in overnight repo, but let's imagine we are taking credit risk. So if an issuer or counterparty is unable to or unwilling to repay an obligation in that pool, then I have risk again. Similarly, with interest rate risk, if I don't properly match my assets with my liabilities, and interest rates abruptly change, I can experience loss. Now, it kind of goes without saying, I think, that credit risk is the predominant risk in this pool. Interest rate risk would not likely be that significant, but for the purpose of being thorough, I wanted to highlight both sources. Now let's move on to the specifics of the recommendation at hand. On this page, we see what I highlight as the key benefits. This is redundant with the first page, but the key benefits of adding Deutsche Bank as a securities lending provider: risk reduction, additional income, and improved transparency in reporting. So let's go into each one of these briefly. Deutsche Bank's program offers 2 layers of indemnification. Thinking about that lending transaction, they offer their clients protection against the insolvency of the borrower of a security. And not to throw Robert under the bus, but to continue this example, if Robert became insolvent and could not post proper collateral, that Deutsche Bank's program offers to indemnify us against his failure in that case. I apologize, Robert. I don't mean any disrespect here. This, to be clear, is a standard provision, and it is something we currently enjoy in our relationship with BNY Mellon. With respect to the collateral reinvestment transaction, Deutsche Bank offers protection against a counterparty's insolvency for repo investments. This is not commonly offered in the marketplace, but is something that Deutsche Bank has in fact offered since 1997. In a moment, I'm going to elaborate, in a couple pages, I'm going to elaborate on this, on the importance of this, but I include something here in the middle of the page that I think it resonates with me, and I hope it resonates with each of you as well. This is a statement directly from Deutsche Bank about their program, and the part I'd like to call your attention to is where they state that they have, and I'll quote here, never been the subject of litigation, threatened litigation, regulatory investigation, or supervisory action. To me, that's pretty powerful. Finally, Deutsche Bank is willing to provide to us a fiduciary standard of care. My understanding, based upon the work that we've done, is that agents in this business do not typically act in a fiduciary standard with this fiduciary standard of care, but instead seek to operate under a standard of reasonable care. Again, this willingness to be held to a higher standard is something that I derive considerable comfort from. With respect to the lending transaction, so the act of lending the securities, our early research and input from HEK suggested that what's referred to in the industry as a specialist model, a specialist lending model, could be more profitable for us than other business models. Deutsche Bank, needless to say, is emblematic of this business model. We gathered actual lending data from BNY Mellon and Deutsche Bank in order to test this hypothesis. To be clear, not as an indictment of BNY Mellon, because they do use a different business model, but just in order to test this hypothesis. So the data is shown here, and I'd like to call your attention to the utilization rates as well as the rebate rates. And just imagine this part's not here for just a moment. So BNY Mellon, what we did was we allowed BNY Mellon's program to be the method by which we ranked these securities from the most attractive rebate rate to the least attractive rebate rate. So we're looking at, and I can spoil this for everyone, this is where the income comes from the lending transaction, is from the top end of this. But we looked actually at 132 securities that had a negative rebate rate, but for all intents and purposes, this is the part that's important. So let's look at the top 10 and the top 25 rebating securities. BNY Mellon has a better utilization rate than Deutsche Bank does, which is good for us and good for BNY Mellon. The rebate rate for Deutsche Bank on these securities, and these are the specials. This is the specialist lending approach. They are aggressive, and they get a substantially better rebate rate on these securities. So net, which is better for us. And we're just looking at the income only from the lending transaction, to be clear. This winds up being the important factor, is the quality of that rebate rate. And it drives the income in the program. So, again, this is not an assessment of the quality of the work that BNY Mellon is doing, but this is reflective of the different business model to focus on specialist lending is, I believe, a more profitable approach for us. A few slides ago, I mentioned that Deutsche Bank agrees to indemnify against counterparty insolvency in the collateral reinvestment pool. I want to explain now why that's important. The rate of return on a repurchase agreement, or I'm going to call this a repo, just for short, is largely determined by two factors: the collateral type for the arrangement and the term of that repo agreement. Since 2008, our program has used overnight repo with U.S. agency collateral. On this table, that's shown in this gray box, which is very slightly gray. And what this reflects is that you think about Fed funds and you earn 2 basis points over the 8 basis points of Fed funds. So you would expect to earn something in the neighborhood of 10 basis points. Deutsche Bank's indemnification provision gives us comfort to move beyond the gray box and create a repo portfolio that is diversified both by collateral type and by term. So what do I mean by that? We could accept multiple forms of collateral and go beyond overnight without, we believe, taking on credit risk that was unacceptable to us. This creates what I have been referring to internally as a beneficial chain reaction. What I mean by this is that when Deutsche Bank absorbs that counterparty risk for us within the framework of that indemnified repo pool, it allows us to accept these diversified collateral types and terms, which earns us a better return. The knock-on effect from this is that this better rate of return encourages greater utilization, meaning additional lending can be done profitably. Are there any questions about this? This is admittedly not the easiest concept to move through. So when it comes to transparency, Deutsche Bank in what we've seen is again at the head of the pack. They offer their clients real-time access into both the loan portfolio, so we can see what securities are on loan in real time, as well as the collateral reinvestment pool, so we can evaluate that in real time as well. If they lend an equity security by 10 a.m., there's a very good chance I'll be able to see that in their reporting before I go eat lunch. This is very advanced for us. Another thing I learned in this process is that there are actually, this quite frankly was revelatory to me, there are actually 2 benchmarks for evaluating this lending transaction, Market and SunGard. We don't currently have access to either of these, but Deutsche Bank has indicated they're happy to provide this to us as part of the program. They are happy, in their words, because they're confident in the quality of the job that they do. Clients of Deutsche Bank have access to dashboard reports, counterparty exposure reports, historical rebate data, as well as to compliance dashboard data, which would certainly help us in our oversight of a program. Finally, and this perhaps speaks more to my own laziness than anything, they would like to push these reports to us so that we don't have to go retrieve them. We don't have to go log into a system and design a report and create it. They will email it to us so we can properly oversee the program with less effort. let me close with my best imitation of a broken record. This recommendation helps us to remove risk from the program. Our economics are improved, and we have what I believe is enhanced transparency in reporting. So I will be thrilled to take any questions about securities lending at this time, or about this recommendation specifically.
Yeah, I mean, the main, I guess just one question really, because a lot of the program hinges on accepting Deutsche Bank as the counterparty on the indemnification. You know, do we, we're going to have reports that sort of show our exposure at any given moment, you know,
To the array of counterparties?
well, Deutsche Bank's the primary one because they've essentially put it all in the wrapper with the indemnification, right?
As a credit
our,
enhancement.
right. So they become our primary credit risk
Yeah.
component in here.
And we've looked at that
Yeah.
from the, we've looked at credit ratings, we've looked at CDS spreads, and when we look at them against peers, you think of Goldman, Morgan Stanley, you know, their credit spreads are, I can tell you it's 71 basis points. That doesn't have a tremendous amount of meaning without the context, but this is something that we would absolutely need to monitor in real time to ensure that indemnification had value to us.
Right.
I think that's your point, right?
Right, correct.
What's this mean in terms of numbers to us?
In terms of?
Numbers to us, dollars to the.
Well,
asset.
that will depend upon the amount on loan with each Deutsche Bank and BNY Mellon. But if you think about, I'll do some math in my head here. For $100 million on loan, right? Let's separate the two transactions. If we are able to earn 50 basis points better outcome in the lending transaction, that 50 basis points on $100 million would be $500,000 a year. Add to that the improved return on the collateral reinvestment transaction. So that could be another 20 to 30 basis points. So for each $100 million, I would, just using numbers in the ether, I would suggest it would be between $500,000 and $1 million.
Would the basis points be, are those numbers in the ether, or is that roughly 75 basis points for the whole transaction? Is that about what you
I
think
would,
mean?
it would depend, I don't want to get held to a number because it would depend almost entirely on what was being loaned. Right.
Right.
So I don't want to put a number out there, but I'm just using what I hope are conservative numbers.
And we own about $8 billion of lendable securities. What range of actual lending do?
Let's talk about utilization.
Would you anticipate we would?
Let's think about utilization here. I think that by adding, and I'll let Herschel add his comments, I think that we will lend additional assets as a result of having a program with less risk. So our comfort in lending some additional securities could go up here because of these protections. So it's hard for me to put numbers to it.
It's always going to be a moving target because of the underlying securities you have, and then that ongoing and changing demand for those underlying securities. But in the analysis that has been looked at, you do anticipate a significant increase of income using Deutsche Bank. Those figures, I think when you ran those were, I don't remember off the top of my head.
Well, there are additional accounts that aren't lent right now, and if we move forward with this recommendation and are lending those, it could be many millions of dollars of additional income.
And to think about is we're going from a synthetic positioning with Russell right now, and if we are able to move into separate accounts, that creates a larger pool of lendable assets as well. So there are a lot of variables So predicting the exact number is going to be very difficult, but I was trying to think of the exact number that, based off our current set of what they could lend,
Yeah.
what that income would
That
be
would-
projected to be. Is it
that
$3.5 million?
It looked, for the whole program, it wound up being north of that.
Okay.
North of 3.5 billion?
Yeah. Well north, in terms of the overall program impact. That, what you're talking about was a specific subset.
Right.
So I think that, you know, we could be, we could double conservatively our income from last year, which was, for transparency purposes, it's in our annual report, was, I think, $2.5 million. We could very easily double that.
Okay, anybody else have any questions of Jeff or Herschel or anyone else? Suzanne, do you have anything to weigh in on this? Or you
No, we think this is a great way to be looking at it. Obviously, the collateral pool investment risk is an issue that, you know, you want to make sure that you've got the right protections in place, because that's where a lot of people stumbled in 2008. But we're very comfortable with this recommendation. We think the dual approach makes sense, and that this should add value without increasing risk.
Staff has prepared a motion to implement the securities lending program as presented. Do I hear a motion that we adopt that?
I move.
I have a motion. Is there a second?
Second.
Okay, it's ripe for discussion. Go ahead, Mr. Loftus.
Hi, I have a very difficult time. I think Mr. Gillespie was having the same problem. The system is almost impossible to hear today. Is there something that James turned it up?
Mr. Gillespie solved his problem. He's here.
You know, I'd love to be here, but I'm sick. So I'm stuck at home.
Mr. Treasurer, I'm sorry, repeat your
I understand, well, I'm a little bit lost where we are, because it's almost, like I said, it's impossible to follow. We have a bit of a problem here, and the staff has spent about 4 or 5 months working on this, and Jeff and his crowd have done a good job, and I thank them for this. But we just found out about this last Thursday afternoon. The Treasurer's Office hadn't had a chance to verify information, provide more information, and to look at this in any meaningful way. I understand there's a vote scheduled for today, and I would just urge the Commission to accept this as very good information, and it's something that can move expeditiously on the track. But I think the vote today would be imprudent, and I certainly hope the Commissioners will give that some thought. Would hate to have what may be a very good opportunity, spoiled by acting too quickly.
Any other discussion? Any comments, recommendations? Hearing none, we'll move to a vote. All in favor signify by saying aye.
Aye.
All opposed, say nay. Ayes have it.
Was there any,
I'm sorry, I remember I heard that late, but of course you vote me down as a no.
one no?
One no.
Okay.
Okay. We're in the happy situation of still being ahead of schedule. I do want to note that since we started, we have at least 2 legislators to recognize, Senator Kevin Bryant and Representative Bannister. Of course, this is a public meeting. We always welcome it, but we're really honored when the legislators take their time to come over here. So thank you for coming. Mr. Fudson, you mind starting early?
Not at all.
Well, take your seat. The next agenda item is a report from the fiduciary audit team, Funston and Associates. All the commissioners have had significant time to study their report, and we're really honored to have them here and pleased that they're here.
Distribute the commission evaluation materials.
Okay. While y'all are getting situated, I've skipped over one agenda item. the commission evaluation materials, we're required to evaluate ourselves. And if I could ask staff to, by our own internal policies, we're required to do that. It's a good process. And I'm going to ask staff to distribute those materials, read them, give them their usual careful attention, and then turn them back in due course. When is our due date for getting them back in?
I'm going to ask Andrew that, the due date for the commission evaluation materials, or Dory. Dory, sorry. Due date for the commission evaluation materials.
It'll be in June.
In June. June.
Get them back in during the month of June. Okay. I would like to recognize Rick Funston and Keith Johnson and Ken Johnson and Randy Miller. I'm going to leave it up to you guys to control your own agenda, part of the agenda.
Thank you very much. First of all, thank you for the opportunity to work on this engagement with you. We've found it to be a very interesting and challenging one, given the breadth of issues, and we really appreciate the level of cooperation that we've had from everyone in terms of providing us with information on a timely basis. It's made our task much easier. In addition to the folks that we have here today, I'd also like to recognize Virginia Brizendine, in addition to Keith Bozarth and Marv Danza, who are not with us today, but we felt it would be more conducive just to have a smaller representation of the team. Having said that, what we wanted to do was to present to you recommendations give you some background on the report that focuses largely on the role of the Commission, the Treasurer, and the role for the Legislature. The purpose of this project was to conduct an evaluation of the fiduciary roles and responsibilities of the commissioners and staff and the relationship with other fiduciaries, as well as the operational policies and practices of the Commission. The goal was to identify what are the current strengths and weaknesses and provide a comparison with leading practices of other public pension plans and make recommendations for improvement. And again, our emphasis here was to focus on what the current situation was and what kinds of recommendations would be helpful to move forward to help improve operations and policies. Because the RSIC is a relatively new state agency, the review was designed to be broad in nature, and we looked at 6 major areas: governance, policies, organizational structure, investment administration, legal, compliance, and information technology. The process for the audit began on December the 4th of 2013. Since that time, we've reviewed nearly 800 documents and interviewed over 50 people, many of them multiple times. We've received comments and feedback from the Commission, from the Treasurer's Office, and from PIBA on both the preliminary recommendations which were issued in our midpoint report, as well as on a draft final report. So the rather weighty document that you have before you reflects a lot of input of a lot of different people. The audit was the final report was submitted on April the 18th, and so basically we've completed all of our work to date, and of course now the work lies ahead for the Commission. And I do want to say that we've been very impressed with the actions that have already been taken by the Commission and staff in beginning to address a number of the recommendations in our report already, and perhaps we can talk more about that later. In developing our report, we tried to answer 6 fundamental questions. Who are the fiduciaries? What are their duties? What are their authorities? Do their authorities match their duties? And are those duties in conflict with any other roles played by the various fiduciaries? How is the RSIC performing, and where and how can the RSIC improve? We made 124 recommendations. 108 of those can be directly addressed by the RSIC. 38 of those require the direct involvement of the commissioners. 12 require action by the legislature, and 4 require action by the state treasurer's office. So again, as I said earlier, the primary purpose of our presentation is to focus on those recommendations that either directly affect the commissioners, the legislature, or the treasurer's office. Let me begin by kind of repeating our overall conclusions, that there are no red flag indicators of malfeasance or misfeasance regarding the Commission's current policies and practices, and these were essentially the same findings as made by the State Inspector General. We believe that investment fee transparency policies and controls have improved significantly, that there's been, that the disclosure of the total external management fees is the most complete in the industry. And there are others who come close, but they don't quite reach the level of disclosure that you have achieved. The recent manager selection and due diligence processes are consistent and thorough, although sometimes slower than industry norms. And the RSIC has been implementing a number of strategies which should result in lower external manager costs. But we are concerned that the lagging development of infrastructure results in growing operational risk and ultimately financial risk. And we also want to recognize that the Commission has made a great many improvements and initiatives over the past 2 years. At this point, I'm going to turn it over to Ken Johnson, who coordinated our team's efforts in terms of the CEM cost-effectiveness benchmarking study. Ken?
Good morning. Part of our charge was to take a look at your overall costs of management and compare those to your peers. And in order to do that, we engaged the services of a firm called CEM Benchmarking, which is probably the premier fund of its service of its kind when it comes to benchmarking costs and asset allocation and the related aspects of cost effectiveness. CEM has a database of over 300 global public pension funds, and their review included a look at your asset allocation, your cost of management, the various management strategies you use, and the net return of the various strategies that you employ. In order to do that, CEM created a peer group that included 20 other pension funds, ranging in size from $14 billion to $58 billion. At $27 billion, your fund is right in the middle, 10 funds smaller, 10 funds larger. And they also compared you to a group of 65 U.S. public funds of even greater and smaller size. There is an executive summary provided as part of our report. There is also the Commission's also received a copy of the full CEM study, which runs some 200 pages and includes a lot of other useful insights and recommendations that I would encourage you to take a look at. The two probably major areas that we wanted to talk about that are referenced in the slide are, one, the finding that CEM came to, that the policy mix of assets that you've chosen, the targeted mix, underperformed your peers over the last 5-year period. And in fact, the 1.3% return that the policy mix provided was the lowest in the peer group. And CEM attributes that largely to the fact that you had larger allocations to cash and that you had a higher weighting in alternative investments. And as a result of the continuing move into alternative investments post-2008, you didn't have quite as large a stock allocation as you once did, and missed some of the market rebound that occurred in 2009 and thereafter. The other thing that CEM concluded about your asset allocation and your performance was that through the efforts of the staff, your actual return over this 5-year period was 2.5%. And they point out that although the 1.3% was the lowest in the peer group, the 1.2% that your staff added to get to the 2.5%, that increment was the largest in the peer group. Just a final word on that, there were about 40% of the peer group that had a lower absolute return than you did during this 5-year period. The second thing that CEM comments on then are the management costs that you are incurring. And they found that in 2012, your management costs were 103 basis points, or 1.03% of your assets under management. And that compared to a peer group average of 61 basis points, or 0.6%. Your management costs were the highest in the peer group for 2012, again reflecting your greater commitment to alternative investments in order to meet your objectives. The additional management fees that you are paying, the order of magnitude of those additional fees to be in private markets as heavily as you are quite close to what CM projected when they talked with you in 2006 about the potential cost implications of the strategy changes you were about to make. So one might conclude that the outcome of the cost is about what was expected. As compared to other funds with similar asset allocations, CEM concluded that your costs are about normal or average. So in other words, if you applied what your peers are paying to be in the same assets to your particular asset allocation, you get to about an average number. And there are largely two offsetting factors that are getting you to this normal situation. One is your heavier reliance on active external management and fund of funds has causes your costs to be somewhat higher than your peers. That's largely offset by the fact that the actual fees you pay your external managers are somewhat lower across the board than your peers, and that your costs for oversight and custody were lower than your peers. So you have two sort of offsetting trends that get you to the normal kind of conclusion. And this finding would be pretty consistent with what you heard from HEK in 2013. They went about it in a slightly different way with a slightly different peer group, but reached, I think, much the same conclusion. In addition to the management costs, the management fees that you pay for your investments, you're obviously also paying performance fees, which you disclose as part of your reporting and as part of the CAFR, and as Rick mentioned, you disclose to an extent that's as significant and as inclusive as any fund that we've observed in the industry. However, because other funds are not reporting at that same level, CEM was not able to actually benchmark your performance fees against your peer group. So the focus in the analysis was on the management fee part of the cost. A couple things that we suggest for the future. One is to take a closer look at the findings of the report. I think you might actually gain value in having CEM sit down with you at some point and talk about their methodology and talk about the trends that they observe and what other funds are doing in cost reporting. We also think that it would be in your best interest for a number of reasons to have CEM or someone else do a benchmarking of this kind on a regular basis, that it helps from a standpoint of providing independent reassurance to your stakeholders and the public as to what it costs to operate the fund, and I think would continue to provide value to you. So those are sort of the highlights of the CEM report, which again is a fairly lengthy document, and I would encourage you to look at the entire report.
Do we want to take questions as we go along, if there are questions?
Yes, sir, I had a question. This is Treasurer.
Go ahead.
Oh, okay, great. So on the fees, as I remember correctly, we deducted, or CEM deducted $164 million. Took that out of the equation because they were performance fees. Why was the decision made to take those fees out rather than to use a proxy and approximate the fees for other funds? When you go through your CEM spreadsheets, it gives you the average tier and what the percentage of funds or hedge funds were, et cetera. We could easily have given a proxy to that. But what happens out of $427 million, if I remember right, $104 million is taken off the table because it wasn't comparable. But we could have made it comparable. Can you explain that to me?
Yes, if I understand your question correctly, again, it was, why did CEM not come up with a proxy number for the missing performance fees from other funds? And the answer, I think, if they were here, would be that they don't feel like they have enough good information to come up with, even with a proxy for that figure, and we're not comfortable doing so. We did have discussions about that with them, several discussions about that, but that was the conclusion.
Well, the one thing we know for a fact, if you don't use a proxy, then they get, it's a zero, right? I mean, you're 100% off. If you do use a proxy, you could be some degree off. But we paid $164 million that wasn't evaluated for fees. And as we did rough and tumble measures in the office, the performance fees paid by other peers in our group were multiples, very much smaller than $164 million. So I think it is a crippling portion of this report to subtract $164 million in fees when the premier benchmarker couldn't benchmark or could not approve some proxy. I understand that y'all didn't do the report and I don't want to try to hold you responsible for it. But I think when you have to look at these things, the top line number sounds great, the top line information sounds great, but we come back to the fact that we didn't compare apples and oranges because we couldn't. We could have used the facilities that hedge fund managers use every day and others in the industry like using proxies. CEM used proxies in other areas of their report, but this $164 million is, if I remember right, 38% of our fees. Okay, enough said. I appreciate your straightforward and honest answer. So, thank you.
Ken, perhaps you could, for the benefit of everybody, explain what a performance fee is.
So, and of course it varies by asset class, but basically the distinction is a manager would earn a management fee that is not dependent on what kind of return they earn. It's generally some percentage of assets under management. And that's a standard part of the management fee is a standard part of all asset classes. In the private markets area, a substantial part of the compensation that the managers earn are based on performance, surpassing certain hurdles, and there's a sharing of the performance results with the manager, and that's called a performance fee.
Typically, is it in the 20% range?
That would be a typical carry percentage in real estate or in private equity, for example. 20% would be fairly common, although that's coming down, and I think it's probably lower than that in a number of the more recent investment negotiations you've gone through. So it's coming down.
Any idea what percentage of funds in our peer group or, outside of our public funds report performance fees like we do?
We were not able to identify any funds that reported them quite to the extent that you do. We, independent of the work that CEM did, the team made a number of contacts with other public funds that we asked CEM for their advice. Who's the furthest out there in terms of disclosure? And there are some that come close. Texas Teachers, for example, comes pretty close. There are two Missouri funds that go part of the way, but frankly, we heard as much response in the other direction. That the response was driven by sort of two ideas. When we asked other funds, why don't you report these performance fees? Part of the answer was, it's a lot of work to do it. And when we talked to the state of Washington, they said they thought it would take 6 additional people to do the kind of reporting that you're doing to gather that information report. The second is a philosophical belief on the part of a number of other fund managers that, well, performance fees are really different than management fees and really shouldn't be kind of lumped in the same bucket. One thing you do know is that both are coming out of the net returns, so that when we start comparing your net return to other funds' net returns, That's after all fees have been subtracted out, even though the fees themselves are not being separately disclosed.
Is it fair to say that $164 million worth of performance fees would represent something north of $500 million of extra income?
Yeah, I mean, it's going to depend again so much on the structure that you've got in place, because the different asset classes are going to have different hurdle and performance rates. They might be lower in the hedge fund arena than they are in the private markets area, for example.
Which is probably why it's so hard to develop a
Right.
proxy for it with such little information.
Well, there are proxies available. They use them. Other funds and all that use them, and they do diligence on folks, and they're out there. Again, thanks. The only thing about carried interest or performance fees, however you want to call it, is you can't say 164 million represents 500 because that takes away the fact that there was an opportunity to make X amount of money on that same amount of invested capital. So there's always a give and take. Can I move on to another question, which was it considered that this fee study would speak more specifically to some very direct questions, such as, did CEM, or for that matter, did Funston endorse our benchmarks as they are now? And what is the effect of the high fee allocation that we have? What's the effect of that over a significant period of time? We use on a regular basis a 30-year projection, and since Suzanne's at MHK, maybe she could give us what their confidence level is. You know, they make a confidence level. I mean, they have confidence in their 30-year projection. We use that on a daily basis to project forward and to create this portfolio. So if we know that and they're that comfortable with their 30-year projection, what is the high fee allocation and those fees that are continually coming from the portfolio with, what's the effect of that? Was that discussed or part of the CEM study?
Well, let me take the first question if I can, which was, I think you're asking if CEM opined on whether the performance benchmarks that you're using for each asset class are appropriate, and they don't opine on that. They do, as part of their report, show you what benchmarks you're using compared to what your peers are using, and you, as a basis for comparison. One of the reasons they don't opine on the appropriateness of it is that, particularly when you get an asset class like hedge funds, for example, there can be so many different kinds of strategies used that different benchmarks might be appropriate for one fund who's invested in a hedge fund that might not be appropriate for another. And one of the things you see in the CEM data is that there's quite a range of benchmarks that are used in each asset class.
Mr. Gillespie?
Yeah, I did those. They projected that our
Commissioner Loftus, Mr. Gillespie has the floor.
I was just.
Reynolds, I appreciate the effort. I saw the standing on TV, but I felt I couldn't hear, and I was so moved. It's just difficult. I certainly wouldn't interrupt you, and I apologize.
I was just going to say, you know, our private equity portfolio is relatively new compared to, I mean, this isn't like we're taking a 5-year look on an existing thing. I mean, we made the first alternative investments, I think, one in 06, a few in 07, 08, 09. Many of these funds have a 4-year investment period, right? So, I mean, was there any consideration given to where we are in our own J-curve as a program, you know, versus a mature plan that's had its private equity, you know, portfolio in place for a while? I mean, I think that's getting lost a little bit, you know, taking this 5-year look back when, I mean, into 2012, I mean, you would have less than half our funds probably at their, you know, at their investment horizon, right? I mean, they're still putting money in the ground.
It's a good point, but I suspect within the peer group of 21, you've got other funds who are similarly just getting into an asset class or just getting out of the asset class. So it would not be really possible for CM to kind of control for all that. It's a good thing to keep in mind, and you know, in sort of judging whether you're comfortable with where you fit, but I think that's not something they adjust for.
And I would add on that too, that as you're building up that private equity program, you're typically paying a higher fee structure on committed capital. So the more mature programs, they're paying typically lower fees on invested capital. So if anything, we're probably, because we're earlier, overstating some of those private equity fees.
I think the other thing we would point out is that this was calendar year 2012 data, and we know in 2013 you've made a lot of changes as well. You've gotten out of funds into direct investments and so forth.
Yeah, let me correct that, not overstating, but paying a higher because we're earlier on in the phase.
Mr. Chair, I did want to address the second half of the Treasurer's
Okay.
question, if I may. So there was a question raised about our capital markets assumptions and our confidence levels in them. So if capital markets assumptions that you use to forecast are obviously different group to group, but what we do is look at our assumptions compared to a study done by an outside group called Horizon that looks at 17 other consultants, investment managers, et cetera, to look at what they are using for their capital markets assumptions across asset classes. And I don't want to bore anyone with all the little details, but the bottom line is that and it was in our asset liability study back in the appendix, if you got a chance to see that. We're right about the average, or actually lower in some asset classes. So when you ask whether we have confidence in our asset allocation assumptions, certainly we have confidence. I would stress, of course, this is modeling and the actual outcomes are going to be wide. What we tried to do in that study was to make sure we not only looked at expected scenarios, which are easy to look at, but also how do you perform in a range of different economic environments? Are you protected when things are going well, like we've been going through? As, you know, do you earn a good return and participate in those markets? But how do you do when the markets are not doing well? And so we wanted to look at a wide range of outcomes there. And I think that's essential as decision makers to make sure you understand how that asset allocation is going to do in a wide variety of environments. So I just wanted to go through the bottom line is yes, but I just wanted to give some background to the answer.
Hey, Suzanne, you can never bore us, you know that. I appreciate all that you've done. And that was the point I was trying to make, was that we have a 30-year projection, but the confidence level in all of that is low, but it's not portrayed that way. Even as recently as yesterday at the retirees luncheon, it's portrayed as, hey, this is what's going to happen over the next 30 years. So that was a small point I was just trying to make. I'll let me nail down two things. One, I'm very pleased that South Carolina has a state law that says that we have to report all our fees. I'm very pleased at the hard work from KIBA and RSEC that has made sure that in the last 18 months, that's really come to the audited parts of our financial statements. I'm very proud of that, and I think the staff needs to be congratulated over and over for that. As early as 2011, I was talking on a national level about the national problem of underreporting of fees. This is not something I've singled South Carolina out. We've been better. We're fortunate to have that state law, others don't have it. So I think from that part of it, we should all be proud and celebrate this, and that it is a national problem. And I'm very pleased that Funston, that Rick and I had a conversation about this a year ago in L.A., Rick, if you remember, and it wasn't well known. And I think everybody's beginning to understand this. And around the country, my fellow treasurers are now all grappling with the same problem. I did want to ask and make sure that we recognize that CEM, when they ranked strategy benchmarks, we were the bottom. So when we were 0% of all our peers. So when we have value added, which this puts me in an uncomfortable situation of kind of arguing against staff. I don't want to do that. I want to thank them for the value added. But when you start off at the ground floor, you're the lowest benchmark plan, then you're always going to be, unless you have a total disaster, you're always going to have a relative great performance in this issue. I wish that CEM had opined on our benchmarks, and I wish that Funston had, because there just seems to be something out of focus when you are the bottom benchmark out of virtually every period you go to. And then the last question was, did they, and I don't think I didn't say this properly, or I cut you off, I apologize. Did we, or CEM, take into effect the long-term effect of a high fee allocation, such as what we have now?
No, CM's position is they basically don't opine on whether the asset allocation is appropriate or not, that they leave that decision to the board to determine based on what the board's risk tolerance is, what the financial position of the fund is. So CM discloses and reports on what the results of the asset allocation are, but they don't think it's appropriate for them to comment on whether that allocation is appropriate. That's really for the commission to decide in your work with HEK. And one of the things that our report suggests is that ways that the commission be able to spend more time on that topic through setting out your investment beliefs and what leads you to assume that certain asset classes might perform better over time, and what other factors are that you consider important to the decision, and then spending just more time talking about that and reviewing that. And I think you have a process for doing that. I think our suggestion really relates to being able to spend more time on that subject.
Yeah, I think it's really important to emphasize that CEM, which again is sort of the gold standard for performing this kind of an analysis in the industry, did an excellent job of separating out sort of the influence of the asset allocation decisions from the implementation of that asset allocation. And I think that we should really stop and just recognize that those are two different kinds of issues. The staff, I think, deserves some commendations for having added value to the investment allocation strategy which the board adopted. I think that one of the things that we have recommended basically is that the commission do attend to sort of a greater focus on kind of revisiting these issues and looking at the strategy decisions that are being made. We've suggested that you may want to consider bringing in somebody on a regular basis to sort of reevaluate your strategies and your costs. But I also think it's important to recognize that you can't really manage a pension fund by trying to just manage the fees. It's net returns that basically pay benefits, and it's not only returns, but it's risks that you have to take into consideration. So I don't want the discussion to be just to gloss over the fact that risk is sort of the opposite side to some of the return issues and fee issues that you're looking at on a going forward basis.
I couldn't agree with you more. And to me, fees are not just a dollar amount. Fees are manifestation of a lot of things. And you mentioned most of them. I certainly wouldn't want to anybody to assume that from my remarks. On the CEM part of this, I want to thank y'all for very straightforward answers. Y'all are not CEM, and you answered my questions succinctly, and I appreciate that very much.
All right, I think we're through with our CEM part of your report, so let's move forward.
All right, thank you. I did forget in the initial introductions to mention a very important member of our team, John Lukomnik, who is also not here today. He has the unfortunate task of testing wines in France at the moment, so he sends his regrets. I wanted to kind of turn to, I think, some of the bigger picture issues and what we found as we went through and looked at all of the different areas of policy and operation and so on. We found really 5 pervasive themes. And we've tried to organize our presentation today around those 5 themes. And I'd like to just spend just a moment on each of those. And then Randy will walk you through the recommendations that pertain to each of those in just a moment. The first one is improving assurance and reassurance to build trust and confidence. It's our opinion that assurance is the responsibility of executives, that they should provide reasonable not absolute assurance, but reasonable assurance that the operations are being run effectively and efficiently, and that they have capable people, processes, and systems in place to do so, and to manage the organization's portfolio within acceptable limits of risk. That's the assurance piece of it. The reassurance piece comes from those who are not part of management, that will give you independent reassurance that the reports that you're receiving from management can be relied upon. And this is really important. So you have a number of different sources of independent reassurance today. You have, for example, internal audit and compliance that reports directly to the audit committee. You're looking at establishing an enterprise risk management program. Again, that reporting relationship, I understand you're discussing that, but that could be another form of independent reassurance. Benchmarks such as those provided by CEM provide another independent source, as does, and of course, this review, which is a fiduciary performance audit, to try again give an independent view, independent of management, and independent of the commission, sponsored by the State Inspector General, to give you an objective opinion. And I think this is essential to rebuilding trust. And I'll talk more about that on the next page in terms of what level of information is necessary in order to have confidence in operations so that you can focus more on the strategic issues. The second part of it relates to building the organizational capabilities. People have referred to it in different ways in terms of getting out over your skis, in terms of perhaps the investment strategies, getting ahead of your infrastructure capabilities. Those issues have been recognized in terms of both HR and IT and others. And so this is something that you really do need to focus on. There have been concerns expressed, of course, about sending a lot of money to Wall Street. If you really want to address that issue and want to keep it more in South Carolina, then you're going to have to think about more about internal management of those investments. And if you do that, then you're going to need the infrastructure in place in order to be able to do that in an appropriate way. The next point relates to the biggest risk that the organization faces is the risk posed by its asset allocation strategy. And so we believe, for a variety of reasons, that the Commission historically has gotten more involved in issues such as due diligence and operational matters for reasons, again, having to do with the way the organization was initially set up. But we think it's really time for the organization and the commissioners in particular, to take a more strategic focus, to spend more time and Randy will talk more about this, through more meetings and so on, but to really try and recalibrate and address the issues that are of strategic importance to the beneficiaries of the fund over the long term, and less involvement in the day-to-day operations. The next point has to do with the alignment of fiduciary duties and responsibilities, and it's been a major area that we've focused on. Keith Johnson and his team at Reinhardt Law in particular have focused on this area, and we're going to touch more on that in a moment. But it goes back to the question is, do the fiduciaries actually have the authority to fulfill their responsibilities, and is there any conflict between the roles played by those various fiduciaries? And we're going to talk about that more in a moment. And then the last area is the issue around the improvement of the custodial relationship, which in today's terms has changed significantly from having bonds and so on in a vault versus now the kinds of range of services that can be provided by a custodial bank. So we'll talk more about that in just a moment. Before I do, though, I would like to really kind of set the stage in terms of moving forward. I said that today's or our report really focuses on current practices and opportunities for improvement to move forward. And I think one of the issues, obviously, is that fiduciaries must have timely access to information needed for oversight. I know there's been some issues about that in the past, but as we think about what I said earlier about assurance and reassurance, the commissioners should not be involved in the day-to-day details. All right? It's not appropriate on a regular basis. Now, obviously, you have the right to ask any question you want in order to be able to satisfy yourself that that in addition to the assurances provided by management and executive and to the reassurances provided by third parties, that you can go and kick the tires and make sure that that information is reliable. But again, the emphasis here should be on the need for oversight and not for management. It's not appropriate and it's disruptive to the organization when commissioners, and we've seen this in other organizations, when there are detailed requests for information that delve into operational matters that really don't pertain directly to the issue of oversight. Now, it's clear to us, and it's probably clear to you, that everyone is entitled to their opinion. You don't need to agree on everything. But again, it's very important, given kind of the history of the commission, that people be treated with dignity and respect, and that the personal attacks that have been continuing must stop. It's time to move forward. We feel it's really important that, given the commitment that the Commission has demonstrated, the improvements that it has made over the course of the last 2 years, as well as the commitment to making these additional improvements, that it really is time to move forward and focus on the future and not, again, not on personal attacks. Over the past few years, we know that the RSIC has had deficiencies in infrastructure, and you've recognized those, and you've recognized the importance of them, and you've certainly made considerable efforts to address them. The Commission does need to pay more attention to the non-investment side of the Commission, especially around issues such as HR and IT, and we've made recommendations, again, to expand the mandate of the Compensation Committee as well as the Audit Committee to reflect that. But again, our consistent theme is the most important issue, I think, for the Commission to be focusing on is on the asset allocation strategy and the infrastructure that's necessary to execute that asset allocation strategy. And that really should be the core of the discussion and not on operational detail. It's certainly been we've been highly impressed with the capabilities of the staff that the Commission has. They've been extraordinarily cooperative. We've seen, and as you saw from the CEM study, they did add value under a difficult circumstance. They've made considerable improvements. It's our concern, and we're not saying that the turnover has been high, but in order for you to recruit and attract and retain high caliber people, again, the environment needs to change. One other issue, too, is that I think has been a distraction. There's an old saying, which is that reputation is gained in inches per year and lost in feet per second. And so I think, again, it's extremely important that in order to continue the momentum that you have thus far and to continue moving forward, that the commissioners avoid even the appearance of any impropriety. And again, this is not something that one can dictate. It's one that has to be self-imposed by the commissioners themselves in everything they do every day. But I think, again, this is, in order for the momentum to be maintained, the commissioners must hold themselves to the very highest possible standard. The Commission should also, I think, the challenge that you've got is that you have a complex strategy in terms of your asset allocation, and it's difficult to explain to people. And I think we've seen you wrestling with that issue about how to communicate the relationship between performance and fees and so on. And so we think this is particularly the case with the legislature. As you know, we're making many recommendations to the legislature to improve the alignment of fiduciary duties and responsibilities. We think it's particularly important that those relationships be built upon so that you can have a collaborative and cooperative working relationship. And I think it has to do with your communication strategy. We think it's really important. I think what we've seen, you've done a very good job of communicating with the beneficiaries, but I think you need to expand your communications to include a broader range of stakeholders. One of the things that occurred to us is that, as it's been explained to us, the current asset allocation strategy is a complex and costly form of insurance against a catastrophic drawdown. So if that's the case, and again, we'll pick this up later in terms of investment beliefs and so on, the question that CEM attempted to answer was, given that you've chosen this particular form of insurance, are you paying more for that insurance than somebody else? And the answer was no. So I think, again, to put it into layman's terms and to communicate that, I think the Investment Commission really has to be proactive in terms of the way it reaches out and communicates these kinds of strategies. We certainly did find that the RSIC reports more external management fees than any other fund in the way that it reports it. And also that, going back to the issue of independent reassurance again, I think it will be important for you to retain an independent benchmarking service to give you feedback. And hopefully, as the national landscape changes in terms of disclosures of fees, and we're starting to see some signs of that, but as Randy pointed out and Ken pointed out, there is definitely a difference of opinion as to whether or not those kinds of fees should be reported, as well as the cost associated with reporting them. And lastly, obviously, that while we said at the beginning that there are many recommendations that can be addressed directly by the Commission, there are a number that cannot be addressed, that have to be addressed by either the Legislature or by the Treasurer's Office. So with that in mind, if you have any questions about that before I turn it over to Randy, I'd be happy to entertain them. I apologize,
Okay.
I do have a tendency to speak in gusts of up to 1,500 words per minute. So, Randy.
Okay, so I'm going to go through the 5 themes that Rick just kind of summarized and the specific recommendations associated with each of them. So starting with the improving assurance and independent reassurance topic, in order to improve trust and confidence that things are operating the way that they should be and that you can trust the reports that you're getting. The first recommendation is the proactive communication plan, which would really help all stakeholders. You've got quite a diverse set of stakeholders, and we believe you will need to very consciously develop a communications plan that identifies who the key stakeholder groups are, identifies the messages that you need to communicate, that they need to be reassured that things are operating well here for their benefit, and that you're anticipating what information needs to be conveyed, and that you have assignments both at the commissioner level and the staff as to who has roles to maintain those relationships and handle the communications. Secondly, and I won't dwell on this because we've talked about it several times already, but having an independent fee benchmarking service, since you do have this high cost allocation and since it has come into question, having an independent service should help to improve the confidence that the fees are in line. I think something we've also seen at other funds is it also can be a helpful tool for the investment staff to understand, are we doing a good job? In which asset classes should we be a little bit more aggressive on fees? Do we have certain managers where fees aren't appropriate? And we know some of those discussions have gone on, and you actually have gotten away from some managers because of their fees already. But having an independent review of that on a regular basis, we think would also be helpful. The fee disclosure policy, we were told that from the beginning of the inception of the Commission that the policy was to have full disclosure. I think that the Treasurer mentioned that that's actually in South Carolina law and so forth. We were told that last year there was a discussion about what the fee disclosure policy is, but what we've, as far as we could determine, it was not officially adopted. So we believe it would be helpful for you not just to go back to what was proposed previously but not adopted, but actually have a discussion about what your fee disclosure policy should be, get general agreement among the commissioners about what you think is appropriate, and make that a formalized policy. Enterprise risk management is something that I think came out of initially the Deloitte report 2 or 3 years ago. You've had it in your actual governance policy manual, and so we know that's been on the agenda to get implemented, and we understand at the last commission meeting, or one of the recent commission meetings, it actually was approved for implementation later this summer. So we're Obviously, you're well along in developing that, but we think that's an important aspect of the independent reassurance as well. Something we haven't mentioned yet, creating a single point of executive accountability. While the structure that you have today is not completely unique, it is not the most common practice, and it's not what we and others would consider leading practice. And it's really true in the private sector as well as in the public sector, that just managing an organization, it's important to have a single leader of the operation speaking for the operation, and also with an oversight of the entire organization, leading the organization. We think that will also help the commission to be able to back into more of a strategy and oversight role, because there's a single person accountable that they can work through on most topics. Another point is there is an internal audit charter that has been under development that has not yet been approved. Again, this is something that we think you should complete. It's probably pretty close to being underway at the moment. One additional recommendation we had was around for referral of service providers. And I think this gets to Rick's topic of suggestion that the commissioners really need to be above reproach in terms of ethical standards and appearance of any impropriety. We would suggest having a policy for sourcing and conflict disclosures whenever there is an instance of any involvement of a commissioner with a potential service provider. And we're really talking about named service providers here, I think, more than we are like any type of service provider, anything that has to do with the investments. Also, for the same reason, we're suggesting implementation of a personal and financial distress policy for commissioners as well as for senior staff and investment staff. And this would be typically if there is a impending bankruptcy, impending litigation, any of those types of things that would cause a personal or financial distress of an individual. And finally, it's been pointed out that while there's been difficulty obtaining enough budget to implement the infrastructure that you'd like to have had to hire the people you'd like to hire to really build the organization more quickly, it's also been pointed out that you've had unspent budget dollars every year to a significant amount. I think on average about $1 million a year for the last 3 or 4 or 5 years. And we understand there are reasons for that, but we think it would be productive to have a review of that whole process, both of the request process, kind of monitoring it, perhaps a mid-year review of how are we doing on spending the budget that's been allocated to us, and so forth, in order to make sure that, one, it is being spent well, and second, that you're asking for what you really need and can reasonably expect to expend throughout the year, so that that's tightened up somewhat. Any questions on any of these before we move forward? Okay. In terms of building capabilities across the organization and getting the infrastructure to be able to handle both what the investment strategies require today, and in particular looking forward, things like moving to a higher level of internal management and different asset classes and so forth. As we mentioned I just mentioned having a single point of accountability. What that means, creation of either CEO or executive director kind of a position. We understand that's something that the Planning Commission has been looking at already. Similarly, creating a senior human resources position and function. You have a lot of diverse needs throughout the organization. You've had to do quite a bit of recruiting. That's required the existing executives to really get involved in a lot of HR activity that could be handled by an HR professional. We understand that you've accepted this and the search is already underway. We've seen that pretty publicly announced and so forth. So we're very pleased that you're already underway on that one. Overseeing development of an enterprise infrastructure and resourcing plan. We think this is important. You're doing a lot of things. You've recently contracted with an administrator. You've got RFP that you've been receiving proposals on for a risk management system. You've been doing a lot of different things. And we have not seen evidence that there's kind of one comprehensive, encompassing plan that ties all of your different initiatives together, links it to the strategies of the organization, and also looks out multiple years. We think those would all be characteristics that would be important to have in a plan that helps to guide basically assess the needs, establish the priorities, and determine sourcing strategies. Is this something we're going to hire people to do internally? Do we need to find outside third-party partners that are going to help us establish that capability or improve that capability? And then also, as part of that, have internal governance policies around that. How does that work within the organization? Who's responsible? When we do launch an initiative, how do we manage it? What are our program management procedures? Who's responsible for oversight, so on and so forth? How does that link back to the commissioners for oversight as well? And then that would be important for overseeing the risk management systems and capabilities as well. We singled this out because we think that, and we know you realize risk management and having an effective risk management system that has visibility at the security level and so forth is a very important initiative. Hopefully you've been making progress on getting that with your proposals that you've been receiving. We also recommend eliminating the 30-day review period on investments. We realize there may have been a point where it made sense to institute that, but we also understand now that you actually, for over 6 months, have been working to lay the groundwork to be ready to do that. So we do recommend that you move forward with eliminating that, because it simply adds a delay in the overall due diligence process, that as long as the commissioners can be confident that all of the right things have happened in due diligence and the contracting processes, you shouldn't have to rely on a 30-day review period. We have not seen that at any other public funds. Also recommend that in addition to your existing HR policies with the executives, and this is really speaking to the commissioners, that you have a mid-year review with the executives that you have oversight of, so that they're getting some kind of mid-course correction feedback in a more formalized basis. I think that we heard the comment that, well, of course there are discussions, there's give and take, but it's often easy to overlook that there is a value to having a structured process to provide feedback. And I think we would expect this to be, for at a minimum, in today's organization, the COO and the CIO, going forward, the executive director and the CIO. We recommend evaluating the performance of the general investment consultant on an annual basis. Again, this is something that I think was underway before we started. We were told that the staff has been working on what that process would look like. We're recommending you move forward with that and implement that and have that as a new practice as well. And longer term, as part of the overall infrastructure plan, having an IT staffing and capability plan. What are the capabilities that you need? Where are you going to get them? Today, much of that comes from PIBA. Some of it's internal, but you've still got really just the start of a core of an organization here. Having a longer-term view that as you continue to develop the infrastructure, how are you going to resource that, and what do you really need to have, and to get that built into a multi-year kind of a plan and budgeting expectations. Any questions on the organizational development?
Perhaps I could just make a comment before we open it up for questions. I wanted to go back to this issue of a single point of accountability. We think that's particularly important for the organization at this point in time. and we would see that in terms of the kind of the general roles that a person like that would play, it would be setting the strategic direction or the framing the strategic direction for approval by the commission, supporting the commission, managing the finances and overseeing operations, engaging the stakeholders, as we've talked about, and supporting the CIO and the investment operations. That's what we think are kind of, if you were to boil it down, we would think that those would be the major responsibilities for someone in a position like that. We think it's particularly important given the flux that the organization has been in. And again, single point of accountability makes it really clear who has the overall responsibility for the organization at any point in time, but also make sure that the infrastructure keeps pace with the investment strategies. So with that, I'll just kind of open it up for any comments or questions on this slide.
Hey, Rick, since I'm having a hard time, can I jump in first? I hope I haven't cut on anybody. This is Curtis. On your doing away with 30-day wait, was that to be included with the legal sufficiency? If I remember the report right, y'all are supportive of a legal document of legal sufficiency that should be furnished to the Treasurer's Office?
Yes, we'll ask Keith to respond to that. Keith Johnson.
Yeah, one of our suggestions was that as part of transitioning out of the 30-day review, that there be an assurance document which is provided, which you currently do have a certificate of legal sufficiency, but I understand that the staff is currently working on tuning that up to make sure that it provides what the commissioners need and expect assurance on when an investment is being closed. So yeah, those are really tied together.
Great, thank you very much.
Okay. Any other comments or questions on this page? Okay, Randy?
Okay. So we'll move on to the third theme, which is resetting the commissioner's focus on strategy and oversight. I think the context for this is you started with very little staff, and you had an expert set of commissioners at the beginning who were really able to help get things going and to set the strategy, diversify the portfolio, be involved in due diligence, and so forth. We think that the kind of the life cycle of the investment commission is at a different point now, where it's a good time, an appropriate time for you to step back and reassess. What should we be doing as commissioners? What should our role be? We've got a very capable staff here. Again, we really want to compliment the competence and the dedication and the capability that you have, and you should be comfortable that you can step back and change the role that you have played. So we have recommended developing a statement of investment beliefs. This is actually something I think in the public pension world that is relatively new in the last 5 years or so. But we think in particular, in your case, that it will be helpful. Now, we understand there is a draft set of beliefs that has already been developed, which we're very pleased to hear. Having just had an initial look at them, I think we would recommend that in some areas you maybe add to them some things that are much more specific to what you believe about the markets, and where is it appropriate to have active, or when is it appropriate to have active management versus passive management, the role of different asset classes, and what you believe the risk and market return assumptions are for those. And really state them in terms of assumptions so that as time goes by, you can go back and look at, are these assumptions really valid or not, and that they should link into your decisions around your asset allocation strategy. And so while we're pleased you've made some progress, we would also encourage you to try to have them be something that really works for you to help communicate to all of your stakeholders why you've made the asset allocation choices that you've made, because they should link back into some of those articulated assumptions in the investment beliefs.
And if I may, just to tie it into what Suzanne said before around the capital market assumptions, making those explicit and articulate, I think would be helpful.
And then related to that is something that we have seen as kind of a leading practice at other funds is that throughout the course of your meetings through the year, that you would have kind of a standing agenda item that would cycle through each of the different asset classes. We know there are asset class strategies that the investment staff develops, and if you talk to them, we know that they understand very well the role of each asset class in the portfolio, what they're trying to do, if they have any tilts, so on and so forth. But that be an explicit part of your discussions during the course of the commission meetings in the year, so that when you have the asset allocation strategy, I guess typically in the first quarter, those discussions, it's relatively fresh as to we understand, why we've got each of these asset classes, what the role is in the portfolio, and so forth. And we understand that that's been a little more hit or miss maybe in the past than it could be. In terms of oversight, while we don't think the commissioners should get deeply involved in the infrastructure planning and development and so forth, but you should view your role as not just looking at the investment program, but that having more of an enterprise view of do we have everything we need in the commission staff, all of the capabilities in place, and making sure that everything is kind of in balance and that you're not ahead in one part of the organization or another. So from an oversight standpoint, we think that's something you should have more in front of you. We would also recommend changing the policies to preclude ongoing investment by commissioners in due diligence. While we wouldn't say it should be 100% ban on involvement, that there may be reasons from either an educational standpoint or a reassurance that you want to occasionally have some involvement. We think it's not an appropriate practice on an ongoing basis, that should really be delegated. We would recommend, we talked about having the ERM program, we recommend that be under the auspices of the audit committee, that the committee charter and mandate be expanded to include oversight of ERM. And again, I think that's something that's already under discussion and sounds like it is already underway. Similarly, with the additional recommendations we've had for HR, the fact you're hiring a senior HR person and so forth, that the compensation committee's charter be expanded to not just look at salaries and bonus pools and so forth, but to include a broader mandate around having oversight of HR and providing support to the executive director and the HR function that's being developed. We also recommend that you get back on a cycle of more frequent meetings. We understand in the early days that there were even monthly or even in some cases more frequently than monthly meetings, and that has kind of tapered back, and that the current policy is quarterly, but actually over the last couple of years you've averaged closer to 7 or 8 meetings. So we think it makes sense to just plan to have on a regular basis more frequent meetings, which would also not pose some delay in approval of investment decisions as well. We found that was just kind of one component to why sometimes the whole investment process was a little bit slower. In terms of compensation policy as well, we think it would make sense to have a policy that would review the implementation of your compensation program to gauge progress. This is something that's been looked at, but it appears to us that since the last time it was more episodic and that there hasn't been an annual follow-up on it. We think that should be something that the compensation committee takes on. We also understand that last year there was a revised agenda setting process for the commission that was articulated and put in place. As far as we can tell, that was not ever formally adopted. We recommend it sounds like it appears to us that it's a good policy, but that it should be formally adopted. And then the last two recommendations here relate to improving something you've already got. You have a self-assessment program that is apparently kind of a relatively straightforward. The chairman of the commission goes through a process each year and gets feedback from the commissioners. What we've seen is that it can be a more in-depth process than that could include, for example, upward evaluation from the staff, peer-to-peer evaluations by commissioners, often would be with a third-party facilitator working with the chairman, and so forth, that could be also helpful, particularly as you're changing charters of your committees. You've got ad hoc planning committee now. You may want to really take a more formalized approach to how we're doing in each of these areas. And then related to that, self-development, you have an expert board. It's very knowledgeable in investments, but we think it would also be a better practice to have a more formalized program that would look at what are the things we want to be educating ourselves on, and taking that even over time to what would be appropriate for individual commissioners to supplement their professional experience and experience here, and to have a combination of general board education as well as individual education to improve the experience and capabilities of the commission. Any questions here? Discussion points?
Yes, sir. If you don't mind, I'll jump in again. We had old stuff in again. You had a couple things in the plan to allow commissioners to no longer be particularly active in due diligence. Would that be the same for strategies, like the commissioner assigned to strategic partnerships? Would that position go away as well, or would that stay because that's considered a strategy, not a due diligence automatic?
Yes, that's clearly a part of that, Mr. Treasurer. It's in the detailed report. We didn't articulate it here. Maybe we should have. We don't believe that's a good practice because it can result in sort of a supermajority vote of the person who really is the expert in private equity. If the other commissioners know that person was involved in due diligence and they support it, we think it's both hard for the staff not to recommend it, as well as we believe that the other commissioners will defer to that person. It doesn't mean that having a...
The second part of that was...
Well, he didn't finish his answer. Hold on, Commissioner.
It doesn't mean that we don't think that deep experience by the commissioners is a good thing, but we don't think that it should be formally assigned asset classes to individual commissioners. And again, that is something that you typically don't see with other funds, and we don't think that that's a good practice.
Thank you, sir. On the agenda setting, what protections are built in? I think if you've read the agenda policy that I don't think was adopted as you mentioned, I'm unable to say, I'm unable to do anything on the agenda. And since I'm also not allowed to serve on any committees, I end up having to grab every piece of information or try to manage a vote or something, always on the tail end. So for me and then for others in the future, are there any protections that can be built in so that we can actually have a voice?
Yeah, Mr. Treasurer, I think that the policy that was developed contemplated a process for all of the commissioners having input into the agenda. I think from our standpoint, that's very important. Obviously, you're all fiduciaries, and you all have co-fiduciary responsibility. Should have the ability to get an issue at least suggested to be put on the agenda. I don't think that we are in a position to sort of recommend specifically how the commission decides that it wants to, adjust that process. That's, I think, something that you have to work out yourselves.
Yeah,
Thanks again for a straightforward answer.
Well, for what it's worth, I just had an idea, because, I mean, part of, one of the issues I know we've had with the agenda is the FOIA laws, which require us to post the agenda 24 hours in advance. And I will say it sometimes a little clunky if everyone's trying to do different phone calls or emails. But I suggest maybe 2 days before we have a scheduled meeting where we set the agenda and we can post that. That's the sole action item for the meeting. 2 days in advance, we just get a conference call together. I think it would work better.
Rebecca's committee is addressing this point, so maybe we can have a discussion on that at that point. The quandary is always, can every commissioner set the agenda, or can some group smaller than every commissioner set the agenda? And the practice has been, if any two commissioners want an item on the agenda, it gets on the agenda. But if it's just one sole commissioner who has something that nobody else thinks is worthy of being on the agenda, it doesn't get there. So, but we can have that discussion later. Let me ask you. You said that the commission's role is oversight, not management. And I agree with you, our role is oversight. In the course, you guys read the statutes and the governance policies and everything that has the equivalence of the force of law that relates to our conduct. Does the treasurer of South Carolina have an oversight role over the commission's responsibilities for the investment and management of the retirement system's assets?
Well, I'm not a South Carolina lawyer, and we weren't asked to give opinions on that, but I can tell you that from our experience in looking at the situation in other states, that the way that case law has generally, and the courts have generally treated the position of custodian currently, is that it's a ministerial function. It is very clear, I think, in South Carolina that when the commission was created, all of the treasurers and the budget and control board's responsibilities for investments were transferred to the RSIC, and the RSIC was given sort of sole and exclusive authority over investment decisions. So it appears that the treasurer does have, because the treasurer is one of the commissioners, has an important role as a fiduciary on the commission. Again, I'm not a South Carolina lawyer, but I know from experience in other states where we do a lot of work that the custodial function has, over the years, become much more of a, viewed as being a ministerial role.
Right. But, I mean, in the private sector, I mean, custodians definitely can influence an investment process because they're having to post capital, right? I mean, they get to make decisions, whether or not to accept an asset into custody. They can require you to provide valuation procedures. I mean, it's not, they're not necessarily trying to say don't or don't buy that, but they certainly have a choice of whether or not to custody a particular asset.
Well, all I can tell you is that, again, I'm not a South Carolina lawyer, so I'm not in a position to give an opinion on it. But in the other states where I have worked, basically, the courts have generally treated the custodial role as being a ministerial function that is not a fiduciary.
I would never, ever assert that I have that responsibility that is falsely presented just now, nor would I accept it. I don't want it and would not accept it. It is a canard that is floated on a regular basis to encourage dissension and nothing else. As custodian, we are a bank, effectively. The Bank of New York is our custodial agent. We are recognized as a bank in the eyes of the federal law. And we try to have policies, procedures that protect the funds of the asset. Some people don't believe we should have signature cards. Some people don't believe we should have policies and procedures, and I can't help that. But we will continue to do the job as well as can possibly be done, and I make no apologies for it. And if occasionally somebody has to fill out a form to protect a $40 billion trust fund, well, then that's just how it works. I know I have to do one for my little checking account, or my personal account, so I don't think that that should be surprising, and I don't think it is the bank trying to control my funds by making me be responsible to follow certain procedures that are designed to safeguard the funds.
Yeah, I should just add one thing, though. To the extent that a custodial bank starts providing other investment-related services, I mean, there may be fiduciary responsibilities involved in that, but the custodial function itself has been viewed as a ministerial role.
And what does ministerial mean in this context?
It basically means that the custodian has a certain role for processing payments, custodying assets, which don't really involve the exercise of a significant amount of discretion over management of the assets.
All right, okay.
If we're ready to go to the next section of your report, even though I had promised y'all yesterday I wasn't going to break in the middle, I'm breaking my promise since we started early. Let's take our mid-morning break.
Very well.
Now, we'll take about a 10-minute break. It may stretch to 15, depending on.
All right.
Okay, let's start coming to order. Hello? Hello? I messed up. Brian?
Or somebody else?
I thought I was answering the phone, but I think I hung it up.
Thank you, Lord.
It rang, so I hit the answer button.
We need to know.
Hmm?
Welcome to the conference center. Please enter your act. Thank you. Please stand by. If you are the chairperson, press the star key. Now, please enter your chairperson. To start your conference, press 1. To start your conference now, press star. You will now be placed into conference. For a menu of conference commands, press star at any time.
Okay, we'll resume with item 4 on your outline, Mr. Funston.
Thank you.
Randy?
Okay. So our fourth theme was alignment of fiduciary duties and responsibilities. And now this and the last theme, there are some things that the commission can do, but these are more, I think, messages for the legislature, in this case, the BCB and the Attorney General as well. But to go, the topic is to be fiduciaries and have true fiduciary responsibility, you should have the authority to make the decisions which allow you to have the resources and capabilities that you need to effectively execute your investment strategies. And as I think we've said in the report, you have a very complex fiduciary and oversight structure in South Carolina with 9, including the commission, 9 different parties that have some equity and oversight or fiduciary responsibility for the retirement funds. And by any standard, that's a pretty complex structure. So what our recommendations to the legislature represent are really, we believe, opportunities to better align responsibility and authority. The first of those recommendations is to clarify the role of the Budget and Control Board, and now with the new legislation, its successor entities, the Department of Administration and the State Fiscal Accountability Authority. It's not clear in our minds, we're looking at the legislation and the various codes and so forth, what responsibilities still really reside with the BCB. It is clear about the procurement having authority over allowing deviations from the standard state procurement policy. Beyond that, it's not really clear what's still there, so we would recommend that that be clarified. Secondly, and I think we've talked a little bit about this, is we believe that the treasurer has conflicting duties in his 3 roles as a member of the Budget and Control Board, as a commissioner, and as the custodian for the fund, that there are some inherent conflicts in having those 3. The easiest one is just being on the BCB with oversight of the commission where he's a member, having oversight of himself. I mean, that's just simply not good governance to structure something that way. And I don't know, Keith, if you want to elaborate on any other specific aspects of that.
Well, I guess I would just highlight that we did include a discussion of some of the the issues around the governance structure and both the complexity and the misalignments of responsibility and authority and the sort of the ambiguity of the statutory scheme for how each of these different 9 players, particularly the 5 main designated, the 5 main entities that are exercising proactively exercising fiduciary authorities, how that all plays out. So there is Appendix H to the report does have a discussion of that. I think the only thing that I would say basically is that to the extent that you have a situation where there is some ambiguity about the actual responsibilities of the Budget and Control Board or its successors in the future, or the Treasurer's Office, PIBA, some of the things that the legislature has responsibility for in terms of setting the budget and approving headcount and approving the performance incentive compensation. It just creates an environment which is inherently likely to, at some point, result in conflict and confusion around who has what authority and how they relate to each other. So I guess from a legal standpoint, it just seems like it's a recipe for fiduciary liability. And I think our recommendations are really around trying to better align authority with responsibility and to simplify the structure and be more explicit about what roles are being played by each one of the players in the system.
Okay. We've talked a couple of times about the having a change in the organization structure to have a single point of operational accountability with an executive director. We also realize that there are some technicalities in the legislation to allow that would need to be rectified. So a recommendation to the legislature is that they allow an executive director to be the single report. Perhaps one of the biggest recommendations is, yes.
What is supposed to be the correct relationship in this revised relationship, a revised arrangement, the correct relationship between the CEO and the CIO?
I can respond to that, and then perhaps Randy. The intention here was to establish a single point of executive accountability. It was not the intention to in any way undermine the authorities and responsibilities of the CIO as being responsible for investment operations. So that I think that is often, when we've approached this issue with other organizations, that's often been a point of contention, like what does that really mean in terms of how it works? But I think that's what we're saying is that the primary purpose for the establishment of a position of a CEO or executive director is to have that single point of accountability for all the reasons we discussed before, supporting the commission, establishing a strategic direction, and supporting the CIO, as well as managing and overseeing the operations and engaging stakeholders. I believe those are kind of the main points. But in doing that, we don't feel that should in any way undermine the authority of the CIO, other than if there are investment decisions that, for example, if you were to move to internal management suddenly, I think you wouldn't have the infrastructure in place to do that. So you'd have to make sure that the two are coordinated so that they actually work together. But this should not be, in our opinion, a source of contention. It should be, obviously there's going to be a dynamic relationship, but I think, again, the primary purpose was to establish a single point of executive accountability. Is that, I'm repeating myself, but am I answering your question?
No, thank you.
Okay, Randy, did you want to add into that? Anybody else?
I think you asked the question, what's the relationship, and certainly from an access standpoint, I think we would make sure we separate access versus a reporting relationship. I think the commission has access to whoever they want to have access to, and that wouldn't change at all. I think the salient points are more around the setting goals and objectives and compensation and evaluation, hiring, firing, so forth. And I think there's not a one-size-fits-all answer to that. It's certainly, what one approach we've seen is to retain, while you could still have a reporting relationship of the CIO to the executive director, the board could still retain veto authority for some of those kinds of decisions. There are different ways to approach it that would recognize that the CIO is a key position that isn't like other functional areas because of the investment responsibilities.
And just to reinforce Randy's point about access as distinct from reporting relationship, you would have access to any executive that you would wish to have access to. So that shouldn't change. Does that help clarify?
But for things like agenda setting, we would recommend that be, I mean, typically that's the chair of the commission with the executive director, and then there's input from other commissioners. There's also input from other staff of the commissioner, the investment staff. But it becomes a more direct point of contact, both for the commissioners to manage the interactions, as well as, I think, for kind of externally for representing the commission.
Okay.
That's my question. Thanks.
Okay.
So D, the fourth recommendation to the legislature, we think is a very significant one, and that is that we recommend that they delegate the responsibility for setting the budget, setting the staffing headcount levels, and compensation beyond what you have today to include bonus pools and actual allocation of bonuses and so forth to the commission. We recognize that may not be easy for the legislature to do. I think if you look at the benchmark information, looking at other investment boards, that's the overwhelming structure of that they have, and it's definitely the trend that we've been seeing as different public pension funds around the country have been evolving and maturing in recent years. Again, it's the point that you have the responsibility for investing $28 billion. As we talked about, hundreds of millions of dollars of fees to managers. If you can be entrusted with that, why can't you be entrusted with the $13 or $14 million of internal costs that really are determining how successfully the rest of that money gets invested and is spent? It just seems to be a major inconsistency in alignment of responsibility and authority. And so that's a point we want to make very strongly with the legislature. We also recommend, and this really ties back to the first theme of independent reassurance, that there be, and we don't have a real specific answer about what this needs to be, but we think it could improve the confidence in the financial reporting, considering the structure today where it's really PBA's comprehensive annual financial statement that contains input from the commissioner's investment report, that there be, in conjunction with that, something that is initiated and managed through, directed maybe is a better word, an independent third party to do an assessment that could be an external audit, it could be fund valuations, procedures, controls review, could over time be all of those things, but that would be authorized by the legislature and perhaps the third party from an independent standpoint selected by the state auditor as the PBA auditor is today. We also, getting to the commissioner selection criteria, current criteria are very, very high. We have not seen any other trustee board for public pension fund across the U.S. that has the same level of requirement for qualifications that this commission has. We think, to a great extent, it goes a little too far in that it relies very heavily on qualifications, either academic or certifications, and it doesn't give credit for relevant experience. We certainly believe having a capable and qualified trustee board is a good thing. However, it's a little too narrowing at the moment, so we recommend that there be a credit given for relevant experience that would allow a little bit more diversity of the board and increase the size of the pool of potential applicants. Related to that, we also think it would be useful to expand the size of the commission. We recommend 1 or 3. The reason we say 1 or 3 is because you currently have an even number of voting commissioners, and we just think, while this isn't a major point, we think it would be more logical to have an odd number of voting commissioners to avoid tie votes. The vast majority of other funds have a odd number of voting members. Yes.
On that one. If, some of the previous versions actually recommended maybe making the executive director of PIBA a voting member, and I can't recall, is that still in the final draft?
Yes, it is. Yes, this recommendation actually is abbreviated, but G 8.2 does recommend that the PIBA representative become a voting member.
I think the way we word it is one option could be to make the PIBA
and my only point
representative.
would be, I mean, if we have to, somebody from PIBA has to sit here and be a fiduciary and responsible for all of this stuff, but yet doesn't have a vote, it seems to put, especially me, in a kind of odd situation. So I don't know who the executive director is going to be going forward, but I'd just like to throw my 2 cents in.
So you would support
even though
that?
you don't get a vote for it.
Even though
we really would recommend of the 1 to 3 the 3 as the option. We would also recommend having a couple of representatives of members as members as well, which combined with a recognition of experience would probably make it easier to find very qualified members that would be either active employees or other retired members as well. We think there would be added benefits having the beneficiaries more highly represented on the commission, and that again is something, if you look at other funds, that's typically the case.
Thank you.
And back to the PIBA question, it would require an exemption for a state employee to be on the commission.
Just so I'm clear in my head, backing up a little bit on like 1C, is that, so y'all are contemplating more of an integrated system with us and PIBA with one director, or each agency having one? Is that 2 different recommendations, or in y'all's mind they were really one and the same?
No, we're not recommending any change with the relationship vis-a-vis PIBA and the commission.
Okay. This is just the change in legislation to enable us to enact the other recommendation?
Yes.
Right, got it.
Yes.
Understood.
Well, it really, we believe it's within your authority to appoint a CEO or an executive director. It's just that you have this vestige of the legislation that still requires a direct reporting relationship to the commission. It's not necessarily problematic, it's just that because you would have access anyway, under any circumstance.
It would be more a cleanup of the legislation to ensure that there weren't any inconsistencies with that organization structure.
Okay.
Okay. We would recommend that the legislature consider term limits. Again, we would not say this is a major point, and you really haven't been in existence long enough that today it would even be in effect. I think we have seen other funds where there may be a commissioner or a trustee that's in place for literally a couple of decades. We don't think that's necessarily reasonable. We do recognize continuity is important. You do have a very good practice of having staggered terms, and that helps for continuity as well. So again, we don't think there's a problem there. That's more something to kind of looking to the future. Also for the legislature, the legislature currently retains the responsibility for setting the rate of return assumption. And it appears that in recent years there has been a reasonably good process of considering the actuarial inputs that they've received, as well as the market assumptions and so forth. However, there isn't anything in the legislation that requires that the legislature review that on a periodic basis every 3 years, or some reasonable amount of time. And we recommend that they, from a self-discipline standpoint, that would be encoded in the legislation. The one recommendation we have for the Budget Control Board, assuming, I guess, before any of these other things happen, the Budget and Control Board still has responsibility for approving modifications to the procurement process, as you know, and there was a proposal taken to them within the last couple of years to change the procedure for acquisition of information systems related to investments. That apparently was not taken up and approved. We would recommend that there be a new attempt at that, and that they would agree to modify it so that the commission is allowed to, or the commission staff is allowed to have a normal procurement due diligence process that would be comparable to what you do for investments for information systems. We found that the current procurement process is both too limiting of staff involvement in the process, as well as typically making it take longer time than it needs to. And again, looking at other funds, other investment boards, the overwhelming situation is that investment systems are not under standard state procurement procedures. And then the last, I'm sorry?
This is going to require legislative action. That means it requires education to some extent. But what are the types of problems that you all observe with the legislature having the intensive budgeting authority and budgeting and approval, et cetera, of what we do from a monetary point of view? What kind of problems can that cause? And has it caused?
Well, I think being tied to the annual state budget cycle makes it far more difficult for an organization like yourselves that's growing and still needs more information and other resources to be able to plan beyond the next 12 months. To get the budget process to sync up with the state procurement process is kind of another challenge, so you find yourself late in the state fiscal year with a procurement that's not quite complete, and so that money can't be used. I think we heard a couple things about procurement. One is that the process just takes a long time. That was one. And the other is that you're able to apply the extensive amount of expertise you have when you're screening potential hires to do investment management. You can engage those folks, do the follow-ups you feel are necessary to clarify any questions. Our understanding of the state procurement process here is that it's fairly similar to other state procurement process. There are a lot of constraints around how the process has to work and what kind of interactions can happen between the agency that's trying to procure a service and the vendors. And so, again, this is another area where you've got all this authority to invest the money, yet getting to the tools to kind of help you do it and execute it in the most effective ways. It seemed to us to be a compelling argument to do more. And your peers are, by and large, other investment boards, are further along in terms of having control of their budgets and procurement.
Yeah, I think it also recognizes that the commission basically does serve as a fiduciary for the beneficiaries in the retirement system. The legislature, while it may not be considered to be a fiduciary, it really has a different sort of set of responsibilities and a different set of rewards for legislators, which may not be aligned with what the role of a fiduciary manager for a retirement trust fund is, I think, just the distinction that these are not state funds or public fund, they're trust fund monies that you're managing and that the costs are taken out of. It's not. It's really a different issue, and there's really a misalignment there of responsibility for the decision on allocation of budgeting resources.
And I think that point, that last point in particular, needs to be emphasized again, that it's not coming out of the state general fund. It's coming out of the retirement funds, any of the expenditures that you do make. So I think it's important for everyone to recognize that it's not, the public's not paying for that.
And our decision to spend it is subject to the fiduciary standard restriction on what we spend.
Right.
Yes, and one of the other things that's a little bit confusing, I think, for legislators is they may not actually realize how a budgeting decision for an organization like this could affect the risk exposures that the retirement system is exposed to. I mean, one of the things that our report talks a lot about is kind of the infrastructure needed to service a complex investment portfolio like you have, and to the extent that you may save a few dollars in budgeting authority, you may also end up having a hidden kind of risk that generates, which could, if it comes home to roost, kind of dwarf any of the savings that may have been involved in reducing the budget. So it's a real fiduciary decision to weigh those kinds of considerations, and it's usually something that's outside the natural range of considerations that legislators are used to performing.
Having said that, though, I think that there have still been many instances where you have been underspent in your budgets. And I think one of the key roles for a chief executive would be to make sure that those monies, that those finance, the whole management process is much more robust about the budget requests as well as the managing of the approved monies. Now, obviously, there are some factors, as Ken pointed out, that are beyond your control in terms of year end and so on, and carryover, rollovers, and so on, as well as delays. Just because you get approval for a position at the beginning of a fiscal year or a calendar year, does not necessarily mean that you'll be able to hire that person on time. It may take you 6 months to recruitment. Therefore, you'll still have a 6-month period where those monies have not been spent. So there are some elements of that, but nonetheless, we still feel that you could do a much better job of putting in place the appropriate infrastructure to manage your budget and your budget process.
That's a point well taken. I don't know about the other commissioners, but I've never been entirely comfortable in my own mind as to why we leave money on the table.
On the spending side?
Yeah, on the spending side. Yeah. I understand the theory of what you just said and all of that, but I've never felt like I had a handle on how that occurs.
Well, I mean, historically, I think it's been some delays, and then also the inability to recategorize across budget items from personnel to systems.
Right.
Yeah.
When I was chairman, I actually sent, this gets a little bit to 1A, but I'd recommended that the trustees at a minimum have that budget authority, not the legislator, in a letter to Brian White, for the record, just because I saw that kind of up close, and at a minimum, I would have thought the Budget and Control Board as trustees would want to control the budget, because they at least meet year-round, and we have the ability to interact with them on BD 100s and, as budget processes go. I felt like there was an existing process, at least, that could be levered, just because the way companies manage budgets now, I mean, it's literally month-to-month activity. I mean, it's no longer an annual activity in the private sector by any means.
Right.
And I tried to skin that same cat. I had made a recommendation to former Senator Ryberg that we have limited autonomy up to a certain number of basis points.
Right.
And if we want to spend more than that, then get approval. But
And this gets down into the details, but we did just sign a contract for an administrator. in March, which is 1.2 million a year. So that is a major expenditure that is going to take most of our current budget authority. There's still going to be money left on the line this year, but of course, going forward, depending on what the legislature gives us, that's going to be a major expenditure, as will a risk system, which we're in the final stages of. So I know that we've left money on the table. We should see an immediate decrease in the amount of money left on the table due to those two
Is
major
administrator up
expenditures.
and running as we speak?
No, it is not.
How come?
We're in process, so it's going to take a while. We had planned to go live July 1st. We're working on that with the administrator. We do have data access issues right now with BNY Mellon that are unresolved.
Explain that a little bit more, please.
Sure. So we've sent a couple of requests to Boney Mellon. We've also sent a request to the treasurer's office in order to get our administrator access to Boney Mellon. And as far as I know, at least as of this morning, that access has not yet been granted. We had a similar situation with HEK, and I think it took about a year for y'all to get access.
Why does it take that long?
There's a very simple procedure, and when that's followed, things happen. It's a very simple procedure. We outlined it previously. We outlined it as recently as Monday night or Tuesday, and of course got a completely flippant and irresponsible response from Senator Rob Byrd yesterday. So if you're serious about getting hooked up, if you're serious about that, comply with a simple procedure. If you're not, just keep talking about it, and we'll just keep listening to you.
Sarah, are you familiar with the simple procedure?
No, I'm not. We had received a format from your office, and we tried to comply with that. If we have not complied with it, I don't know how we have not complied with it.
Well, and then you need to go back and read our letter. And the other thing, y'all gonna sign this contract on the 8th of, or maybe it's the 10th of March. You told us about it Thursday afternoon and asked us to start. And then on Friday, you started bombarding us with questions. Where's our commission? It's a significant undertaking to arrange all of this. Your failure to plan has created a problem in my office, and we just, don't have the staff to deal with it during a whole board meeting and a RSIC meeting because you just haven't planned. We sent you a letter on Tuesday, I think it was. Please read the letter and respond. It's easy. We need the entire confidentiality contract. We need a couple of other documents. I'm not sure if they're off the top of my head.
We did provide it, Mr. Treasurer. If we have missed the mark, I need you to tell me that we have missed the mark. That was the reason for my 2 emails and my 2 phone calls to your office asking if we had complied with what we needed, and no one responded to me.
Did you not see the letter that we sent on Tuesday? Is that not a given to you?
I received a letter from Dory that Dory had received from Melinda, and that's what we used to proceed.
Okay. We corresponded with everybody, the FIBA and RSIC on Tuesday, I think it was. I'm a little confused about my days. And we laid this out for you. We just need those documents.
Sorry,
If we don't want
can I make a
access,
suggestion?
don't comply with it.
Can I make a suggestion, or let me ask a question? How long would it take to fill out the paperwork for the simple procedure?
I don't think as much at all. I don't have it in front of me for them at home.
I mean, just a guess.
Such as when we got this, again, at the last minute, and then had to have it all done by the next day.
I'm sorry, I'm just trying to, I'm sorry.
I understand, Rebecca,
I'm just trying to.
But I'm not going to have my office slandered repeatedly by the investment commission.
You know, I don't know about you, but this is beginning to sound like an Abbott and Costello comedy. Now, this sounds to me like a total miscommunication here. Sounds like it's a simple question of sitting down, getting the proper whatever things that you want and we need here, but let's get it settled and stop this nonsense, period.
Ed, I agree with you 100%. We have 6 more letters. We're not the ones standing, as Sarah has just done, saying it took a year before and it's taking us forever now. We're not the ones making those outrageous claims. And I don't care what y'all say about me. I'm used to that. But I will not have the office
Well,
slandered.
Mr. Loftus,
We ask you to fill out the form. If you don't
Okay.
fill out the form,
Can
you
I
will
make,
not get your paycheck.
I'd like to make a can I make a
I
suggestion?
recognize Rebecca. Go on.
Sorry, I'm thinking if it's a relatively simple process, maybe takes about an hour to fill out the forms, if you could assign one of your staff members, and we will assign one of our staff members, and we can send our staff members over to your office to sit down with your staff members and actually make sure that we get all of those pieces in place, and then there will be no confusion, and you guys have all of the documentation you need. And but maybe just if you have a staff member to facilitate for an hour, if we send some people over there, we could get everything done. Would that be agreeable to you?
We have a full-time custody officer who is at your beck and call. We'll be more than happy to have her made available to you. I don't know what she's doing this minute, but we'll get you in the queue with everything else.
Okay.
It's a process. Before we can start the process, we have to have the paperwork.
Well, so I think that's what I'm asking. Would it be okay?
Mr. Treasurer, if I can speak, an email was sent on Tuesday, and it clearly said that all we're asking for is the signed confidentiality agreement, which we received when we set up y'all, and the services agreement.
Okay.
That's all we're asking for. If you get it, we don't need a meeting. We'll be able to process it.
So you got the
two documents.
Let me finish, Rebecca. What we received from Library was the RFP link. Now, I can't do anything about this. I have put in emails to you commissioners on a repeated basis, the distortion flowing from the office. And I don't mind his personal emails, the insults to me, but I'm not going to have the office because of this. We didn't ask for a link to a public document that we could have gotten ourselves. It does not include what we.
All right, let me cut to the chase here. All we need is a signed confidentiality agreement. Is that what I hear? Sorry.
You need, whatever is in that document, whatever the letter we sent was, we need that to begin this process. It is not just the easiest clicking and clicking.
And we'll be happy to forward the.
Which should, by the way, have been started in mid-March.
And Mr. Treasurer, I don't know if you want to consider forwarding the email that was sent Tuesday morning to all the commissioners so they can see that we're happy to do it when we get the two documents. But they need to be exactly what the process we followed in November.
We go through this, we work through everything we do. Extortion, that's extortion, that's extortion. All we ask for is a couple of simple documents. And if the commission can't figure that out fast, then we've got some significant problems we have not addressed.
Mr. Loftus, that's unnecessary to be.
Well, thank you. Thank you very much. I don't know how you guys can see it is, but my office is putting enough time on this already. And we just ask that the.
Well, what I'm asking you to do as a commissioner is put in a little bit more time and help us get this done. Thank you.
We're more than happy to. We're there, we were there 14 and a half, 15 hours yesterday. We'll be there today about the same thing. So just let me know. We all are ready. We're ready.
All right, let's move on, Mr.
Okay,
President.
we just have one more item on alignment of fiduciary duties and responsibilities relating to external counsel. And Keith, do you want to?
Yeah, this is actually an issue that we often see at public funds, and different public funds do it differently. But the crux of the issue is that typically attorneys general do not have on staff at the Department of Justice attorneys that have the expertise to be involved in private market investment negotiations. It's just sort of not something that's within the scope of what they're usually required to do, nor are they accustomed to handling fiduciary duty kinds of issues relating to an investment organization. So the trend at other public funds has been for the Attorney General to provide a sort of a high-level set of criteria for selecting the investment and fiduciary counsel, but to essentially delegate the responsibility for selecting the counsel to the fund's internal legal counsel, with some reporting back and some previously agreed upon sort of contract terms for retainers for the counsel and fee levels and that sort of thing. So it can become a source of delay in investment transactions if there isn't a smooth process which allows the in-house counsel at a fund to basically make sure that outside counsel is assigned to an investment transaction as soon as counsel is needed, which could even be before the investment is brought to a final approval. So we're just suggesting that some of the procedures that are used at other funds to try to establish a pre-approved pool and pre-approved contracting and fee arrangements be put in place. We think it would help to streamline the process.
We do not have the full extent of what Mr. Johnson's talking about. No, we do not. It will require, at the very least, a discussion with the AG's office. What I'm less clear about, Ellen, is whether a statutory change actually is needed. I'm hoping we can just work through it with them rather collaboratively.
Yeah,
get to
most other states have
Yeah.
basically, since the Attorney General still actually retains the approval authority, but has just established criteria under which the approval has been delegated, they've been comfortable with it. One of the other kind of issues that sometimes arises is fee levels and
Is what? I'm sorry.
fee levels in terms of the law firms. The other participants in private market investment transactions will typically be represented by law firms and attorneys that have a lot of expertise in these kinds of very unique transactions. Oftentimes, their fees are higher than what may be charged by in-state law firms that don't have that kind of experience. Just from my perspective as a legal advisor to public pension funds, I think it is really important for our clients to be able to have access to the same quality and expertise of legal representation as the other participants, the other investors, and the general partners that are on the other side. Otherwise, it puts you at a real disadvantage. So sometimes that becomes an issue, the level of fees which attorneys general are willing to approve, but I think it's very important that the fee levels be set at a range where you can attract and hire the kinds of expertise that you need in those transactions.
Mr. Chairman, we've reached the allotted time in terms of our presentation, but as we mentioned earlier, we're certainly available to continue on. Would you like us to continue?
I would, and we put some extra time.
Okay.
We're close.
Additions in there that are not your fault, so.
That's quite all right.
Okay, so we're close. So the last theme, and we broke this out because it does seem to be such an issue, as I think just evidenced by the earlier conversation, improve the custodial relationships. And I think the context for this is, I think as was mentioned earlier, the custodial bank today is so different than the role of custodian when many of the laws were initially established, where the treasurer of a state was the custodian and simply had a bank vault, or had a vault somewhere where they retained security papers and so forth. Today, the role of a custodial bank is absolutely integral to the smooth and effective functioning of an investment fund. And what we're seeing is that hasn't been the way that it's been happening here. And as a result, we're recommending to the legislature to consider options to improve the relationship. We've identified 4 potential approaches to it. I wasn't going to try to go through them all right now, but the fundamental commonality across all of the options is to give the authority for the selection and management of the relationship with the custodial bank to the commission. And we know the treasurer doesn't agree with this, but we would say unequivocally that is the only rational way to structure it. It is the overwhelming way that it works at other pension funds. There are a couple of states where the treasurer is the custodian of fact as opposed to custodian of record, and Certainly, we've worked in one of those states, and it's been it's contentious with all of the funds in that state where that's the case. It doesn't add value. It's a distraction. It's just as we saw here. If the commission was working directly with BNY Mellon, you wouldn't have had this conversation. It would have simply happened when it needed to happen. In our point of view, there's no value added from having the Treasurer's Office involved in that process whatsoever. And we recommend that, that the legislature change that.
But if I might, it would not have happened because they haven't filled out, would not have complied with DNY's requirements. You know, in this role, we are ministerial. They have to fill out papers. They just say they want to fill out the papers they want to fill out. BNY or Deutsche Bank or whoever is not going to allow that. And so, while I understand what you're saying, and I agree with almost all of what you've got here, and I do agree with some of the comments about the Treasurer's role, but that doesn't belie what we see. If they refuse to follow a simple procedure for the bank and with us as administrators, just as the paperwork handler in the middle, they're not going to do it for them as well.
So what is the?
They're a real responsibility. And then the other part of this is, in looking through y'all's research, we did some research of our own, and any of the y'all call peers were not statewide organizations or multi-organizations like this. What we found was the overwhelming number of the AAA credit rating states and the next tier down had the treasurer as a custodian. Now, they had different roles, of course, and investment commissions different. But when you take away the ones that do the teachers or certain counties or something like that, it becomes more pervasive. So I don't want to sidetrack the whole conversation here. It's not, wouldn't be worthy because, you know, we'll lose every vote we ever had. But the point is that RSA does have to obey somebody's rules unless funds are disbelieved, you don't have to obey any rules.
Well, I would beg to differ with the Treasurer's facts.
Request information in lieu of Bank of New York, and we can't get it. And as you well know, as a commissioner, I still can't get information. So those dynamics aren't going to change. And so while there is some value to what you say, it's more to the story than a simple flip of a switch. Thank you.
I would beg to differ with at least one of the facts that you presented, that if you look at public pension funds in other states, it's the rare exception where the treasurer is the custodian. It's not, the treasurer may well be the custodian for other funds of state, but not for pension funds which are not owned by the state.
Okay.
I mean, candidly, the custody issue gets ultimately to a counterparty risk issue, and no one really thought about it until the financial crisis, right? The SEC's defined. A hedge fund manager technically is a custodian of our funds when we make an investment because he has the right to obtain ownership and deduct fees, no differently than a mutual fund manager, right? But I think it goes to the heart of how do we manage our counterparty risk, regardless of where that resides. It's an important function. It's not to be overlooked. Otherwise, the SEC wouldn't have issued guidance on what constitutes custodial relationships, in 10, right? And how do we put the proper processes and controls around that, regardless of where they reside. I don't think it's a issue we should take lightly, right?
And we're not suggesting that you should, and we're not suggesting certainly that you shouldn't abide by policies and procedures as our...
I guess my bigger point is there's no longer one custodian of our funds, right? The way we invest, by law, we probably have up to 50 now, right, custodians of our funds.
I think the question is, who should those custodians be ultimately accountable to?
Right.
Who at the end of the day? I think it's our point of view that given what the range of services that the fund now depends on the investment side from the custodians, it seems clear to us that the accountability ought to run to the commission rather than to the treasurer.
And I think, again, just to reemphasize those points, we fully believe in accountability. We fully believe that you should adopt robust policies and then enforce them and adhere to them. And in fact, as many of our recommendations point out, it was over 120, it was 120 of them or more. It's all about how to improve those, the robustness of those policies and improve adherence to them, which is the issue again of around accountability. Respecting the treasurer's argument, I'm sure he's right, is that in most states, the treasurer is responsible for the custody of state assets, but the retirement fund is not a state asset. And so I think that's where we would tend to differ. With that in mind, perhaps we could go on to the next point.
Before we go on to that, I want to give Sarah the last word
sorry.
on what is Bank of New York's requirement?
As far as I understand it, we have met Bank of New York's requirements. They have communicated with me. We sent them 2 letters. We sent Bank of New York the first letter on April 10th, which was signed by Senator Ryberg. We sent them a second letter on April 15th that was signed by Herschel Harper. That letter was provided by Conifer, which is their standard letter to gain access to a custodian. Bank of New York has told me that they are fine. They are waiting on word from the treasurer's office in order to approve the request. So that's why we reached out to the treasurer's office to understand what format they needed things in. And so it is my understanding that we have met the requirement of Boney Mellon and that the requirement is not hard. I think it's a flip of a switch for them to turn this on.
I'm sorry, Rick, Sarah had the last word on that. Sarah had the last word on that. Mr. Funston, next item.
All right, thank you.
Okay.
Thank you as usual for my ability to speak back to the story fact. Thank you.
You're welcome.
Randy?
Okay, so now moving to the treasurer, the recommendations for the treasurer's office. In the current structure, there was a change. There's a first recommendation is to review the positions that are required to sign release of cash transfers, just to make sure that the appropriate people from the commission are authorized to release cash. Second is we recommend that the treasurer tell the custodial bank, BNY Mellon, to accept signatory changes from the commission. We would expect that to be either the executive director or the chair. There isn't any reason that the treasurer's office has to have any involvement in who is accepted to sign. And that to continue a change that was made in the middle of our study, which was to allow standing instructions for the custodial bank to receive funds. It had required signatures to accept funds that then would start earning interest, and while understanding is that the signatures were always obtained, it did result in a lot of extra work and running around trying to get them at the last minute to make sure that they were accepted and got the overnight interest. So there are some, and I guess with the new custody officer, hopefully these recommendations can be taken up in the treasurer's office and addressed in the near future. The last recommendation here is to determine the future of securities lending. Obviously, we heard earlier today you've been making a lot of progress on that and have just taken a step in that direction. So we applaud that.
All right, any further questions on that?
Are y'all scheduled to present to the legislator? I mean, obviously you were hired by the Inspector General. I mean, and you're reporting to us. Are you
Yes.
taking these recommendations? I mean, how's that interaction? What's that timeline?
I'm not sure about the legislature, but we've been asked to appear before the Senate Finance Subcommittee this afternoon. Good. All right. So with that in mind, if there was no other further questions on that, I'll move on to the next slide, having to do with implementation considerations. No doubt, we have given you a great deal of information to digest and many recommendations in support of our findings. In the back of our report, we have included the last pages as an Appendix Q, a list of each recommendation together with an assessment of its criticality, the degree of difficulty associated with that implementation, whether commission involvement is required, whether outside cooperation would also be needed, and if yes, who that would involve. This was, we worked in collaboration with the commission to kind of make sure that we were on the same page in terms of understanding the degree of difficulty associated with each of these recommendations. They're fairly self-explanatory. They're organized within each of the 6 categories of our report of governance, policy, organization, structure, and so on. And again, in descending order from difficulty from difficult to medium to easy. So we'll leave that with you. We note that already the commission has taken some significant strides towards implementation, having formed an ad hoc planning committee to review the report, to assign specific staff responsibilities, and we also are aware that there are a number of items that you actually want to start to take action on as early as today. So we applaud that, and we also would recognize that this entails a significant amount of work for the organization, and that you've obviously demonstrated your commitment to move forward with this. But perhaps if there's one thing that I could leave you with, having observed again some of the interaction just this morning, there's an old saying which is fix the problem, not the blame. And my suggestion would be is that perhaps you could put that in big, bold letters, right, and focus on fixing the problem rather than who was to blame. If there was one recommendation that perhaps should have been here, or maybe that's the superordinate recommendation, that would be my advice to the commission. Obviously, this is the first in a series of fiduciary performance reviews. Next one starts next week. As I said to you in our opening meeting, you've been reviewed so many times you must feel like you're on Broadway. But you've had many reviews in the last little while. We hope that this one will complement the findings and recommendations of the other reviews. We recognize, too, it's going to require a significant amount of time and energy, and we would suggest that any subsequent reviews be deferred in time, and that you be given enough time to actually implement and act on what you're already doing, and that any subsequent review could then follow up on the implementation of that, as well as perhaps selected deep dives, as opposed to being something as broad as this has been. So we sincerely hope that this has been and will be of value to the commission. Again, we want to thank the staff, and I will point out Andrew Chernick in particular for having been so responsive to all of our requests 24/7, and we've been getting emails from Andrew at 3 o'clock in the morning saying, sorry it took so long, all right, when we just made the request that day. So again, thank you very much, and if there's any questions, I'll be happy to entertain them, but thank you for your participation.
Just on the back, you said these are in absolute priority order, or just by your within
each category?
Within each category.
It's grouped by category.
Right.
And within each category.
Right.
But it's not an overall.
Grouped by the nature of the risk and the criticality of getting it right.
Correct. And the degree of difficulty.
Right.
And obviously, there are things that you have control over and things that you don't. So that concludes our presentation. If you have any other questions.
Before you leave, let me, and I'd like to ask each of the four this question. And I may not phrase it very eloquently, or elegantly. Not trying to be eloquent, just elegant. You're bound to have had some impression of the South Carolina Retirement System Investment Commission and its staff and its people before you started your work. And I presume I know you have an impression after you started your work. As I've made talks to various civic clubs or retiree organizations or small groups or whatever, I've always expressed a great deal of pride in what we and our staff have accomplished over the years under the leadership of Mr. Gillespie, Chairman Powers, myself, all of us. Is that sense misplaced on my part? Should I pull back on that? What's your overall impression of us, what we do, our staff, et cetera?
I'll go last.
Okay.
Randy?
Well, to be honest, I think before we came here, we weren't sure what we were getting into based upon the media coverage. You know, it certainly raises a lot of doubts in people's minds, and I think it can't be positive for the system or for the beneficiaries. Having spent time with everyone here, I think we've been very, as I said earlier, we've been very impressed. You've built a very competent, capable organization. Obviously, we've identified things that we think can be improved, but I think we can't quibble with your embracing virtually all of the recommendations as quickly as could reasonably be expected, more quickly in many cases, and that so many of them are already underway. So I think there's the attitude, the dedication is clearly here. I think you do have a lot to be proud of in terms of the organization and the capabilities.
Yeah, I'd agree with that. I guess the other perspective I would add is that I had the opportunity to sit in with a couple other members of the team on probably a dozen to 15 conversations with your outside managers and vendors, and of course they're going to say you're great human beings, but they had a lot of good things to say about your staff, and that they were your staff is wearing them out with their due diligence, and if the average is down here and you're up there, so there was a lot of positive things said about the staff and their process. I think, having come from a public investment organization myself, I think you still struggle a little bit with how to be a private kind of operation within a public sphere, and I think that's still a big challenge for this organization, is to not only think about how to do things from an appropriate investment perspective, but how to position yourself in a public sphere so that you've got the acceptance and the support of the constituents, which you're absolutely going to need to make a lot of this happen. So that would be my just one parting bit of advice, is to think about the fact that you are in a public environment. Things don't move quite the way they do, or maybe as rationally as they should sometimes. But I think I see that as kind of your major challenge going forward.
Yeah, I would say that before I came down here, my image of the organization, which was based totally on what I read what I read in the press, was not very favorable. And having been here and actually experienced and seen the facts, I think it's really unfortunate that the media has portrayed an image of how this organization is run that is completely at odds with reality. And unfortunately, I think that's been to the detriment of both the beneficiaries and the taxpayers of South Carolina. So I feel sick about it.
Well, can I ask you, would you have said the same thing if you had been here 3 years ago?
That's a really good question, and I'm not going to answer that because I wasn't here 3 years ago. I don't know, but I like the question.
Well, and I think
it is an important question, and I don't want to prolong this, and I apologize if I'm interrupting. I just can barely. But the point that I'm trying to make is I'm proud of the place too. I think Funds and Support is an excellent report. I think it has shown what tremendous work has been done in the last 2 or 3 years, and I think that everyone should be rewarded for that. Now, I believe, along with you, that the media should stop. And as Mr. Gillespie would tell you and other fair-minded people, I tried to stay out of the media, but I continue to be safe. So I think that the 3 years ago are in a very, very different place than it is today. And that's why I was happy to work with the audit, which I knew what they looked at today and not 3 years ago. So I think what you're saying is excellent, but I think if you track back to 2008 audit, 2012 audit, and the other paperwork, that you see that it was a very different place, and that more work has been done in the last 2.5 years than is
been easily conceived of. Thank you.
I appreciate your unexpected endorsement of my chairmanship in the last year. Rick, you wind it up. You have the last word.
Well, thank you for that. First of all, I would agree with the treasurer's comments that there have been significant improvements over the course of the last several years, and that was really why we said maintaining the momentum, about continuing to make that kind of a progress. I guess when it comes to your comments about being proud of your organization, I think you should be proud of your organization. But I would caution you, much along the lines of what Ken was saying, is that pride should not translate into arrogance. And we have heard that comment at various times, specifically with respect to the legislature. And that I think that it is essential that the organization, having building upon the good relationships that it already has with the beneficiaries, that rebuild and establish good relationships with the legislature, because many of the changes that we've talked about that will be significant changes for the commission really depend upon legislative support. So I would really encourage you to, while being proud, be humble, and to translate your challenges into layman's terms so that they can be readily understood and have a broader appeal and a broader message. Because I think it's easy. Every profession develops its own language. And certainly in the investment business, it's a very arcane language which is not readily understandable, particularly given the complexity of what you're doing and the good work that you're trying to do. But I think it's really incumbent upon you, to Ken's point, is to start to build that positive communication and really use the messages to be really clear with people about what it is you're trying to accomplish in the interests of the beneficiaries.
Thank you.
Thank you.
It means a lot, and the work you all have done, it meant a lot. And I, for one, am going to do everything I can to take everything you've said to heart, not just at the end, but throughout it, all of your recommendations. And I think the commission as a whole shares a lot of that. That we'll obviously there'll be some nitty-gritty details that we may disagree about or take other action on, but your recommendations are reasonable, they're well-founded, well-researched, and extremely valuable to us, and I want to thank you for it. We're a little bit behind schedule. We're going to break for lunch now. I understand lunch is here. We will reconvene at 12:40.
On behalf of our team, thank you very much.
Thank you.
Thank you.
Commissioners back, so we'll crank back up in about a minute. Let me know when you get reconnected. It's 12:15, so I'll call on our Chief Investment Officer for a report and overview.
Thank you, Mr. Chairman. I've gotten so used to other people speaking that I'm getting my mind engaged today. And great news. We actually have 3 people who have passed the KAYA exams, all through level 2, so they are now part of the KAYA, and the KAYA stands for the Chartered Alternative Investment Analyst. So it's a series of 3 exams focused on alternatives. So we have 3 more staff members now. That's Justin Young, J.P. Boyd, and Adam Jordan. So congratulations to them. So today we'll start with a performance update, very brief. These numbers are as of February 28th, so once we get the quarterly numbers in, the official report in, we'll go into a lot deeper dive in the June meeting. Just a quick update on the markets. No surprise to a lot of people, the equity markets continue to be very positive for the fiscal year to date. Other asset classes, hedge funds, commodities are about the middle tier in the high single-digit return area, and then the bonds tend to be in the lower single-digit, but everything's positive market-wise so far today. We continue to see mixed news with respect to economic growth, but it continues to be going forward as opposed to backwards, which is good news, and we continue to see the Fed tapering. From a performance perspective, the fiscal year to date, as of February, we're up 10.5% versus the policy benchmark of 10, so 51 basis points ahead. The cumulative net payout, so you'll remember that the contributions coming in from employers and employees versus the distributions or of benefit obligations going out, there's a difference there, and it's to the negative. So on a yearly basis, we've had approximately $1 billion from the trust fund to cover that difference. Fiscal year to date, we're at $692 million. From a diversification standpoint, some of the things, I'll give you a quick update. Here's the snapshot, and I believe Mr. Phillips, when I was out last meeting, actually had updated the commissioners with respect to the transition. And if we roll this to the 3/31 date, the forecast is that we would be in complete compliance with all the guidelines and parameters that were approved for this current year's fiscal year to date, so that transition has been done. What that really means is that we had a hedge fund target at a total plan level cap at 15%, and we're going to be well south of that at about 12%. Just to give you an update on a couple of things that we've actually done since this report. Sorry. I want to update you on a couple of rebalancing decisions and tactical decisions that we've actually implemented. And this really comes from the fact that we've been able to add several research staff members, taking a deep dive at the markets from a fundamental and quantitative perspective. Within the public global equities, we have a small cap bias because we have 3 active managers in that category. We actually made the decision over the past couple of weeks to reduce that beta exposure. So we did not reduce the physical funding of the managers, but through the synthetic market, we took out $300 million of beta exposure, which has worked out well. We've reallocated on a cash basis as we've had some of the hedge fund redemptions come in, approximately $100 million to the large cap space as well as to the non-U.S. developed markets, so to get that in a little bit better balance. You see the rolled up number here, but if we broke those out, that's where you'd start seeing some of those changes occur. We also have had the emerging markets debt. Not sure if there's the pointer aspect here. Right here, you see we're 1% under, I'm sorry, emerging markets debt is almost 2% underweight. We have implemented that through 2 active managers as well as the synthetics. We have a swap that was rolling, and the cost of rolling that swap was approximately 90 basis points. We've elected to do a physicals funding through Russell at 12 basis points. So that ability to be able to use Russell for those basket trades like that on a passive basis, in this scenario, you're talking about close to $300 million for that transaction or that market exposure. That difference is somewhere around $2.1 million of just savings by being able to have a more efficient implementation. So the contributors, we have around $6.5 billion of notional with Russell at this point in time. No surprise here, the equity markets continue to be the top contributor. The private equity is doing well as also, and then you'll see the other asset classes there. So I won't spend a whole lot of time there, but that gives you the breakdown. The light green box shows the contribution from the Russell Overlay Program, and then the dark green is the actual physical funding. This is a fiscal year to date to show these composite categories for the asset classes relative to their benchmark. So you'll see that the plan, the very far left here, is up again about 50 basis points relative to the policy benchmark Private debt, we're able to garner a lot higher spread at this point in time relative to the index. Real estate has turned and it's coming back very positive for us. Hedge funds, the low beta component, we're outperforming that benchmark. We've been doing a lot of work, again, consolidating that book and taking out some of the more directional managers. And so this is getting to be much more absolute return nature, if you will, or low beta, more market neutral perspective. Over to the far right, this number here I would expect to improve on private equity. We're starting to see a lot more realizations, which I think will catch up, so the accounting will catch up there. We have had a significant realization for one of our larger co-investment positions. So we have taken basically our cost basis back out, and that was just closed this past week. So with respect to, we basically have the profits still in the market. We anticipate an IPO in probably 12 months to fully realize the rest of that value. It's estimated we will make between 3 to 4 times our money on that trade. So, okay, that's the footnotes component here. So I'll stop there before we go to the annual plan.
Herschel, one question related to the comment that was made this morning, that to the effect that our benchmarks rank at the bottom of CEM analysis of benchmarks. Do you have any comments about that statement that was made?
So the benchmark itself is going to be a set of passive indices that are going to be weighted according to the asset allocation that gets approved by the commission. So we have a much more defensive posture with 40%, including private equity, in that equity component. Mm-hmm. If you take a look at other pension funds, they typically have something of 55 to 65% in equities. Equities will be the primary driver, especially in this market that we've gone through, especially since the recovery of the financial crisis, that equities have been the asset class of choice with respect to driving return. Keep in mind, they also drive volatility. So the commission, when the allocation was more closer to a 60-40 type mix, looked at that from a risk basis. So that's your capital allocation. The risk coming from that capital allocation, 90-95% of the risk was driven by the equity market. So the commission made a decision to reduce that amount of risk exposure to the equity markets. And we have a more conservative allocation than you would see for other public pension funds. So by nature, when you have this kind of a market, we're going to lag. But we still have plenty of exposure to growth assets to produce and achieve, and we're comfortable at that 7.5, and that's the target, if you will. So we would anticipate that as markets do cycle and do change, that when you do have a significant drawdown in the markets, and it's prolonged, it's not just intermonth, that you will see this the portfolio protect on the downside, and that's key and critical for us because being at 56% funded on a market value basis, 29 plus year amortization right now, we do not want to be in a position of creating a significant drawdown that stretches those out, because that then forces higher and higher contributions by employees and employers. So it's a risk transfer, and that's what we're avoiding, is that risk transfer to the state agencies. And keep in mind, if you have a recessionary event, that's when the tax receipts are going to be hit hard. So there's actually less money in the budget, state budgets, to actually allocate to these agencies. And now if you're asking them at the exact same time to pay in more because of benefit contributions, that's a highly correlated investment strategy with their ability to actually meet those obligations. And so we've been thoughtful with respect to avoiding, or I shouldn't say avoid, trying to reduce that risk transfer for those type of events and get it on a more uncorrelated basis.
Before we get into consideration of the annual investment plan, let me just state this. You know, on March 13, the annual investment plan with our asset allocation suggestions being part of it was presented to us, and I asked all commissioners had an alternative asset allocation plan to submit it on or before April 11. I never received one, and I don't think staff received one or HEK received one. I just want to confirm for the records that no alternative asset allocation plans have been presented to us for review or consideration or working the numbers.
That's correct.
Mr. Chairman, I ask you a question. So is the only way to have an input on the asset allocation plan to give an alternative plan? I mean, would it be possible to talk with staff or other commissioners or ATK and have conversations with them about certain aspects? Or is it just some rule that's written that anybody who has a dissenting idea has to start over and give a brand new plan?
The governance policy says that communications with HEK should occur through the chairman, the chief operating officer, and/or the chief investment officer. So, in answer to your question, it is possible to have input into an alternate asset allocation plan without presenting an entirely different plan.
Thank you very much.
But it's not, there's a way to do it. Okay, take it away. Who's going to start, Suzanne or Herschel?
I'll start.
Herschel, okay.
And what we have today is the annual investment plan, and the requirement by statute is that staff provide this to the commission no later than April 1st of each fiscal year, and that it's approved by the commission no later than April 1st of each fiscal year. So the commissioners have had this presented at the last meeting for them. We have received some comments from Treasurer Loftus, and we'll get to those in just a moment. The first document here, first version that we have, is a cumulative set of changes coming from some staff members, from legal, from the planning committee, and just some of those thoughts with respect to some of the key strategic areas. And I apologize, it's very difficult to read on the screen. But we have made some red line changes, and you'll see the multiple colors. One of the key critical things I think actually helps clarify is in this blue area here is actually an addition from legal, and it clarifies that the parts of the AIP and SIOP can be picked up in one or the other, so you don't have to be redundant and repetitive. So what we've tried to do over the past couple of years is actually make the SIOP, Standard Investment and Operation Process or policies, into one document to make it more policy, and to have the actual annual investment plan be focused on the investment plan for that fiscal year. So that's what we've tried to do, and here's the statute. I think it'll help clarify that and make this a little stronger document. As we move down the page a little bit, you'll see the red, those were all the previous comments, and the document itself, because it's an annual plan, it pretty much completely changed. And then you have some of the yellowish gold comments, and those are some of the revisions in red line. Some of these are actually added in. So for instance, develop the statement of investment beliefs to become part of the AIP. Actually, that should be corrected. It should be part of the SIOP once adopted. So that's in there. The risk management systems, there was some clarification of language there. With the administrator, the private market system will be picked up there, so that should be in place fairly shortly as well. The accounting and administrative functions for reporting, that's all very consistent with the things that we've heard from Funston and the Planning Committee. The trade order management system, that will support the existing internally managed portfolios today. The risk systems, that's something that we continue to work on in addition to the creation of the enterprise risk management function. The dedicated human resources function, which Funston spoke about earlier today as well. So we wanted to be able to pick up some of those recommendations earlier rather than later and keep them out in front of the commission. So what you'll recognize is some of these are not purely investment related, but operations related with respect to supporting the entire organization. So we think that having them in here and documented actually still makes sense, even though there is a slight nuance of more operational support components of it, if you will, reporting versus pure investments. So the strategic partnerships, we'll continue to work on those and look for more efficient structures and how we can have more control over those as well. James could just scroll down a little bit more. So one of the things that we felt was very important is that the internal research function is critical. If you're an investment management organization, that growing that out is always going to be critical because that's the key driver and inputs for how you're making decisions. What we have taken out, though, is that expanding internal management today. And so what we'd like to do, and to let you know, is that I expect that to come back in next year. And that's on the basis that we expect to have a more robust operational infrastructure in place. So we're taking that out for this current year. So the staff, we'll take a look and make sure we get that there. The next section here, there was a comment from the treasurer under strategic partnerships where there's the word several. And at one point in time, there were actually 14 approved. We're down to 9 right now, so we can change that term if you'd like. But we haven't changed it in this document, although I did want to point out the treasurer did make the comment to be more numeric specific, but that in itself will change throughout the year. Some of the other components here is that this is an area that I would highly recommend we maybe revisit in June. And it's blending in a little bit of a policy here with a plan. And that is really defining HEK's role within strategic partnerships and the prudence memo. And if you think about that, that's not necessarily an investment plan item. That's really more policy. So I'd anticipate taking some of that language and actually moving it to the SIOP. But I think it's very, very important for the commission to work their way through that and what that really means, and understand what that fiduciary responsibility would be from Hewitt as well. There are some other questions that we received. There are some other just cleanup language changes throughout the document. One question that we did receive from the treasurer was, are these allocations, so capital allocations, when we quote the percentage that we have versus exposures, and their capital allocations? And then you probably picked up that there was some softer language in there that will state that we will review the asset category or asset class. And what we're really saying there is that we anticipate doing manager searches for those categories. And so those are really the comments, and you have some additional just kind of cleanup language in here, defining some of the benchmarks a little more clear. So those were really the comments that I had, and I'll be happy to answer any questions.
I guess one of my big questions, both in light of sort of what Funkston was saying about us backing up to think on an asset allocation level, is, can you go back over an area like commodities, right, where there's a lot of variation in implementation from something that reads very much more like a private equity implementation versus CTAs, which is historically how people generated returns. How's that being modeled? Because the implementation decision, I think, because there's such wide variety, right, and the dispersion of outcomes can be so wide that in essence there's a big basis risk if we're thinking of this from just an asset allocation space versus implementation space. For us as a commission, how do we kind of review that okay, they have this commodity plan, it's in the AIP, but it's the way this is written, it's a specific sort of direction within that commodity plan. I'm just trying to think, if we're trying to take a step back, but there's an area that has such wide potential dispersion where I really think implementation can overwhelm the allocation, right? Because there's such wide underlying dispersion and outcomes.
So there's an interesting discussion as to what you can and can't model. And when you get into illiquid asset classes, when you get into asset classes that lack homogeneity, it starts to be a problem. So you can think of something like hedge funds. What's a hedge fund? I could show you 12 different programs, and they could range from very, very conservative with no beta to uber aggressive with amped up leveraged beta in several asset classes. So we all know that you've got that problem with modeling. So you can try and adjust the model to fit all the different iterations, and honestly you start to get in, garbage out. So what we try to do is make reasonable assumptions for the typical behavior of an asset class, and then as we're working with a client on implementation, to make sure that the various levels of implementation aren't all leaning in the same direction. So illiquidity, for example, are we making sure that we're looking at the overall liquidity of the program some other way to catch the implementation elements there? Risk, if we're risking up real estate a little bit more than the assumptions would indicate? Are we making commensurate decreases in other areas that kind of balance each other out? So there's a little bit of subjectivity in, are these aligning perfectly with our asset class assumptions, to make sure that we're not leaning all one direction and starting to put other forms of risk in it that we haven't modeled. So my short answer is you can't really model those things as precisely as we would ideally like to. But we have other ways of trying to capture those qualities to make sure that you're not amping things up. We are going to be looking at liquidity, our liquidity model probably in the next meeting or two, just depending on timelines, but allowing you to kind of see worst case scenarios. What if we have a very locked up market? What sort of illiquidity might you have? Things like that. Just to kind of look at some of these challenges from different angles, and that would take into account the way in which you're implementing it rather than some blanket assumptions about an asset class. So is that getting at your issue, or did I dance around it?
Yeah, I mean, I'm trying to think through it just, both from a reporting, from an oversight, standpoint, because, I mean, this is something we saw with D.E. Shaw, right? They were doing real estate, they were trying to shorten liquid markets and be long in illiquid markets, and they've since shut down the program, right?
So one thing we've done as well is when we went back to redefine low volatility, low beta hedge funds, is we actually found the commodity trading hedge funds that had been in commodities actually fit that profile. So they were actually reallocated back to low hedge fund bucket, if you will. And so here, for the commodities perspective, we've thought about it from two perspectives, keeping more of a pure beta. So we've gone from the traditional swap to more enhanced yield swap, so you're kind of minimizing that roll yield, and you're still getting hit with it, but it's not as bad. And then also the thought process would be, well, can you become a little bit more in the physical space, if you will, more of a merchant model, and be able to take possession, actually hold the physicals, and then trade around those. And so we've had some discussions with several managers who could implement that kind of a strategy, but we're not there yet. But that's kind of where that commodity, so you're right, it does have that more liquid beta with a private equity feel to it.
Again, just trying to think through it, because I think in this space, like, that gets back to the value of having stated investment beliefs, right, of why you're doing something, because when you start looking at an ERM report, you're testing your assumptions, right, and you might be going out of your assumptions and different things, and if that's the level at which we're, as a commission, board level, supposed to be setting, right? I'm just, I'm trying to think through, all right, here's the report I get back on commodities, which y'all might have modeled as an index, that's fine, right? But everything we're doing is going to be in violation from the very first thing you do, so it's not a very good model to start with, right? So I need to, we just have to know what those are all the way through to carry them through from the level y'all modeled them to the way they implement to the way we report on the risk stuff, and but I think too it starts with that statement of investment belief. So how do we believe commodities really behave? What's the best way to express that?
Asset class plans.
Yeah. So that's part of the June retreat.
Right.
And we haven't done it in, I guess, a few years, but at one point in time when we had that retreat, we would actually go through and have the asset class plans in a lot more detail.
Right.
And that's a little bit also why we've left these a little bit more generic.
Right.
Because once we get to a deeper detail, I could see that then becoming an amendment to this.
Well, and that's kind of what struck me when I read the commodities one. It seemed a little
very, very high level. And our plan would be in June. We can actually walk through the asset class plans and get very, very specific.
Right.
And then once those get approved, it's almost the chicken and egg, as we're getting these recommendations from Funston and wanting to do the strategic retreat and go deeper and deeper and deeper, and trying to marry that up from a timing perspective. I fully anticipate as those plans get approved by the commission that they become the amendment to this document.
Any other questions?
Would they be an amendment or just an addendum?
Or, should say.
Appendix, attachment as an appendix or something?
Yeah, because we can revise this at any point in time.
Right.
You envision doing that in June or just after June?
I would like to do it in June.
Okay.
We'll see how far we can get. But this document is up for approval today, so it would require a vote.
Do I hear a motion that we approve the AIP as presented by the CIO, which is an amended version of the March 13th.
So moved.
Excuse me, I'm a little bit lost, I apologize. Are we about to vote on the entire AIP?
We're getting ready to, we've had a motion, I'm looking for a second, which I now have.
Second.
And now the floor is open for discussion. And the motion as made, the motion that's up for discussion is to approve the annual investment plan as presented by the CIO, which includes amendments since his initial presentation of March 13th.
I just have kind of a clarification. Herschel tried to help us out, but I'm not sure I understand. In the document that we're looking at, it's got all these colors in it. Is everything that's not stricken out okay, regardless of the color?
Correct. Correct. And the color coding is to let you know when the change occurred, basically.
And who?
The yellow, as I understand, is the most recent round of changes, and the blue are changes from our earlier AIP.
Yes, sir.
Correct? Okay.
I'm certainly pleased that among my present maladies, being colorblind is not one. Yeah, I thought the document changed, a fair amount, and while not all of my changes made it in there, I appreciate y'all doing those. Herschel, would you be able to clarify just a little bit more, because we've had several good and forthright conversations about HEK and their role in strategic partnerships, but I'm a little bit confused because of the changes back and forth. And could you link these conversations over the last 6 months up with what we finally ended up in the document here?
I think I heard you say to link that back to the conversations. I think that was part of my earlier comments with respect to the discussion in the AIP with respect to the strategic partnerships, and especially Hewitt's role, is much more policy-oriented. And I would encourage the commission to take that back up, and that once we finalize more of a policy with respect to what that is, that actually becomes part of the SIOP and not the AIP. And so the key part here would be that the investment commission has delegated to the CIO the ability to make the investment decisions in conjunction with the strategic partners, going through our policies internally to approve the underlying investments within the partnerships. Hewitt's current role will be to provide a prudence memo for those underlying investments.
When they're asked. That's what I'm confused about. The language in here about like as needed or those types of things, and I'm just not clear because it says input to the IIC as needed, so that requires that someone would ask.
The as needed is not in there anymore.
Is it a blanket thing, or is it going to be a certain class of maybe follow-on investments that's just so pro forma that you don't need it, or that's what I'd like to have some clarification.
Yeah, there's two different things going on here. There's the language that says, excuse me, that the investment consultant will be informed of the investment decisions within each strategic partnership, serve as an input to the IIC as needed. So that's the internal investment committee. So as we continue to debate and go through the due diligence process, if we're at a point that we believe we need some additional help here, we will reach out to HEK. Then, so now we're moving away from that. Then the other part here is Hewitt will provide a prudence memo to the commission for proposed investments.
Gotcha. Very clear, as you have said and written, but I just want to make sure. Thank you.
Okay. Is there any other questions?
All in favor, signify by saying aye.
Aye.
All opposed by like sign.
Nay.
Record one nay.
Sure.
Oh, I failed to mention, I should have, just because audit is later. Audit did, I'll go ahead and jump in, because it's specifically why we met before was to do audit on prior year AIP compliance. Is Monica still here? You want to comment real quick?
Pretty much, we didn't have any significant findings that would impact the changes that were just proposed to the committee. We did have some recommendations that I think we could go over later, but nothing that would impact what you guys just voted on.
Okay. Moving to the next item is the PENN short duration. And last meeting, I wasn't here, but as I recall, there was the approval for the contract extension for some of the fixed income managers. With Penn, they actually manage two high yield strategies for us. One is a limited or short duration strategy, and the other is a more normal term high yield strategy. Both strategies are governed under one investment management agreement, and what we're asking for here is to actually segregate those into their own individual IMAs, or investment management agreements. And then also what we'd like to do is extend the contract for the short duration, Penn short duration strategy by 2.5 years in order to have a termination date, if you will, for both accounts so that they would be on the same renewal cycle.
Any change, like breakpoint fees, do they do that on a firm level versus product level, or?
So we do have a revised fee schedule presented in, I think it's page 2.
Yeah, 82. Very good.
So they're right there in the middle. So the current fee structure is 52 flat for the opportunistic, or the normal term, if you will, high yield. And so the revised fee schedule will be on that decremental fee schedule. And you can see the first break point is actually lower than our current flat fee. And then for the short duration high yield, it's currently 40 flat. And then the revised would start at 40 and then go down with more and more assets that we put there.
Particular note of interest, when we came in with the original last month, Penn had originally cut it from 55 to 52 on their opportunistic. Since then, when we started to go through the contract, we went back to them and said, hey, can you do more of an enterprise type fee relationship? And they come back with this right here. So this is an additional fee reduction from what was approved in March.
How much do we have in each of the products, right? Because, I mean, if you're rebalancing, would we ever potentially, unintentionally, fall below one of the breaks?
We could definitely fall below those breaks because they're at 0 to 100 and 0 to 150. Currently, correct me if I'm wrong, Mike, but both accounts would be in excess of the first break point. And we have a recommendation later that would actually add more assets to this manager and stay with the compliance with the SIOP with manager level allocations as well. But I would anticipate that we may be exceeding, or we'd be at the top or the lowest break point.
In both products?
In both products.
To be clear, this is an improvement, as Mike indicated, over what we approved last meeting from a fee perspective, and kudos to Mike on getting that done.
I just didn't know if y'all wind up rebalancing between them, right? You could wind up kicking the fee up when, they really have the same amount of money from us, right?
Right. There is that possibility if you, really start scaling back. Mm-hmm. But the top tier at 200 and then 230, right. With the allocations we have today, the limited number of managers in that space, it's probably not a high likelihood.
Right.
So this would require a vote as well to move to the separate IMA for the short duration and then to extend this contract for another 2.5 years.
On our written motion sheet, that would
Page
be...
Page 2, second item.
Page 2, the second black bullet. Do I hear a motion to the effect that we adopt this recommendation?
So moved.
Do we have a second?
Second.
I have a second. Any further discussion? All in favor signify by saying aye.
Aye.
All opposed
Aye.
by like sign. It's unanimous.
Unanimous.
Mr. Chairman, those conclude my remarks until a little later.
Okay.
It's time for committee reports. I'll turn over to Commissioner Gunlingson, who's the chairman of the Ad Hoc Planning Committee.
So the ad hoc planning committee was formed in response to the 124 recommendations from the Funston fiduciary audit. And Commissioner Wilder and Commissioner Williams are also on the committee. And we have met a couple of times, primarily to establish a set of overall high-level priorities and strategic goals coming out of the recommendation, and then secondly, to start acting on some of those that we thought we could rather quickly get in place and help move towards achieving those strategic goals. So in terms of, we've come up with a list of 10 high-level priorities coming out of the Funston review, and we did this by, one, going through the 124 recommendations, and two, trying to find commonalities that existed with the 5 pervasive themes that Funston outlined in their report, and with the high-level strategic priorities that all of the commissioners had previously filled out in a survey and was presented to us at the last meeting. And in doing that, that's how we came up with these 10. So I was going to go through the 10, and at any time just stop and please let me know if you have any questions about it. But then after I go through the 10, there are 4 of those which we actually had action items on to go through today, and I would spend a little more time in detail, and maybe some other people as well spend some time in detail on those particular recommendations. So first, and I think maybe one of the most important ones that Funston recommended was shift the commission emphasis to providing oversight and strategic guidance. And that is one of the ones that has action items, and we will go into a number of the things that we're doing with that in just a bit. Second was develop the human resources functionality. And I say that we have these 10. They're not necessarily in priority order, so we can shift those around at a later time. But there's sort of 10 high level. So second, develop the human resources functionality. It also is one of the ones with the action items, and I'll go into a little more detail on that in a second. Third, clarify and redefine the purpose, policies, and procedures of the IIC. Now, we don't actually have action items on that, but again, it is one of the high-level points that Funston made. 4, build the infrastructure before expanding in the internal trading program, including the third-party administrator implementation, operational policy development, and business case for expanded internal trading. And I think actually Herschel touched on that a little bit earlier in the AIP. Number 5, build out the investment risk management function, including systems, integration with the IIC, policies, procedures, and plans. 6 was develop and integrate the legal investment function. We have one task item coming out of that. There's a lot more to do, but we have one that we will talk about a little bit further. 7, redefine and implement a communications plan, including improving stakeholder interaction and leading industry-wide initiatives. 8, appoint an executive director who's accountable to the commission for managing the entire organization. 9, build out IT functionality, including personnel and strategic plan. And 10, continue to develop the enterprise risk management function, which I think Alan will talk about a little bit later in his committee report. So again, those are the 10 high-level strategic goals. If anyone has a question, please just jump in any old time. But so like I said, there are 4 of them which we have action items for today. And first, shifting the commission emphasis to providing oversight. One of the major recommendations was developing a statement of investment principles. And actually, Reynolds has been the one that's kind of taken the lead on this, and I was going to turn it over to you to go through that if you would like to.
Thank you. I guess the important part of this is, we from our inception, relatively soon thereafter, we adopted a mission statement, and we've had SIOPs and AIPs ever since then. But modern practice, according to Funston, is we also set out what our investment beliefs are and what the guiding principles of our investment philosophy is. And this is
this is a significant document because it's going to guide the investment staff and all staff's decisions on culture, people, structure, process, strategies, and therefore our end results. So in summary, in conjunction with our statutorily assigned duties, these investment principles are going to guide very much of the Commission's conduct as we transition into this more of an oversight role than a managerial role that they have recommended. Since this is such an important document, what we wanted to do was to, the Planning Committee has recommended it for approval to the Commission, but we don't want to vote today. We want to distribute it and have you all get your comments, suggestions, changes, items to add back to Herschel no later than May 15th, 2 weeks from today. It will become, we will be asking that a statement of investment beliefs and principles be adopted at the June meeting. But the time to get it revised and corrections and get your comments reduced to writing will be between now and May 15th first, and then obviously there'll be a lot of massaging and discussion between May the 15th and then. I heard Funston this morning, we gave this to them yesterday since we adopted it when? Yesterday?
2 days ago.
2 days ago.
Or maybe, no, yeah, it was 2 days ago.
So we gave it to the Funston people yesterday, and they made a couple of comments, and I hope somebody took good enough notes to make sure that Herschel gets those at least on the table for consideration. I did not make notes, so I sort of remember them. But anyway, that's it. Here they are. We'd be glad to answer any questions about them now. But I really think the important thing is that we digest them, make sure we understand what they are, and make sure that we're willing to take these principles and let that be a guideline as we make a decision 6 months or a year from now, or whenever. As long as these principles are in effect, we need to guide our conduct by them. And Funston made a good recommendation to me yesterday when they were explaining the importance of a document like this. Part of our ongoing oversight should be to always test your assumptions and test your principles against how they perform in actual conduct. They gave me some hypothetical examples, but I'm just going to pick number 8 there. It says a policy of open engagement is the best approach for constructive dialogue with broader stakeholders and interested parties. That sounds incontrovertible to me, but it might not even be true. So test to see if your assumptions are right. And see what would happen if you're wrong about that assumption, and how would that guide your conduct, and what the damaging results would be. The example they gave me is, they said, what if some people put in their statement of investment principles is that private markets will never be correlated, will ordinarily not be correlated with public markets. Well, every now and then, see if that may not be true. The environment may have changed, and all of a sudden private markets can be highly correlated, and you're just wasting a lot of effort to try and get uncorrelated in that particular way. So anyway, as you think through this, that's the kind of thing I think is important. That's all.
So we do have a motion on the list for this particularly, which, do you want to read that, Reynolds? Or do you?
Well, let me just refer everybody to page 2 of this item 1. And it's the motion is that we accept the draft, provide feedback to staff by May 15th, and include approval of it on the agenda for the June meeting. And that's a committee motion, so it doesn't require a second. So
okay. Oh.
Is there any further discussion?
Yes, sir. Okay, we accept the draft, and it will be on the motion in May. I don't know the motion in May. What will the motion be then? I mean,
the motion at that time presumably will be, there will have been some massaging of these investment principles, and the motion.
The principle. Okay,
and the motion at June will be to adopt whatever the end product is after the massaging and the voting
Do
on
we,
amendments.
do we need to vote to accept it? I mean, have we already accepted it? It's been given to us and accepted? What's the point of a vote?
It doesn't do any harm. And it helps the commission be involved in the setting of the agenda for the June meeting.
Well, I don't want to belabor the point, but what happens is it locks folks in. You got to accept them or not, and I think we all like the work that's been done, and if we accept them just because we feel like we have to as an extra step, I think it's a step that could cause problems later on.
Specify, please. What kind of problem?
Well, I mean, I'm just thinking through it. I mean, I guess if we take it because it's from the committee and doesn't need a second, right? Then May 5th, or whenever we get back together, I guess the motion would have to be to amend the prior motion, right? Because there's a
The motion in June,
right? Which is this document, right?
The motion in June will have a statement of investment principles attached to it, and part of the motion will, by the planning committee at that point, will readdress all of this, would be to adopt the new one, as revised.
This is just a draft.
So the adoption of this is not on the agenda at this point, consideration of the.
Whatever the new product is.
Yeah. Any further discussion? All in favor, signify by saying aye.
Aye.
All opposed by like sign?
No.
I'll abstain because I'm a little confused. I hadn't seen a lot of this and just think through the motions.
Okay.
I was up late.
Ayes have it.
Okay. The next item under the, again, still under the priority of shifting the commission emphasis to providing oversight and strategic guidance has to do, there are actually updates to Governance Policy 4, and these cover a couple of recommendations. One of them has to do with eliminating the practice of commissioner participation in investment manager due diligence. And it's not, so there are some areas in here where it actually eliminates the requirement that due diligence be performed by commissioners, but it also has verbiage in here which includes the, commissioner involvement in due diligence for educational purposes. And I think we say to occur within at least the first 2 years of beginning the term with as a commissioner, just because those are actually very valuable learning tools. And it does not preclude any other involvement in due diligence, just the mandatory requirement that the commissioner actually has to perform the due diligence or be part of the team. And the other component of this is that it formalizes, well, it also discontinues the informal use of the asset class assignments, although I don't think that was ever.
It wasn't
That wasn't captured in the governance policy. That just was an informal policy that took place, but since it wasn't ever written, it was informal, but we just recommend discontinuing that practice. And then the third thing it does is it formalizes the agenda setting process that's already in place, again, as recommended by Funston. And right now, informally, if 2 commissioners wanted something on the agenda, it would get put on the agenda, and typically one commissioner would just simply let the chairman know, and the chairman has been serving as the second commissioner approving that item being put on the agenda. So, but anyway, this actually formalizes that that scenario and puts it in the governance policies. So there is actually a motion that...
There's actually 2 different motions on that. Print the sheet, Rebecca. Roman numeral 2 would relate to the due diligence question. Roman numeral 3 would relate to the agenda setting question.
I see.
So let's take them up separately.
Do we anticipate anybody having an issue with any of them?
Well, does the committee want to move that we take them up together?
Well, I mean, since
I think we ought to take them up separate, just because, again, I've been on the road, so I haven't fully, read all the document changes. I'm trying to read through them here, but I think it's better to take them one at a time.
Okay.
Well, let's do it that way.
So is there a motion that the commission adopt the planning committee's recommendation that we eliminate the practice of commissioner participation in investment manager due diligence and discontinue the use of asset class assignments for commissioners?
You're making that motion, so it doesn't require a second, so any
So
further
I am
discussion on
making a
that?
motion.
The committee's making a motion.
That's the committee motion.
Yeah.
Now, is that a change in the document somewhere?
Yes,
Yeah,
it
it's,
is.
um,
Point to it, please.
I can.
It's
governance policy 4.
Red page number 90, I think it is.
90?
89 and 90.
It's in section D, education, and then part 1, it actually crosses out the may perform due diligence regarding issues such as investment manager selection and custodial bank selection. And then further down, under part 2, I guess bullet point D, it adds the component of, for educational purposes, new commissioners are required to participate in due diligence alongside staff within the first 2 years of the commissioner. And again,
Rebecca, may I ask a quick question?
Sure,
I think
yeah.
Winston answered this morning, but is it your understanding that this would include the strategy type commissioner assignments such as strategic partnerships?
yes, and that was never formalized in the governance policies, but it's an informal practice, so there's actually no changes to the governance policies required for that. However, we do recommend as a part of this that we no longer adopt that informal process of asset class or strategy assignments.
Thank you very much.
Can we touch on one other? Because I was just at CRT board meeting, right? That's not a manager due diligence, but I am serving on that board.
It's a board. That's
Huh?
different.
That's different, that's a different
Totally
item,
different.
right?
Right, yes.
Yeah.
Yeah, from time to time, commissioners or other people may be designated as the commission's board member on various investments, but this one has
Different.
nothing to do with that.
Is there any further questions on this?
All in favor, signify by saying aye.
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 All opposed, like sign. Ayes have it.
Was there any no vote or abstentions? No?
No.
Okay.
I'm sorry, I was an aye.
You're an aye. Okay. Unanimous.
No, he was.
No, he was a nay?
No, he said he was an aye.
He said he was an aye.
Oh,
no.
an aye.
An aye.
I thought he said a nine.
An aye for a
Aye for an aye.
Okay, the next motion from the committee is to adopt the planning committee's recommendations to amend governance policy 4 as presented, performing changes to other commission policies and procedures, so on and so forth. But effectively, that was the one regarding formalizing the agenda setting process. You will find this in governance policy, section G, rules of order, and number 3, agenda items and procedures. And it encompasses bullet points C, D, and E.
Page 92.
And if I could add to that, this was recommended by the Governance Policy Ad Hoc Committee back in February, but there was some confusion about whether it would eliminate items from being added. And so we ran this by Funston and others, and actually feel like it's more clear if we do add this language back.
Any questions?
Yeah, I'd like to go ahead and just renew my objections last year, as I had last year. Much of the information from meetings is not received until less than 3 days before the meeting. And that makes much of this problematic. Also, I think, I renew that I'm just unable to get things on the agenda, and so this doesn't help that situation at all as well.
Any further discussion?
Well, we don't have a motion to discuss it, but.
Oh, I'm sorry, I thought I was just made the motion. It's the committee
Okay.
motion.
Yeah, the
right?
committee, it's the committee
All right.
motion, so you can
Yeah.
discuss it on.
Yeah, I mean, I think there's I find remembering the 3 days and the written requirement and all that very difficult. I think a better process would be for us to have a scheduled conference call 2 days before. We can meet all the FOIA things. You can set the agenda in 10 minutes on a conference call. It'd be on everybody's calendar. It's a much easier process to manage.
Would you
You know,
notice-
so I'm going to wind up voting against this just because I don't think this is a good practical implementation. Right.
You would probably have to provide notice of
A
a public
separate
meeting
meeting.
in order to
Right,
have a public.
but just like we have our scheduled meeting, you can post a conference call meeting, set the agenda, and have a FOIA requirement that that's the purpose of the meeting. Right?
Well,
I
let
mean,
me
so
ask-
you wind up with a four-day
right now-
process.
right now
You get a
we're-
FOIA, a meeting, a FOIA, and then a meeting.
So right now, we're informally doing what's set forth in, I guess, in writing for right here. I mean, are anybody has anybody had something they wanted on the agenda that has not made it to the agenda? I mean, I've
There's never been a time when two people have wanted something on the agenda that hasn't made it.
Well, we have it in, what you said at the meeting the other day. I got it in writing at the office, where it's transcribed by two different people. You were usually the second person. Someone calls you, that's one person, and you're the second. And you never allowed me to have the simplest agenda item. And we don't want to belabor the point.
Wait just a minute, all you got to do is get some other person.
Well,
all you have to do.
this last time, Mr. Gillespie and I were talking to you about rearranging the schedule. You shut that down. I mean, it's just
different.
I don't, look, there's no sense in disharmony. I'll vote against it. The other four are going to vote for it. So we just don't need to waste our time here. But it's just impossible for me to get anything on. When I have had a second, you didn't do it. So I'm not going to waste my time and somebody else's time to do the same thing over and over and over.
I won't be chairman much longer, and it's not impossible to get something on. All you have to, if the chairman himself doesn't think it's a good agenda item, all you have to do is convince any one other commissioner. That's it, period. So anyway, obviously I'm in favor of this because it conforms to existing practice.
I'm a no. I think it's a better process we could lay out.
And Alan, you're suggesting again a conference call?
I just think, like, normally, right, the thing that has made this clunky, right, is the FOIA requirement, because our agenda has to be posted 24 hours in advance. Whereas other boards, right, you go in, there's a proposed agenda, and you amend it right at the beginning of a meeting, right? I mean, you take 5 minutes and you reorder, or, where you don't have these FOIA requirements. My suggestion would be you have a standing meeting, 48 hours before, whose sole purpose is to set the agenda for the meeting 2 days later. You can FOIA post that, right? Say it's Monday, right? You have a conference call on Tuesday. You FOIA post the agenda on Wednesday, and you meet on Thursday, right? And it makes it a much more conversational thing versus in writing, in email, phone calls. I mean, that's clunky.
I'm on a lot of different boards and commissions, and this is the only organization that operates this way. And underlying this whole problem, I think, in addition to what Mr. Gillespie just said, is the fact that we get large sums of information at the last minute. It's just unheard of anywhere else in state government, but it happens here constantly. So there's this flurry of activity, and then we're asked to make votes, and I suppose everybody's read every page of all this, and they're comfortable with it, and over the last 24 hours. But we were still getting information when we got back in the office this morning, and we didn't leave last night till 8 or 9 o'clock, whatever it was. So it's just a bad situation. I don't think it's the proper way to handle it. And as far as I know, we're the only group in state government, or any group I've ever been involved with, that did it this way.
Any further discussion?
Well, apropos Alan's suggestion, does this present any mechanical problems or difficulties, or is this something that, I don't know, how does everybody else feel about it?
I think, just for me, from staff perspective, if you are going to go to a conference call, we probably need it further out than 2 days ahead of time.
Yeah.
Because there's materials and everything else that has to be posted. So, there's just that practical part of it.
To ensure, and I've heard persons speak eloquently about this. Bob spoke about it. The previous chairman spoke about this issue of being unable to get the information to the commissioners at a time when the average commissioner can manage it. I'm amazed that the other commissioners are able to go through each stage of these documents in the short amount of time. It amazes me, and that must have nothing. And then let's devote 100% of 2, 3, 4 days to go through it. It's a massive amount of information, and for us to be able to go through it is almost impossible. And this, of course, belies the fact that, or goes back to the funding idea that we should have monthly meetings that are regularly scheduled so we can spread the work out on a regular basis. I think would be much easier on staff.
Yeah, I mean, to your point, I mean, that, the goal's always been a week in advance. I mean, my timeline only shortens that by 24 hours, right? I mean, you know, push it back a week. I'll do the conference call a week in advance. I'll do it a month in advance. I mean, I don't, you know, that, my point is a conference call is a hell of a lot easier than this, right? 3 days written notice, I got to call and get somebody else on the phone, right?
Well, I'm not sure that that would be easier than this, just from the amount of resources that would
Anything easier than just getting.
just sending an
If the
email.
chairman, if Ed won't agree to it, just get somebody else to agree to it, and then he can call the chairman, so please put it on the agenda.
Yeah, but if he says no, then I got to dial the next one. He says no, got to dial the next one. I got
The
five
likelihood of
phone
that's
calls, right?
so unlikely, why do we need this clunky?
Well, that's-
conference
yeah,
call?
That's my point. Why do we need this clunky written 3-day process? Right?
Well, because Funston recommended that.
They didn't recommend a 3-day specific written request. They said we needed a procedure to set an agenda.
They said
That's
that,
what they
though,
said.
They said that they would formalize the current informal process.
By meeting more
that we-
frequently. They also suggested bi-monthly meetings.
No, you're right.
Okay,
Right?
and
And
I
a conference call.
apologize, you know, as the planning committee,
Right.
there were only, we couldn't get to every single
Right.
recommendation. And in terms of the meetings and how the frequency, we talked about, do we go ahead and make a proposal for that? And I think we had decided, well, you know, that might take a little bit more time, and maybe something we could talk about at the June retreat to see how often we wanted to meet. So I do apologize, Alan, that we didn't get that
Right.
on the,
Yeah,
a
and
motion
I'm not
for
targeted
today.
on that. I mean, some of this goes back to, I mean, candidly, the meeting frequency, that was almost a unilateral decision of the chair. The agenda, I do think, has been an issue. And so I'm a no on this, right? I mean, no offense to the planning commission, right? I would like to send it back to the commission and say, bring back different language.
Okay.
But, I mean,
Yeah, and-
everyone,
and I
we
would-
have a
I
motion
would
that
agree.
everybody can vote on. I'm prepared to vote.
And I would agree, and I would love to see the more frequent meetings, because I think when we're able to distribute the work, and that's got to be a great help for staff to know that, hey, this report's due this date, this is the next date, instead of having this huge and incredible task that the staff has to go through now to make all this happen.
Those are great points, and I think, you know, we will certainly, as the planning committee, make sure that that's one of our priority items for the June meeting, that we make sure we discuss that and come up with a solution for that. I honestly did not realize that this would be a problem. I thought it was very straightforward, that we were already doing this. Funston said, hey, you're already
Just
doing
follow-
this,
just
put it in your
formalize it,
governance policies. I had no idea that people really had a problem with how we set the agenda, or that people had trouble getting stuff on the agenda. I wasn't even, I've never actually tried to ask for anything on the agenda. I've been pretty happy with it. So, you know, I mean, I feel very comfortable, you know, again, because I haven't seen any problems. It's worked well and from an informal standpoint, as far as I know. And Funston said you should formalize the process you're already using. And I don't want to confuse this with the frequencies of the meetings, or because that's a separate issue, and I think that needs to be a separate recommendation, separate motion.
Yeah, as a member of the planning committee, my view is that the intent of the committee was to make the current agenda-setting process more explicit and clearer, with the objective of making it easier for anyone to get an item on the agenda. So our intent was to improve things. And as a planning committee vote, we thought we had with these changes to the governance policy.
And we believe, and we do believe both of you. I mean, there's no doubt about that. We don't. I hadn't talked to Alan about this, but we do appreciate that. But what happens here, if this passes, we pick up the formalized problems, but we don't get any relief with that additional meetings or something. I mean, that may or may not happen in the future.
Well, I
How
can tell
many
you that
meetings
the-
we have is a totally different question.
Yeah,
of how
but
to
the
set
planning
agenda.
committee is you know, fully supportive of implementing all of the Funston recommendations. And again, you know, in terms of the frequency of the meeting, we just didn't have time to address that and really wanted to wait till the retreat in June when there was a little more time to discuss that. But in terms of just getting things on the agenda, that was really all this motion was about.
Yeah, but much of the agenda would be set by what the agenda is. I mean, you know, sometimes we had, well, take for example this morning, securities lending. State Treasurer's Office had no idea that was coming up until this, last Thursday afternoon. So by the time we were able to get some information together, 3 days has passed. So how would we, how would we manage a situation like that? The entity controlling the information has all of the power, and quite frankly, I don't share any of that power. I don't have the ability to get the information in advance so that I can put issues on there. It's just very, very difficult. I won't be quiet, Rebecca, because I respect what you and Dr. Wilder are trying to do, but it is one of those things where the appearance is one thing, but in actuality, when you deal with it, and if you do try to read through all this stuff and go through it, I mean, really seriously take this responsibility and go through these documents, it's a mammoth amount of work. And by the time you get through it, you've missed your 3 days. And again, some of this information, and last night, we got the PowerPoint play on the securities lending last night, I think it was.
But we, as individual commissioners, we'd all been briefed on that.
Yeah, but
I thought Mr. Berg met with you last Thursday in person and briefed you on that.
He met with us Thursday afternoon, and that prompted probably 20 hours worth of work in the
But
Treasurer's
that
office.
wouldn't
to gather
necessarily
other
change the
information.
agenda.
Yeah, that doesn't have any impact on the
That would have no
agenda.
impact on the agenda, because
That's right.
during
They're
the
different
securities
Yeah, but
lending,
my
you would
point
discuss.
is, a phone call is easier than written. I mean, I'll give you an example. I've been on the road since last Thursday, right? I now have to get something in writing, I have to find another commissioner, right? Presumably, I should sign it or an email.
Well, I tell you what-
Unless I can get their dual signature on an email.
I tell you what,
Right,
if you,
Shane,
I
right?
will.
mean, it's just, I'm not saying this is a huge criticism, I don't think it should be. I just think there's a better process out there that, I'd like to send it back to committee and say, come back with a different
Well,
process. But,
Alan,
we have a
this
motion,
really
I'm
doesn't have
prepared
any
to vote.
particular formality to it. It doesn't say they have to simultaneously make the request or anything. It just, I mean, I really don't say anything to be simpler.
Where does it say it has to be, your request has to be in writing? I'm trying to read that.
That's a motion would have to be in writing.
A motion.
A
Oh,
main
the
motion.
motion.
But not an agenda request.
Not an
You
agenda
call the
request doesn't
chairman,
have to be in
say,
writing,
put it on
Right,
there.
but to this point, I mean, we get a lot of information, we get it very late, you're traveling, right? I mean, frequently, I'm not going through the information until 36, 24 hours before a meeting, right? I mean, and then, but I'm past 36, so presumably, I can't even come in here and make a main motion today, right? All I can do is vote on the motions that are already proposed and on the floor. So I've been
And
silent
those
today.
And those of us who aren't allowed to be on committees are one step further removed from that.
We're going to be doing away with
Okay. All in favor of the motion, signify by saying aye.
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 All opposed by like sign.
Nay.
No, so it was
Ayes have it.
4-2.
And, I mean, this brings up a compliance task, right, since the agenda is set, right? How the commissioners who don't vote in favor verifying that, in fact, 2 commissioners have recommended the agenda, right? I mean, now we got an audit problem, right? Yes, Monica? Right?
We could look at that if the
Exactly.
audit committee so chooses to.
Yeah. Put it on audit.
Yes.
Okay, Rebecca, next time.
Well, I hope this next one is less contentious. Okay, the next one is purely informational. Unfortunately, there are no motions coming out of it, at least from
Although
me.
you do have,
That is to further develop the human resources functionality, and just an update that an HR director position has been posted. And some of the other recommendations had to do with expanding the role of the Compensation Committee to make it the Human Resources and Compensation Committee. And those will actually be further explained by Ed when he has his report on the Compensation Committee. All right, the next item that we're expanding on is the overarching priority, develop and integrate the legal investment function. One of the Funston recommendations was to eliminate the 30-day review period for all final documents before approving the final approval of an investment. And Dory, would you be willing to speak to? We have, I guess, originally a motion in July of 2012 added the 30-day review period. And I know back in September there had been a recommendation to remove it after a tremendous number of process improvements as well as technological improvements had been put in place. It was tabled till November, at which time the fiduciary audit was being contemplated or underway, and it was decided to wait until that. And now, since they have recommended also to remove that 30-day period, that is, the committee has taken up that motion to do that. I don't know if you have any, or I don't know, should we open discussion on that?
Yeah, the commission, the planning committee recommendation is to repeal that motion dated July 19, 2012. So the floor is open for discussion on that.
I have a question, and this really goes to both staff here and I guess the treasurer's office, just because I know this is something I worked on as far back as when I was chairman, trying to get that, the required document list. I mean, the original point of the 30 days was to make sure that all the due diligence items that were requested, and kind of matched up. Are we happy with that information flow and matching up? Because that was what, where the 30 days originally came from.
I can.
Part of the approval process actually go through the internal investment committee, is that Andrew signs off from the compliance perspective that all those things have been done. So that's part of it as well.
And that gets pushed.
That, before it gets out of internal investment committee, has to be done.
And Sarah, you want to pick up what happens after that?
Sure, we are posting, well, when we go to the 30-day review process, we're posting the documents to Watchdocs for everybody to look at.
Well, actually, most of them are posted well before that because it's all posted before it goes to the commission for a vote. So what's posted at the beginning of the review period are just the final documents, the final side letter and subscription agreement, things like that.
And the final thing is a letter saying it's legally sufficient.
Among
with a checklist
the other
attached, et cetera, et cetera, et cetera.
documents, yes.
I think Herschel's right, a key control is having Andrew review it prior to it coming to y'all to make sure, that reassurance, right? We're supposed to have the assurance of management, so it's management's responsibility to make sure we follow the guidelines. We're trying to give you reassurance through the compliance area.
And then the other level of reassurance would be, since June of 2013, legal has been providing certifications, and we wouldn't see a change in that, except for we wouldn't need one at the beginning and the end of a 30-day period. We would just need one that would contain all of the information that were previously in two. All the material elements will still be in one and presented to the chairman prior to the request for signature.
So just to be clear then, once all that documentation is posted, is there now, if we repeal this 30-day rule, is there some time period during which you receive comment and so forth, and if none is received, then you assume that there'll be no further action taken? Is that?
We are talking about eliminating that process.
So back in May in 2013 is when the legal sufficiency issue came up. And looking back in the minutes, one of the issues, Treasurer Loftus expressed an interest in obtaining a short summary or a simple page documenting any changes in terms as opposed to having to read lengthy contracts. So I think we were trying to get away from having to have that review in the middle. And the recommendation to reduce the 30-day review period at that time was carried over because we wanted to see if we could, satisfy the concerns with the legal certificate. And I believe that I think that that's worked very well. Betsy's closed the
We
last.
closed 2 since September, and they have gone smoothly working with the treasurer's staff.
Yeah, and a lot of that also, I mean, historically was picked up because, for example, the treasurer's office, I know, as an example, it asked for detailing of sub-custodial relationships from funds and stuff that now get picked up in the due diligence process that in the past may not even been questions that got asked, of the provider. So there's certain things that have moved, I think, before documentation, whereas in the past, we were slowing down the process to give people more time to think through things.
And that is one thing. I mean, I do think that Funston said that our due diligence process is thorough. So, I think that the documents that we are gathering, we didn't receive any feedback that, we need to do more here, we need to do more there, or need to make something more robust. So I think the process is good. We have a control in place to make sure that we're following it, and that is done before it comes to the commission.
So as I see it, it's all worked out pretty well. Mr. Powers' motion was very helpful. It allowed the commission and the treasurer's office as custodian to develop procedures, and especially the written certificate of legal sufficiency, and that document works well. There may be a little, I would hope that staff could be able to work together on, when that document gets posted, someone gets a phone call so we know it's posted, and there's going to have to be some period of time. The treasurer's office has to go through that document. It's the way the current, now that there's actually, in fact, a document of legal sufficiency as opposed to just being orally transmitted, it's much easier. The amount of work is, a 100th of the work. So, but there is going to have to be some little time period. But I would think that the commission would be too interested in that. That'd be something that the staff would just work out. So you just about a few days.
The chairman is still going to receive the document of legal sufficiency. It's just that there's no mandatory waiting period before he signs it, correct?
Right.
Okay.
Right. So now a document can go up, and everybody can execute it immediately, really.
Yeah.
Essentially, I think what we're saying is that, we've gotten to the point, or if you all vote on this, that we've gotten to the point that we're comfortable with the process and that we're following the process. The document of legal sufficiency will still be there.
Will still be there, yes. Mm-hmm.
Any further discussion?
I guess my only question, I'm obviously not spending my time doing a deep dive. Do we just want to shorten the period from 30 days to 5 days or something? Immediate might be a little quick, right, if somebody didn't want to read a document or something, but.
Well, the treasurer's office is going to have some period of time when they post the document of legal sufficiency. The extreme, you want more than 2 minutes, so you'd have to give us some period of time to take a look at it, go through our checklist.
What role does the treasurer have in approving a legal document for the chairman of the commission?
Well, we went over this before. If we want to go through it again, I'd be more than happy to. This is.
I don't see that the treasurer has any role in that process.
I have to echo what Reynolds is saying. If this is an investment decision, what does the treasurer's office have to do with that other than the custodial aspects of the legal sufficiency? I'm unclear on that.
That's what we're talking about. That document of legal sufficiency. And I don't know what Reynolds is going back on some slight of fancy from the past, but the same document we've been dealing with as recently as a couple of weeks ago.
Well, as long as you get it before it has to be funded, I don't see what the issue is.
Just keep filling out the document properly, and we'll keep doing what we've been doing.
I don't.
Mr.
Okay.
Chairman, if I could interject, the last two that we had, there were issues with the legal sufficiency, and we did have to work with staff. They were very kind and updated this statement of legal sufficiency, so it was taken care of. So, certainly a few days, like you suggested, a 5-day period would be helpful. And knowing when it comes in, which Betsy's been great about doing.
I would just say, with all due respect, there were not issues your office requested some additional detail, and I supplemented it, but nothing significantly changed. We just added additional detail to clarify a few points for them.
Okay. Maybe I'm just being a little thick here, but I've heard this argument on legal sufficiency now for a long time. It's held up all sorts of things. What is the problem if there is a specific definition of legal sufficiency? It should have been solved a long time ago. I do not understand all this additional requests for this, that, and the other thing. What is it you need for legal sufficiency from the treasurer's office? We've gone over this far too long. It ought to be detailed and sufficient. And why do we keep talking about it, Mr. Treasurer? I'd like to know why.
Ed, all I know is whenever we talk about something, you bellow at us and think it gets fixed.
I don't bellow it up because I'm tired of listening to an exception to the exception to the exception to the exception, which is nothing more than obstructionism.
We have a functioning legal sufficiency
Y'all do what you
document
want.
that's complied with.
He's ill-informed, and I'm just not going to put up with it. Just do what you want.
Well, that's what you think.
The treasurer's staff and the investment commission staff has been working well here, and it is nothing to be broken. But if you want to blow it up and break it up, go right ahead. That's your prerogative.
I wonder if we should call for a vote.
Yeah. All in favor?
Well, I
recognize you, Mr. Mayor.
Yeah, I think we ought to shorten it. 30 days is an awfully long time. I don't think it ought to go to 0, right? I mean, that's my only reaction, just because I do think sometimes if people are so inclined, they look at other documents, it can be important, and I only say that in part because one of the items that came up in our board meeting in their purview to have an opportunity to see a document. You know, I think there ought to at least be some minimum time, 48 hours even. I mean,
Alan, what are you suggesting, after all the final documentation has taken place?
Yeah.
Have some period?
Yeah,
for
I mean, it
review
could be
after?
48 hours, it could be 5 days. I mean, it can be something that's commercially reasonable, but I think to go all the way to 0 is a little too fast.
You have a motion to amend this in that regard?
I would make a motion to amend it.
To what?
Let's say, you know, I generally want a weekend, so maybe 5 days, maybe.
Is there a second?
I'll second.
Oh, there's an amendment, okay. Amended.
All in favor of the proposed, is there any more discussion on the proposed amendment?
I think Alan's suggestion is a good suggestion. I would perhaps just shorten it to maybe 3 days.
Yeah.
I'm a little opposed to stretching this.
I am too. I, you know, the 48-hour, or I think.
Would you?
So should we say 3 business days then?
Well, wait, 3 business days?
Rebecca suggested 2 business days. to sell one.
2 business days?
I mean, even cash trades are still T+3. I mean, they're trying to go immediate, but.
I'm just trying to make sure we have
To remind folks, this is the document, and this is the information where the Supreme Court Justice pointed her finger and said, give the man his information. All we're asking for.
This has nothing to do with getting people information. That's totally
Again, what I
separate.
want everyone to realize again is that all of these documents will have been on Watchdocs for everyone to have viewed and read for some period of time. So it's only till the very end when there's what, one more document?
Generally, it's the final side.
Side letter.
Final side letter.
And the subscription agreement.
Yeah.
And subscription. So the legal sufficiency has already been out.
No.
The legal sufficiency is done when the side letter.
When the
all
side
the
Right.
But everything else.
But we've
has come
already
up.
gone through the full system of
Mhm.
checks to ensure legal sufficiency and
Correct.
ensure,
Correct.
you know, everything has taken place in the process long before. So again, we're talking about 2 documents that get placed at the very, very end.
I'm not sure that that's true, because sometimes the legal document of legal sufficiency doesn't come over as quickly as you might would think, and also the documents at the end are the most important documents. And we're not asking for a lot of time, but when you're saying that if something comes in on Thursday morning, we got to get it out the door almost immediately. And if I remember right, and I might be wrong about this, but what we called an issue, which I thought was very polite and benign, and I think Ms. Burns is objected to, was when the tenor of the document changed because actual issues, or excuse me, items that a lawyer had been certifying before were no longer certified by that lawyer. and were served out by unnamed staff.
Okay, well, why don't we take Alan's
been a while.
3-day? Why don't we take
But
Alan's
so
3-day?
we have to kind of keep up with these things, and 24 hours or 48 hours is just isn't a lot of time. So we're not going to do it before we can do it, so we can put that in there, but we might just be trying to have an
Are you okay
argument
with
later
3
on.
days?
And I don't-
Three calendar or 3 business?
I would say 3 business.
3 business.
I mean, even a cash trade is T+3. I mean, you got 3 days to figure out. all the
Three
inputs,
business
right?
days? So does the maker has
Does
accepted?
the committee accepting the amendment to 3 business?
I would, yeah, do we need a second for the 3 business day?
No, I think first, I made the motion, I
Okay.
accepted it, so I don't think it needs a
Okay.
second, right?
Then, yes, well, you too, on the committee, I would be willing to accept the 3 business day.
3 business days.
I would.
I don't think it needs any review, so
I don't either, and Funston was very clear about that as well.
Yeah.
But, you know, I do understand, you know, we are creatures of habit, so maybe this is a baby step towards ultimately, you know, getting rid of that. So, you know, I think some progress is better than no progress.
Well, it'll certainly be faster than
Yes, 3 days is way faster than 30.
Okay, all in favor of the amendment to make it so that it would, instead of saying 30 days, where it now says, it was changed so that it would read a minimum of 3 business days to look at all final documents.
Yeah, and can we make that, you know, part of the motion was to change that review period for all pending and future investments, including renewals.
Right, that's part of the motion.
Okay.
Yeah.
All in favor of the motion as amended, signify by saying aye.
Aye.
All opposed by like sign.
I'll abstain.
So 1 abstention?
Well,
Okay.
Okay. I had.
Item 5.
Yeah, I had no
Madam
idea
Chairman.
this was going to be such an exciting committee. All right, so the last was the overarching priority. Number 8 was appoint an executive director who's accountable to the commission for managing the entire organization. And Funston, I think, started off with that recommendation and ended off with that recommendation. But the point of that was to be have a single person who provides the accountability for the agency. And do I need to make the motion, or can I just start discussion on this, or?
This is going to be a committee motion, so
Okay,
you
the
can
committee.
just start going.
So effectively, the commission, the committee is recommending that the commission approve revisions to governance policy 3 that we're presenting here, and directs RSIC staff to make necessary changes and so on and so forth. But effectively, the changes to policy 3 adds the position of executive director, and slightly modifies the CIO and COO position just to recognize that there is the role of executive director. Now, I want you to know that we didn't just throw these role responsibilities and duties together and stick it before you. We've actually done a tremendous amount of due diligence in developing these roles. We, in addition, Funston's recommendation was very clear in their fiduciary audit about having the importance of having this role. We went back to Funston and we said, can you craft a set of example role responsibilities and duties for the CEO or executive director position? And they did, and they had several conferences with me and with several people on the committee with regards to this role. Secondly, just because, not that we didn't believe Funston, but we actually contacted HEK and were put in touch with 2 members of their fiduciary staff who are Nancy Williams being one of them, who's considered one of the foremost experts, if not the foremost expert in fiduciary matters for pension plans in the United States. And we asked about this scenario with an executive director and then underneath a CO or CIO, and that report to the board. And they confirmed everything that Funston had said about this particular role. And not only that, they said, we asked how many pension plans actually had this type of role versus those that didn't, and they said that they felt that this was the recommended governance structure for plans. I think Nancy said a very, I like the comment, she said, when you have, because right now we have a bifurcated system where we have a CIO and a COO both reporting to the board. And she said when you have 2 leads, you have no leads. And she said you unfortunately put the chairman of the board in the position of having to be the CEO, which is unfair to someone who's either not paid or paid very little for that role. And it's not there on a day-to-day basis to be able to manage the operations. So the executive director role we've crafted to, again, serve as the agency head and to, it's effectively, I want to say another thing, you know, we went through several scenarios with HEK with regards to, and Funston, with regards to what's the role of the CEO, or the executive director versus CIO. And the executive director, she said, the executive director is not a portfolio manager. The executive director is not there to make investment decisions. The executive director is there to manage the organization, to deal with the legislature, to communicate with the stakeholders, to handhold the board, is what she said as well, but to deal is more the deal with the administration of the organization. And most importantly, is there to support the role of the CIO, to make the CIO, make the investment team have all that they need to succeed. And that is the role of that particular, of the executive director. So we have put together, again, you know, based on all of the feedback from Funston and from HEK, we have put together a set of director responsibilities and roles to meet all the criteria as laid out by Funston and as verified to us by HEK. I don't know if you know, if there's discussion on this in particular or specifics.
Yeah, I mean, you know, we spoke about this on the phone, you know, last Thursday. I'm strongly against passing this today because I'm not sure, as it's worded, that it's even legal.
Oh,
right?
well, that's a good thing that you brought that up.
And I just bring that up because in Funston's report, G4, the legislator should revise legislation to allow, right, the commission to designate a single person, right?
Yeah.
You know, I think they've done a thorough job. I mean, we had them in here. You know, I reviewed the code last night. You know, I think until it is more well-developed, I'm absolutely not prepared to vote on something that, you know, I need explained to me much more clearly about how
that's an excellent
Let's
point.
get Robert to address this. 'Cause we
Yeah.
made this up.
And actually, can we go to Robert's, Robert prepared a legal memo on South Carolina State.
95. Alan, at the beginning of this week, members of legal were asked to provide guidance about 3 different issues that are listed on the page that's up on the screen, and you see it in the middle of page 95 of your red numbered packets. So the 3 things we were asked to provide guidance about were, number 1, under current state law, what roles, responsibilities, and functions must be performed by or have been delegated to the Chief Investment Officer. The second was roles, responsibilities, and functions under current state law of the Commission with regard to the CIO. And then last but not least, under current state law, what roles, responsibilities, and functions could be performed by or delegated to an executive director. So based on the information that was provided, what we did is just really focused on existing state law, principally Title IX, and took the other information that had been provided and tried to give guidance about what the state of the current law is. So turning to page 96 of your packets, you'll see that what we did is we started with the definition of who is a fiduciary. And there are 4 components of that definition. 3 of them are quite relevant here. The first is any person who exercises authority to invest or manage the assets of a system. The third component is a member of the commission, and the fourth component is the commission's chief legal officer. Chief investment officer, sorry. Yeah, I don't want to be making the CIO. It's very interesting to note that the definition would cover, the first component of that definition would probably cover several members of RSIC staff and would cover the executive director position as was outlined to us. That first component would definitely cover several people. But the CIO is separately and explicitly named. We think that's not, not a distinction without a difference, because while other provisions of Title IX apply to all RSIC staff fiduciaries, the statutory framework, we think, really makes it very clear that the CIO position is unlike that of any member of RSIC staff. And there are these two statutorily clarified and identified roles and responsibilities that have to be performed by or have been delegated to the CIO. I'll go over those first, and then I'll hit 4 roles that under state law the commission has to discharge with regard to the CIO. So let's do the chief investment officer's roles and responsibilities under existing law. Again, unlike any other member of RSIC staff, state law explicitly requires the CIO to perform 2 big roles, and that is, number 1, developing and maintaining the annual investment plan, and number 2, investing and overseeing the investment of the trust funds. The key provision is one that I think a number of you are quite familiar with. It's a compact, powerful paragraph, 916.315G, which provides, in relevant part for these purposes, that to assist the commission in its investment function, it shall employ a CIO who, under the direction and supervision of the commission.
Right.
Yeah.
And the commission was previously defined as
Yeah.
those of us who are appointed members.
Mhm.
Right.
Yeah.
Right? So
Yeah.
that, the commission,
That
even
is
though we
the-
broadly speak about the commission as defined
Mhm.
earlier in this act is not this as an organization, it's those of us
Us.
appointed,
Mhm.
right? So
Yeah.
this would leave Herschel as a direct report of us by law,
Mhm.
right? Or the CIO or anybody.
So, yeah, any
Right.
CIO. And as its agent, so then it identifies those 2 functions we were just talking about. And then there are other provisions of state law that elaborate upon these 2 functions that must be performed by or have been delegated to the CIO. And those are listed on page 96 in the middle of the page. Suffice to say that these 2 functions, the way I read state law, and I think legal is in complete agreement with this advice of counsel that I've written, these 2 functions really are the domain of and the responsibility of the CIO and must be discharged by him because they've been given to him under state law. So that's roles and responsibilities of the CIO under state law. Let's turn to the commission. Under current state law, what roles and responsibilities and functions must be discharged by the commission with regard to the CIO? We could turn to page 97 of your packets. There are 4 areas, 4 main roles, responsibilities, and functions that the commission must discharge with regard to the CIO, and they're listed at the top of 97. The hiring of the CIO is the first, because there is another provision in 916.315G that states that, quote, that it is the commission, shall employ a chief investment officer, close quote. So that language certainly suggests at the very least that under existing law, the commission should continue to play the final decision-making role with regard to the hiring of the CIO. Is there room, can you design a management structure that would accord to or delegate to an executive director a meaningful role in this process? Absolutely, there's a way to do it and still be in compliance with state law, and we'll get to that in a couple of minutes. But again, final decision-making role I think needs to remain with the commission. Termination of the CIO. Again, the same language in 916.315G is quite key. The power to hire, the other side of it is the power to terminate. So we think the commission should continue to play the final decision-making role with regard to any involuntary separation from employment of the CIO. The third area, under state law, where the commission has duties with regard to the CIO, evaluation. Here, there's a slightly different bit of text that I want to just note for you, still from 916.315G. The commission shall, quote, employ a CIO who, under the direction and supervision of the commission, handles the investment and reinvestment of the funds. So this certainly suggests that the commission should continue to play the central role in evaluating the CIO's performance. And the fourth area is, or concerns, the compensation, the setting or fixing of the compensation of the CIO. Yet another provision of the same statute notes that the CIO serves at the pleasure of the commission and must receive the compensation that the commission determines appropriate. So again, could you design a management structure where the executive director is involved in this process quite actively? Yes. But, and have we had situations already arise where the commission has decided to delegate some of that authority? Yes, we have. But again, the commission's role with regard to fixing the compensation of the CIO, I think, is quite clearly spelled out in state law. And I would recommend that great care be given to thinking about the connection between fixing the compensation of the CIO, evaluating the CIO, and other policies before material changes are made on that score. And there are a couple of other roles and responsibilities that the commission must discharge with regard to the CIO. One you're quite familiar with. You're required on an annual basis to provide the CIO with the SIOP. And secondly, one that's really much more a matter of transmission. You're required to provide the CIO with a statement of actuarial assumptions developed by the systems actuary and approved by the board. That's a summary of the commission's responsibilities with regard to the CIO. So that brings us to this third area. Under current state law, what roles and responsibilities and functions could be performed by or delegated to an executive director or whatever this new agency head position is going to be. So based on the information that was provided, and I think it remains consistent with what I've been hearing today, it would appear that there are a number of areas where, consistent with state law, the executive director could be delegated very significant roles, responsibilities, and functions with regard to the CIO. And we go back to page 98 now. The same four areas. Hiring of the CIO, should it be the commission's pleasure? I believe that the commission could empower the CIO to perform a number of different functions, any or all of the following functions: apprising the commission of concerns or issues relating to the CIO, assisting the commission in making decisions with regard to any involuntary separation from employment, communicating the commission's decision about any separation from employment, and overseeing the implementation of any separation from employment. Happier topics, the evaluation of the CIO. I'm sorry? I'm sorry?
You actually said empowering the CIO.
Oh, the executive director to, pardon me, empowering the executive director, thank you, to take some or all of those steps or handle some or all of those tasks. When it comes to evaluation of the CIO, the executive director could provide an input to the evaluation process and could certainly coordinate the evaluation process that's spelled out in the governance policies. And then with regard to setting of the compensation of the CIO, should the commission so choose, the executive director could be delegated responsibility for coordinating the annual process that's presently followed to fix the compensation of the CIO. To the extent that in the future qualitative factors are to be included in determining the CIO's comp, the executive director could also provide an input into that portion of the compensation setting process. But again, These things are all part of a larger whole, and we would counsel or urge you to very, very cautiously review and thoughtfully think about that bigger picture before making material changes on that score. Concluding notes that you see on page 98 is about dotted lines versus straight lines, solid lines. I think that based on the information that had been provided, it was apparent to us, Alan, that the CIO would have something akin to a dotted line reporting relationship to the commission. And in light of the analysis that we've offered, we think that that is the irreducible minimum for purposes of satisfying existing state law. You've got to have that. Less than that, there is going to be a problem. But we think what's been discussed and what is before you in Governance Policy 3 does meet those requirements. And then there's a concluding comment about the executive director. So I'll stop there. Sorry it took so long, Mr. Chairman.
No, thank
Rebecca,
you very
did-
much, Robert. That was very, very thorough.
Okay.
And I really appreciate all
Yeah.
the work that went into that.
Did the committee have the benefit of that legal advice
Yes.
before redrafting?
Yeah, yes, that was a part of the input into
Mhm.
to developing the job descriptions.
So can we roll up, like, real quick, for example, up to item A3 in the proposed thing? I mean, this is just, it's a language thing, but this is where when you're working on the fly, is an at-will employee selected by the commission to oversee, you know, COO, chief legal, HR, and CIO, right? I mean, that's a strong word, right? Because legal opinion, we've now put caveats around that, right? So the legal opinion is, I think, softer than a word like oversee, right? And and even this kind of touches on some earlier versions of org charts we've had. For example, you know, chief legal, you know, I mean, this goes all the way back to when we first formed the commission, Reynolds. You know, the original org chart actually had two legal positions, one for the commission as a body, and then one for, you know, investment type functions, right? Because presumably there are issues that may arise where we as a body, you know, need separate and differentiated counsel, right? So, I mean, this gets to be, in my mind, a pretty complex question, not unimportant question. I think there's also the question, which Mr. Ryberg and I talked a little bit about last week, what was legislative intent, right? I know that's something we don't often give thought to, but, I mean, I think as the legislation is written, it was contemplated that, you know, we initially gave Bob both these titles, right? Or something similar, CEO, you know, and then we split it, right?
There was something before.
Yeah, something before, and the agency head was originally the chairman, right? So, I mean, we've been through a bunch of different machinations
Several different
on this question, right? And then we created COO position, which I candidly would have thought would have already picked up a lot of these responsibilities, right? So, I mean, to me, this, I'm not saying this isn't the right way to go, but for me, with both, you know, a little bit of institutional history as well as sort of the legal caveats, right? I mean, I think this is it requires more thought than I've, you know, as I discussed last Thursday, than I'm prepared to vote on today. Right? I mean, that's just where I am. I mean, I think it's the right direction, but I'm not prepared, you know, just because I think it's a more complex issue, you know, of governance structure that we could spend a whole day on, candidly. Because we have. I mean, you know, we've been through about 5 itinerations of this over the years.
That's what Funston did, and that's what the planning committee has done all the work on, has spent more than a day. We spent, you know, 3 meetings plus, you know, inordinate amounts of time outside of that, plus additional conference calls and discussions with Funston. So, I mean, you know, as the planning committee, I guess we felt that that was our responsibility to do all that legwork so that you didn't have to, and that we could provide that recommendation to you guys, to the full commission for that. And, yeah.
Nice to see you.
Yeah.
I echo much of what Mr. Gillespie says. Some of us, I see a great parallel here between what we just moving away from asset due diligence by commissioner and asset classes. We operated under the prudent man rule. One commissioner went out, sometimes two, If they liked it, we all felt that was a prudent man. He was on the scene, he made the decision, we voted for it. And now, in motion after motion, the committee sends it in, and we're supposed to accept it. And I realize that the committees, y'all feel good about this. Y'all spent the time on it. But as a commission, we haven't. And so I think we just had Funston tell us in one way that perhaps that theory was not the best. Something like this is something I think any other board in state government would take into advisement, and they'd take it to June and probably pass it. But to do so without some time to talk about it, think about it, ask questions about it, what are the what-ifs involved, I think is ill-advised.
Well, yeah. No,
Was there any material difference between the final Funston recommendation that we received April 18 and on this particular area and the preliminary one we'd seen a month before that?
No. Would it be I mean, I know you helped draft the legislation with CIO. Would it be helpful to, explain the history of, what was the original intent of, I mean, it was my understanding that it was built, drafted back when there were two people employed as the.
Obviously, they didn't address the executive director in the legislation. Why we did that, I can't tell you. And of course, they wanted to make sure the commission was responsible for the investment side, and so that's why the CIO was set up the way it is. I've operated in a COO capacity with the CIO for 6 months. It doesn't work when you have two people reporting like we do. It's dysfunctional.
Mm-hmm.
And there has to be an entity where the decision-making is final and where the buck stops, and there has to be one report to the commission. This, to me, the way it's set up is a recipe for disaster. And I stated it well before the Funston came out. I stated it to you, Mr. Chairman. Funston, I guess, basically validated my thoughts relative to an organization. I've never been in an organization, where there's nobody on staff or here that the buck didn't stop at. I mean, I look over to Travis sitting down there at PIVA. I mean, y'all don't report, I don't believe, to one of those 11 commissioners, okay, in a bifurcated basis, the way it's set up here.
No, I report to the, I'm the one that reports to the other.
That's right, and that's what we're lacking here. And so, and do we have the luxury of waiting? I don't think we do. I think we're putting off, number one, the inevitable. Number two, we're delaying the implementation of review and the attainment of goals. We're delaying the implementation relative to full review of performance, and I don't believe we have that luxury. And so I think timeliness is now, and I don't believe there's another organization. I think as Robert has done a great job here in looking at how it's structured and how it fits into the existing statute, and what you have come up with, Rebecca, you and the committee meets that, and to go forward where we would expect a part-time commissioner, okay, to manage this place on a regular basis and do so in an effective way, I think Reynolds is not a possibility.
Are there going to be growing pains? Yes. But I think what the committee has come up with is the best way possible within the framework of existing law and being in compliance with it and accomplishing the objectives that Funston and HEK want. The chief investment officer will still report to the commission. He'll still be in charge completely of investments and investment staff.
and all of the investment-related functions, but it accomplishes as much as we can within the existing statutory framework of an executive, having a single head. And I'll repeat what I said, yeah, they're going to be growing pains, because we have operated that way in the past. We have to grow through it. But we, as long as we select a mature, sensible executive director, and we've already selected a mature, sensible chief investment officer, that's what their job is going to be, is to figure out this structure. And if it needs changing, change it. If it doesn't need changing, don't rock the boat.
Alan, is your concern over the legality of this or the structure itself?
Well, it's layered. I would say really, I'd say there are three things that have kind of slowed me down on it. One was just the process, and I appreciate the work the committee's done. Rebecca called me last Thursday. We had the conversation. I asked for Robert's legal opinion, asked for a job description of the executive director. There'd be personnel reviews. I had a conversation with Mr. Ryberg about it because, that gets into, if you create a position, how are you going to run the search? What are the qualifications, right? To do all that in a week, right, when I'm headed out the door on a Thursday, I just don't think is a responsible way to run the process, right? I agree with Mr. Ryberg completely that having a direct person that, is responsible and report it. But then I think we do have the added complication of, I can't look at the law and not at least think in even our own historical practice, right, that was contemplated that that's the CIO. Now, obviously it doesn't have to be, which is why we created the COO position. But that becomes inseparable in my mind from personnel decisions, which we would need to take up in executive session, right? So, are we going to run a search, or is it going to be an internal search? If it is, so to me, the issues are, A, the process, by which, we're taking up the issue, right? In that I've had a week since I've been socialized to this, right? I don't think that's fair to me as a commissioner, right? Particularly on legal and structural issues. Second, I think they're personnel questions, right? And then I think they're just basic HR, questions, right? From job description development. And we received some of that from HEK and Tungsten and stuff. But again, all that's happened in the last 5 days when I've been on the road.
If I remember right, I learned of this on Tuesday. Is that correct? Y'all voted on Tuesday?
No. We learned about it because I called you after to ask if you had been called.
When was this?
Thursday. Last Thursday. And that's a problem with the process, right? I got a call out of respect, and trust me, Curtis cussed me out on the phone when I was chairman. I don't always get along with him over here. We got into it. He told me to get a lawyer. I told him I would. I had.
And worse, he told me.
But, back to the work. If we're going to rebuild trust, then I think that's a responsibility that falls on all of us. And I can't support a process where even I feel behind, and I know one of my fellow commissioners didn't get a call.
I never get calls. I don't say much about it. I've just been cut out of everything. I just don't say much about it, but I'm cut out of everything. Each commissioner here has allowed me to be cut out of everything. I don't get calls, I don't get emails, I don't get anything. And, well, I shouldn't say that because I'm sure Reynolds will come up with something that I've gotten. But, I am the state treasurer. I do have a role here. You might not like me, but I've never had a crossword with most of you. Never. But yet I don't get a call. I don't find out things. Had Mr. Gillespie not just happened to catch me someplace, I wouldn't have known until Tuesday when it passed. It's just mind-boggling to me.
Yes. For me or somebody else?
I believe I discussed it with Ryan.
Okay. But from a commissioner, you didn't get a call?
I think I might have talked, I might have talked to you. I'm trying to remember now.
Yeah. Travis, did you get a call?
From a commissioner?
Yeah.
No.
From a staff member?
You did get a call from the staff member?
Yeah, I didn't get a call from a staff member. So,
Herschel, you wanted to be recognized a minute ago. I got sidetracked.
Yes, sir, thank you. When I was appointed as CIO by the commission, the structure was very clear at that point in time that there were segregated roles and that I would report directly to the commission. So that's the job, the duty, and the understanding of organization structure that I committed to. We have had a lot of change at this organization. I think we all recognize the need that we need to grow. there are things that we can do better. I think the recommendations from Funston and HEK all make sense, and I think as we think about organizational structures that one would observe even in the corporate world, this is not an uncommon structure. I think the key critical component will be defining clearly these roles and responsibilities and this policy, because this will change and reshape the commission. This is a defining moment again. As Mr. Gillespie brought up in A3, the word of oversee. I actually heard Funston mentioned several times, and Rebecca mentioned in their conversations that it was mentioned that this role is to support the CIO. So I think there's a lot of terminology in here that one would want to make sure they fully understand the full context, because this is a significant change. I am willing, as CIO, I don't want to be the executive director. I'm in the role that I'd like to be in. I'm here and saying that I would definitely be in favor of this type of an org structure, but we definitely need to make sure we clearly understand roles, responsibilities, and the definition of the context of all the terms here. And that's where I am, because I agree that there will be growing pains, and we're going to need to understand how those get vetted, who's responsible for vetting those things. But I believe that our path forward, that this is the correct organizational structure.
And I believe we'll probably all vote for it in June. But, you know, we just had a series of committee votes. We don't have much time. They say how important this is. How important can it be if you have a couple days to take a look at it? And just how important can it be? And these things they don't sit well outside. When the others hear about jobs being created and filled immediately and big salaries, I mean, this is how the commission repeatedly finds itself in trouble. And we ought to go ahead and call for a vote. We know how the vote's going to end, is be done with this conversation. But these things are important. It wouldn't be hard to build a consensus, but the steamroll folks, you know, today it's me, and perhaps Mr. Gillespie, it could be somebody else tomorrow, it could be you tomorrow. If you come in here and you don't have the knowledge, all of a sudden there's the vote about something that we all say is just inherently important.
Well, can we narrow our area of concern, or I don't want to call it disagreement, because I think everyone here, and I think you just enunciated, was we all agree that we should have one head of the organization, whatever we want to call him, executive officer, chief, CEO, but is the desire to flesh that out a little more deeply in terms of the areas of responsibilities and so forth? Is that the real problem here? Not so much creating the position? Am I getting that right, or is that?
Yeah, I mean, it's clear that what Funkston anticipates and what practical experience, I think, tells everybody is having a single direct report is the right way to go, right? I think there are a lot of elements that that go around that, though, from how do we run the process, how do we improve it, how do we check the language, how do we draft the job description, how do we run the search process. I mean, I think there are a lot of procedural elements, but I think the general direction is the right direction. But, I'm not prepared to approve something on it's until I pulled up my watch docs this morning, I hadn't seen the draft, because, I got home at 3 o'clock last night, what that looks like. And I look at it and I see words like oversee, and then I pull up my Funkston report and I see the legislator should allow, right? And then I just got the brief from Robert, right? I'd like some time to take all that into consideration of how do I reconcile that language with this language with the legal brief I just received from Robert, which isn't even protected because we did it in open session, right?
Just on the issue of apparent conflict between what the Funkston report says in terms of legislative oversight as opposed to what we just received in our legal briefing, are we prepared to accept Robert's opinion that we are able to do this without, am I stating this correctly, that it's your opinion that we are able to create this position without legislative approval?
Yeah, that the single report structure can be implemented so long as the powers and duties and obligations of the CIO under existing law continue to be, performed by him, and he continues to have.
As long as we don't change
direct-
that.
Yeah.
But we effectively have that now. I mean, we not effectively, we do have that now. You report directly to the commission.
Right.
And there's
Yeah.
the chief operating officer, who is the agency head. And so that's not, I mean,
No, that
the
also
basic's not
complies.
going to change.
We've had several
Yeah,
different
I mean,
organizations.
but what we have, in fact,
yeah.
today is not going to change. It's just we're going to add a third person.
It's a different it's a different structure.
How was that?
It's a.
Mr. Roberts, the agency head now, right?
Single.
No.
Who's the agency head?
Well, no, Mr.
There is no agency head.
Well, no,
There's
Mr.
a
Ra-
CIO, and there,
He
right
is
now
the
there's.
agency.
Robert is the agency.
He is the head, agency
Yeah,
head right now.
Robert is the agency
right now.
head.
Yeah.
And he reports directly to the commission.
Right.
Personal reports directly to the commission,
Like-
just like it is now. And that's not going to change, because the dotted line will always be there, because that's a statutory construct. That's not a regulatory, that's a statutory construct.
Right.
We're not changing state law.
No, we're not
That's-
changing state law,
yeah.
but the org chart is going to look different.
How's it going to look different?
Because there
We
would
have an
be.
executive director
Yeah.
at the top.
Oh, yeah, because he'll oversee, but yeah, that's
Right.
right.
And
Well,
then-
but the fundamental part of him having access to us doesn't change.
Should not
No,
change, should
no,
not.
and that's what
should not.
Funston was saying, is that they recommend changes to the state code of law to, because right now, what we're recommending is an executive director here with a CIO and a COO down here, but there's still a dotted line for the CIO up to the commission. And Funston is recommending that we change the state law to remove that dotted line from the CIO to the commission. And they said the dotted line effectively means reporting directly to the commission, but in removing that in state law, the commission always has access to everybody, but they're recommending getting rid of the dotted line altogether. We're recommending still a dotted line relationship. But let me say, I do not want to leave anybody out of the process. I do not want to rush anybody on the process. I really, really think that this is so important that I would love to have unanimous consent
I'll never
on this.
Never do that.
Well, would you accept
Yeah. I mean,
handling this,
it's not the
the
way
way
it's
we-
presented.
would you accept handling this the way we handled the statement of investment beliefs? And that is to accept it as information now
Yep.
and ask all commissioners by the same date, May the 15th,
Yeah.
to get the planning committee through
Mhm.
Chairman Gunlingson back your suggested changes, whatever. The only thing I ask is don't just do generalized griping about it. If you got to change, state exactly what the change
Right,
is,
yeah.
so that they
So, I
can.
mean, yeah, if you don't like oversee, although oversee, I think, is qualified by, as specified within this policy and as required by commission and state law, so.
There's a
but
limit
if-
to
If you
those.
don't like oversee,
But-
just don't say, I don't like oversee.
Right.
Give some suggestions.
Right.
for
Yeah, but you
language.
can see why that's hard language to read and
Yeah.
accept in a week, right? Because just even what you did there, having to layer, right? I mean, that takes some thoughtful consideration.
Mhm.
I also would add, I would appreciate that that suggestion, but B, I think this ultimately becomes inseparable from an HR discussion, which I believe we have, set for executive session, right? Already, right? As well as, I think if we do create the position, how do we run the search? I mean, that's something else for these high-level hires. We've always determined what the search process, was going to be. We have to opine on that. I mean, are we working from our existing pool? Are we going external? Because this, to the
I think that
treasurer's
is the appropriate part for executive
Yeah,
session.
Right.
yeah.
Commissioner, has OHR, Office of Human Resources, looked at this? So that would be appropriate, I think. I never realized that we were exempt from any of those things. It's just like the HR process we're about, we've got, hire somebody. They
Mhm.
will be using probably 90% of those policies that the state has. So, I mean, that would be one thing we'd have to look. We talked, there were two things that struck me, and then I'll win and we'll do what you want to do. One is the first draft, and I'm not sure it was in the second draft, but the first draft had a fair amount of conversation about strategic conversation. We didn't have very much of it. And in fact, when I was talking to the Funston folks in person, they brought that up and they said, y'all don't have a lot of that. I said, don't have much of it at all. Then today they said, let's don't fix blame, let's fix the problem. How these things happen is people say, hey, just give us a few days more to look at it. We don't set the next meeting, somebody else sets it, but the 2 weeks is an excellent time. You know, a little more time to look at it. That's how we get through this trust issue we have. But, you know, having to look at something over a couple days, especially in the context of all of the big things, and then it all goes through, it's easy for you because you've been working with it for weeks, and we haven't. And so, again, that's just one of those things. Here it goes again. No say, it happened. I'm responsible for the outcome, but I have little or no say on the front. Now, Reynolds suggests, I don't know why we're voting to accept these things. It's just not standard. It's the committee report. We've accepted it. It doesn't need a second. It's on the floor. It's a part of our life now. And these votes, I don't get that because
There's no vote pending right now. She made a motion, well, the committee made a motion and asked her if she would accept.
Well, I know. I was just talking about that whole concept.
Well,
I didn't mean
that concept's not at issue right now, because that's not,
Well,
if she accepts that suggestion,
That we had actually made a motion to adopt the changes to governance policy 3 that you see, but now it looks like there's a possible amendment to carry it over and have a review period with feedback by May 15th. Is
That would be wonderful. I would very much appreciate that. And I don't think we'll make many changes, because I think y'all done very good work, but we may have a couple.
so that's what I'm going to do then. I'm going to ask everybody to get their written proposed changes to the committee in time for them to do it. And when the committee gets that, then the committee can deal with it as appropriate, whether that's to ask me to call a special meeting of the committee, whatever. But the committee will deal with those remarks as they get them.
Can I ask a
Go ahead.
clarification? I'm assuming, but I don't want to, I guess I don't want to make the assumption. I was going to have Nancy look at these as well. I know that.
I would, actually, that would be wonderful if you don't mind.
Okay, great. The reason I raise that is not that we would normally look at the job responsibilities of every person in this organization.
Sure.
That's not, that wouldn't be our role, nor are
Right.
we best suited for that. But when we were having our discussion with Rebecca, I know that one of the issues that Nancy and Jenna felt very strongly about is that having these responsibilities clearly distinguished and no ambiguity was key to the success, particularly when you're putting in a new senior role. That if there's anything that's ambiguous, and a word can make it ambiguous very easily, it's important to be clear from the get-go. It's probably not something, yes, there'll be adjustments along the way, but making sure the intent is set and the direction is set up front is very important. So I would
have a lot of appreciation if you would.
Great, we're happy to do that. So I just want to make sure that was appropriate. Thank you.
Funny, Alan, we've already decided what we're going to do on this, but the same word you focused in on, the original iteration of that sentence 3 said the executive directors and at-will employees selected by the commission to oversee so-and-so, period. And we had that same discussion between various iterations. We thought that was too strong a word, but we felt like, as specified within this policy and as required by the commission and state law, put a little bit more constraints around the oversight. Man, maybe it doesn't. Maybe there's a better way to phrase it.
Well, no,
But
I'm
just
used
want
to
say
things like
we,
that.
we didn't
right?
ignore that kind of thing.
That's like any legal thing, right? That refers to another part of the document, but when you're trying to do this on an iPad from an airport, it's
Right.
difficult, right?
Yeah.
Right? That's why I have 4 screens in my office, right? I can do that sort of thing.
So anyway, the point you raised is a good point, but it's not one that we'd not thought about ourselves either.
Could you just restate, Mr. Chairman, what the next steps? Because I don't think it's a motion
The motion
anymore.
is pending on the floor. No votes
It
has
is a
been
motion?
made. And I've asked all commissioners and consultants to the commissioners.
Okay.
And staff. I don't care. Good ideas come from good ideas. And commission staff, to present by May the 15th, which happens to be the same date as the Statement of
Beliefs.
Investment Beliefs Day,
Yeah.
in writing, your suggested changes to the committee, and the committee will then deal with those
Okay.
changes. as
Thank
it
you,
deems
sir.
appropriate.
And the changes would be to,
Any
Governance
portion of
policy 3?
proposed policy 3.
Yeah. To the planning committee. Submit comments. Good. Thank you.
All in recognition that the consensus goal of the commission, as I understand, is to come up with an executive director position, as recommended by Funston and Machike. Okay?
Well, Rebecca,
as a member of your commission and as chairman of this commission, I want to express my admiration for the ability you have to run a tight ship and to keep us focused and on track and keep track of all the various changes that need making.
Well,
I think Ron and I are in awe of your skills.
Oh, well, might I express that
I
I'm very
agree.
glad that my committee report is over. Oh, it is. Do I have more?
I think you're more. No, at a different future meeting.
Oh.
But for today, it's over, and thank you for it. Audit committee, Alan?
Okay, audit committee. Couple of different things. I'm trying to find my document pack here. Give me just a second. Is it in the full board pack here?
Yes, sir.
Yeah.
105.
What?
Red number 105. 105?
Mm-hmm.
Okay, so the, a couple of things, audit committee, met, received obviously audit reports, as I reported earlier, one on the AIP compliance. What other audit reports did we
That was
receive
it.
last
That
time?
was the sole one.
That was the sole one we received at our last meeting. We also do have a proposed audit committee charter. One item that did come up, which needs clarification, and Robert, I don't know if you want to touch on it, just the issue between audit committee oversight of audit personnel, at where that may, on certain things, overlap, as perceived with compensation committee. So if you want to just comment on that, because that makes its way into the proposed charter. We just need to clarify.
Thank you, Mr. Gillespie. Just two quick points that I'd like to note. During the preparations for the Audit Committee's most recent meeting that Mr. Gillespie was mentioning, it became apparent that the language of the Commission's compensation policy needs to be clarified so as to note really clearly that the Audit Committee and not the Compensation Committee is responsible for fixing or setting the compensation of the Chief Audit Officer, which is Ms. Houston's new position. And so what I'd like to propose there informally is that legal work with staff and prepare a proposed amendment to the comp policy for consideration by the compensation policy in consultation with the Audit Committee, so we can get that clarified and resolve any potential ambiguities. Less valuable idea. Depending upon the way in which the Commission chooses to set up the reporting lines and evaluation of the Director of ERM and Compliance, which is Mr. Chernick's new position, there may also be a need to add some language to the comp policy regarding that second position. Thank you.
Right. So, kind of related to that, on the ERM function, there was some question about that. We did also have a call with Dr. Wilder, myself, Andrew, and Funkston on ERM, because there was some question of what is the role of ERM and where should it report and ultimately lie. Their recommendation is that it, because it primarily and normally comes in as an assurance or reinsurance function, that the audit committee, is where that position report, ought to come in. So Dr. Wilder, I don't know if you have any, further color that you would want to provide.
Just that this is a big area for the commission and for the commissioners to understand and buy into as it develops.
And so the audit committee charter reflects those changes, both of the ERM and the clarification as it relates to compensation committee. And there was one other item, Andrew, you mentioned.
The one thing that wasn't reflected in this charter that came up in our discussion with Funkston is who decides the compensation of the ERM, director of ERM. Currently, the way that the charter is written, the audit committee is not deciding the compensation, but Funkston recommended the audit committee should decide the compensation.
So we'd need to add that.
Yeah, it would just be adding, Robert, correct me if I'm wrong, it's C2, the committee will evaluate, compensate.
I believe you're right.
And set compensation.
Yeah,
We're set.
the chief audit officer has similar verbiage.
Yeah. C2.
And the audit committee did approve this with the exception of that amendment as its recommendation for the full commission, as its charter. So we do need action on that, or requesting action on that.
One question.
Yeah.
Simple one. Have you defined enterprise risk management in any of these documents previous? Or could you? Doesn't have to be done today.
I mean,
But, it's a flexible,
yeah, no,
it floats and.
We actually had a really good conversation with Dr. Wilder, and Alan agreed. Obviously, what's going to come out soon enough is an ERM charter, an ERM policy, but what Funston said, which I thought made a lot of sense, was a lot of ERM programs when they're first launching, they get too focused on policy, and then they spend all this time on policy, and then the output is like, people are like, this isn't what I was expecting. So what they mentioned is have an open dialogue with commissioners and executive management at RSIC and work together as a team to figure out what product do you want? What reporting do you want? What are you guys looking for ERM? Obviously, there's guidelines, but it's flexible as far as reporting. And once we define that, then we can define it within the charter, and we continue to do that report on a go-forward basis, if that makes sense. So I think potentially June, we can, if there's time during the commission meeting, we could have maybe a short discussion on our ERM, and then a follow-up meeting, we could have a more detailed and start showing examples of reporting and areas of coverage.
Thank you.
Yeah, I mean, that's one of the things Andrew and I discussed. He has some sample reports from other, state plans. I was at CRT, saw their ERM report, which is a monthly report compiled daily by their risk officer. And so I think sometimes it's almost too conceptual, but when you begin to see the reports, now, to Andrew's point, that's always customized by organization. I mean, those reports that he has versus a CRT, because they're involved in different activities, are different. But I think it will become more tangible, when we discuss an actual, what do we want to see in the report.
Well, I looked it up and got like 5 different definitions. That was the only reason I
No, and it's hard. I mean, and what, like Dr. Wilder says, we want executive management and commissions buy-off. We want to make a product that's adding value. We don't want to be a rubber stamp or check the box. So we have to have these discussions early on as we start developing this program.
Okay. So you have recommendation from the committee, and if people will accept it with the addition of the clarification on the compensation on item
7C2?
7C2.
Any further discussion? All in favor of the recommendation of the compensation committee signify by saying, the audit committee signify by saying aye.
Aye.
All opposed by like sign? Ayes have it.
And then Robert obviously let the cat out of the bag, but we did formally, Ms. Houston, as of, April 1? Got the new title, Director, Chief Audit Officer.
No
right?
fool.
Right, so, obviously she does a great job. Can't say enough good things about Monica and the job she does for us.
Thank you. Good report. Before we go on to the compensation committee, let me return to a planning committee item, which actually, one of the Funston recommendations was that we work with national, I can't remember how they phrased it, but basically they work with national organizations to encourage other commissions like us around the country to be more transparent and accountable as we are with regard to their reporting of fees. And I did want to take a two-step report on that. We wrote to the GASB, Sarah wrote this letter, to the Government Accounting Standards Board and asked them, told them what we were doing and what problems it created, and asked them to be consider changing their policies and procedures and rules. And then last week, Laura and I wrote a letter to the Securities and Exchange Commission. They were so taken with the concept and the idea that they've had follow-up telephone conversations with her, and I believe there's some sort of meeting scheduled with the SEC
Next week.
next
I
week.
believe.
So we're moving in that regard too with one of the Funston recommendations. It's parallel to, but the planning committee, but only relates tangentially to it.
And our message to the SEC was really just that the fee issue appears to be an industry issue, that the rules are not consistent, which hinders our ability to do a true apples-to-apples comparison. So it seems to me that in order to fix the problem, if we could fix it at the industry level, at the reporting level, then we can have more confidence in an apples-to-apples comparison. So our message to GASB and to the SEC has been, focus on the reporting. If they could make the reporting requirements consistent, then we believe that that would have positive benefits. So just wanted to make sure I conveyed what our message to them was.
There was a treasurer who got in a lot of trouble just the other day because she's under fire about her fees. We just gave that away. Anyways, so, sorry about that. And she used the term industry standard. And 3 or 4 people said, well, what is the industry standard? It's changing. So it is a changing dynamic. I had a conversation the other day with a media person from New York who was calling just to talk about fees and things. And I finally said to her, I said, well, did you not realize that people weren't reporting fees? She said, I never thought about it. But anyway, so she's not going to write about that. She's writing about something far more interesting. But it is going to change a lot, and I think there's more conversation out there, a lot more than maybe Rick let on today, because it's hardly a day goes by that I don't get an email from a system or a treasurer or somebody on a daily basis, always grousing about fees.
All right, let me call on the compensation committee for your report.
Well, we had a very short meeting. We met on April 9th, and the committee, in light of certain recommendations made in the fiduciary audit, reviewed and submits the following recommendations to the commission relating to the committee charter. 1, add human resources as an oversight function of the committee. As compensation and human resources matters are inherently linked, and pursuant to the recommendation in the fiduciary auditor's report, the committee believes the addition of human resources oversight is important to the role of the committee. Number 2, as part of its responsibilities, the committee would like to adopt the fiduciary auditor's recommendation that the committee, 1, annually reviews the RSIC's implementation of the compensation policy, and number 2, conducts or procures a new peer compensation study at least every 3 years to assess the current level of RSIC staff compensation and to make revisions to target salary ranges as appropriate. So we submit the following motion. Compensation Committee recommends that the Commission approve the Compensation Committee Charter as amended and presented.
Okay. Any discussion?
I guess my only discussion, I know we had originally set this up for over $150,000. This says compensation of COO and CIO and staff. So I guess it covers all staff now. Is that correct?
It has,
with these changes.
I think that in section 2.
Yeah.
Concerning matters relating to and RSIC staff, that was in there from.
Yeah, we didn't change.
Yeah, that was not changed.
So presumably the committee ought to be reviewing more than just compensation levels at 150,000, right?
I don't believe the charter, the charter doesn't outline anything related to the 150,000 because that's in the comp policy.
Right.
But what this does is broaden the expanse of the comp committee to be HR matters in general.
Right.
And so what we did, consistent with this, is we developed a job description for an HR director, which is a high-level position that will advise on compensation across the board, as well as multiple other issues. So, and then that HR director will work with the comp committee on those issues. So what I expect to have happen is that perhaps we get more structure related to HR and compensation. So I don't think we would want to make the recommendation to go under the state pay bands. I don't really think that's necessarily appropriate. But I think it would make sense for us to have pay bands for certain positions. And the HR director could help us develop those. And they would look at inputs like in public pension funds or investment management firms or, in the Southeast, things like that. I think we need to come up with that methodology. But in my mind, that's an outcome of hiring the HR director. And I think it's actually the first job duty that I put on that job description.
I think that $150,000 figure came from the delegation of authority from the commission to the comp committee rather than part of the charter.
Yeah, I was just saying this
Yeah.
for
The
the
policy
members.
issues.
I'm all in favor of this, but the way it's worded, they have a broader mandate than maybe they've
And,
taken their mandate to be, right, today.
Comes into even sharper focus now.
Right. And then the only question would be whether, since we have RSIC staff, presumably everybody's RSIC staff, whether we need the preceding language, right, would be
Typically.
redundant, right? Because the COO and CIO are part of staff, right? So you just say,
Staff?
concerning matters related to compensation, RSIC staff, right? Strike that language.
It's your pleasure.
You accept that amendment, Mr. Chairman? Okay. Any further discussion? All in favor of adopting the resolution as amended?
As amended.
Signify by saying aye.
Could you just repeat the amendment?
The amendment is item number 2, the Roman numeral 2 at the top. It would be amended to read, "The commission has established a Human Resources and Compensation Committee, HR and Compensation Committee, or the committee, to consider and make recommendations to the commission concerning matters relating to the compensation of the RSIC staff, and to provide oversight relating to human resources." All in favor, signify by saying aye.
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 All opposed by like sign? Ayes have it.
Okay, thank you.
Okay, but before we get to the report of the ad hoc nominating committee, let me open the floor for nomination of officers to be chairman of the commission for the period beginning July 1, 2014, and ending June 30, 2016. Ron?
I would like to nominate Ed Giobbe to be the chairman of the commission for that term, beginning July 1, 2014.
Do I hear a second?
One second.
The floor remains open for nominations. Are there additional nominations?
Someone else want it?
Hearing,
Job.
hearing none, the nominations are closed, and shall we declare Mr. Giobbe elected chairman by acclamation? So done.
Yay. Congrats.
Now, not in his capacity as chairman-elect, but in his capacity as chairman of the ad hoc nominating committee, can we receive a report on the ad hoc nominating committee?
The commission adopts the recommendation of the ad hoc nominating committee, and it elects Dr. Rebecca Goldenkinson. I always get that wrong.
Rebecca G.
To serve as the commission's vice chairman for the term commencing on July 1, 2014, and ending on June 30, 2016.
That's the recommendation of the committee. The floor must remain open for additional nominations. Is there an additional nomination?
Was Dr. Wilder on the committee that made forth the motion?
Two
The committee was Ed and I.
Okay. Do you want it, Ron?
No, I'm too junior.
Any additional nominations? Hearing none, shall we declare the nominations closed and Dr. Goldenson being elected vice chairman by acclamation? So done. And it would now be appropriate for me to disband the ad hoc nominating committee.
Yes.
So I hear its task has been completed, and we hereby disband. Unless I hear an objection from the commission.
Are there any subcommittee things we need to approve in light of that, or is that wait till July?
When you say
What do you mean?
subcommittee?
Like,
Oh,
don't we have
chairs or-
we have more standing committees now, so does the vice chair or chair sit on any stuff? I mean, I guess that would all wait till July anyway,
Yeah,
right?
in July, Ed would need to appoint new
Right.
committees subject to the.
Commissions, right. Yeah. No, good reminder, though.
But prior to that time, we approved the elimination of commissioner involvement, will we still, will we still?
You won't need to do the asset class part. You will need to appoint members of the standing committees, which will be the audit committee and the
Oh, all right,
compensation
good,
committee.
okay. So we'll get rid of the fixed income oversight
Yeah.
and real estate oversight and all that
Correct.
stuff.
Do I hear a motion that A, we take a brief break, and B, we go into the executive session to discuss personnel matters, receive legal advice, and discuss investment
So
matters? All in favor say aye. Aye. Go ahead.
Thank you.